Break a leg.
All right. I was waiting for it. Good morning, everybody. Hope you're doing well. I'm Jeff Gibby. It's good to see you. Good morning, Neil. Good to see you. As you come in, say hi. If you're watching us on YouTube, like and subscribe. It helps a great deal. I hear you get good karma for it. This is what I've been told. But I want to say thank you. I appreciate all of you guys coming in today. I'll be running the show. I'll be reading the legal disclaimer first. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. Good morning, Paul. Good to see you. Good morning, Greg. It's good to see you. As we go through today, if you ever have any questions, make sure to type them. If you're in GoToWebinar, type in the questions box. If you're watching us on YouTube, just chat them in, and that's great. A special reminder, like and subscribe. It helps a great deal. Also, there's a pinned comment up the top. If not, it'll be there soon. If you're watching us on YouTube and you want to register to win prizes, we're going to be giving away fabulous prizes all day. So go ahead and get registered. We do a raffle between every speaker. Want to say thank you to our sponsors today. Have some great sponsors. AAII. AAII is a very well-respected, very well-reputed organization. They're a nonprofit. They've been doing their nonprofit stuff, I think, since the late 70s. And they do the AAII investment survey. They do a lot of news and research information and research articles. They even have an active investor division. And you can find out more about the AAII if you go to aai.com. I do also want to say thanks to Stocks and Commodities Magazine. Great magazine. They've been sponsoring the show that we do and the events that we do since, it's got to be 15 years now. So we really appreciate their support. They've done a great job over the years. You can find out more about Stocks and Commodities at traders.com. Oh, and I always click on that on accident. Also want to say thank you to the Traders Forum. You can join the Traders Forum at thetradersforum.com. There you can chat with other traders. You can learn about the markets. You can learn about technical analysis. And you can do all that pretty much for free. Thetradersforum.com. I'd love to see you there. All right. We are Metastock. We're going to talk about Metastock all day long. Metastock's been rated the best software in its price category. It's only been rated that for just like only 32 years in a row now. But we're going to talk a lot about scanning the market, testing ideas, all that kind of good stuff as we go today. So great tool. I use it in my own trading. I love to use it to find and identify opportunities. And we'll be talking more about it. But in any case, not right now. Serge is our first speaker. Serge is a very good friend of mine. He's going to talk about his TST Trender system. And he does a really, really good job of kind of taking some pretty complicated subjects and making them very simple and straightforward. Serge, let's go ahead and get you started. I'm going to go ahead and stop sharing my screen. I can see you already. You look amazing.
Likewise. Can you hear me okay?
Yeah, I can. You sound great.
Awesome.
I just, let's see.
Screen.
Yeah.
Yeah.
You should be able to just do it.
Yeah, I'm doing it. 1 second. It's just pulling up here. Choose the right screen. I got too many screens, Jeffrey. That's the problem.
I can't help you there.
No, I think we're good. This one here, let me know what this looks like.
I can see the right screen. At least I can see the momentum trading stuff. I can see the PowerPoint. So I think we nailed it. First
awesome.
Try.
Appreciate it. Thank you, Jeffrey.
Awesome.
Good stuff.
So thanks for kicking us off. I'm going to get out of the way. Your turn.
How much time do I have?
Let's try and cut off right about the top of the hour, if you don't mind.
Gotcha. Yeah, no problem. We'll be a bit quicker than that. Sounds good.
Okay.
Perfect. All right, let me just quickly check if I can see the questions here. That's one more thing I need to do. And then I think we're good to go. Cool. All right. Excellent. Well, again, good morning, everybody. Thanks for being here. I'm Serge Berger, and thank you, Jeffrey and team, for setting up another wonderful conference. You know, trading and investing does carry a lot of risk, and it's important that we get educated on the markets, especially these days. Always, actually, but especially these days when markets have become a little bit complacent in many ways. It's important to be able to gauge and risk manage. I think that's very important. What I'm going to do today is, since it's the start of the day, I think there's nothing better than getting a little bit of perspective. And we live in a momentum-driven market environment. I think momentum is an important thing to understand. Does everyone in here know what momentum trading is? Give us a quick yes if you know what that is, or no if you don't know. Right? I don't know. I can't see you guys on YouTube, at least not the questions. I can't. But maybe those people here in the webinar. Right? So we live in a momentum-driven market environment, and essentially what that means is that markets are largely machine-driven, and these machines can drive markets way beyond sort of reasonable, you know, levels, be that valuation metrics or otherwise, than we've seen in the past. We also have a liquidity bubble. We've got a lot of liquidity sloshing around the global system. And so that can only add to fuel to the fire. Same thing on the downside. You can get markets very oversold very quickly, but largely it's been on the upside for the past 10 to 15 years, the excesses, and that's largely due to trend following strategies. So the good news, and that's what I'm trying to get to, is that trend following is momentum trading is here. It's here to stay, and it's only getting adapted more and more by machines, because again the markets are more and more machine driven. If we know how to take advantage of that, that can be a very powerful force, and that's exactly what I'd like to explain to you today. So I'm here in the office here, a bit of a different angle, but as you can see, same office. My career as it continues has been largely focused on different markets, different market asset classes, be that from fixed income to complex fixed income derivatives to equities and all the equity derivatives, both on the sell side and the buy side. I remain on the buy side here as a portfolio manager as well. And I also run the steadytrader.com, which is an educational website, which is what I'm talking to you from here today. Quick risk disclaimer, and I'm going to turn my camera off here in a minute, as I always say, because it distracts me. But again, risk disclaimer, I talked about how important it is to get educated. I also want to just mention that anything that I'm going to talk about here today is purely educational. This is not meant to be any advice in any shape or form. So please keep that in mind. That's all. That's all this is educational. I'm going to quickly just skip a couple slides, but I think when we look at the market through the lens of momentum, we can get through markets a lot better because we're going to constantly go with the flow. A lot of traders and investors, and you may have experienced this yourself, tend to fight the market because of some inherent belief, be that fundamentally, structurally, politically, whatever it might be, right? There's a lot of factors. And then they fight the market. The beautiful thing about momentum is that momentum is agnostic to the news flow, right? You can have a horrible economic data environment and the market or markets might still go higher. However irrational that might be, at the end of the day, the ultimate arbiter is the market price. The market price could be wrong ultimately, but in order to make money, we have to go with where the market is going, right? I've had to learn that the hard way, so I'm here to show you this through the lens of someone who's gone through this for the past 26 years now. I've been doing this for a long time, so hopefully this is going to be helpful for you. I'm going to turn my camera off so I can focus a bit more, but obviously I'm here with you guys right now. We are in a bit of an interesting environment here in the sense that we're in the fourth quarter, and there's very little that seems to matter outside of these two gentlemen. I would argue the guy on the left seems to be currently more important for the machines than the guy on the right. Um, and that's going to be a problem at some point, but it is what's making the machines tick. The thing for perspective I'd like to give you before we get started is that we typically tend to see US equity markets push higher in the fourth quarter. So far and we're here in early November, so far in the fourth quarter, we've gone through, the first 10, 11 days of November and of course all of October. We've already had a pretty strong quarter. When I talk to people and I talk to a lot of trading desks, I've never seen this many people being bullish for the rest of the year, which I'm just giving you for perspective to remain open-minded, right? The good news is that momentum is going to tell us exactly where to go, right? If momentum remains bullish, then great. But ultimately, that can change pretty quickly if it does. And so that's really kind of what I wanted to talk about. So let's talk about this a little bit more through the lens of momentum. I think for all of us, it would be helpful to be able to have a repeatable process to give us more peace of mind if all we had to do essentially is to follow buy or sell signals. I think most of you would probably agree that would be an easier way to go through life. And I can show you, for example, what that looks like if I'm going to just, if you guys give me just 1 second, I'm going to pull up, for example, the S&P 500 to kind of give you the example of this. If all I did is follow momentum, right, that would look a little bit like this here, right? So you can see, if I were to just pull up this chart, you can see this is a momentum indicator that we like to use. And all we do is we buy when there's a green arrow and we sell when there's a red arrow. Well, you will notice that the S&P 500 hasn't had a down arrow since this is now going back to April. Okay, so you can see in April we received a buy signal, and on the daily chart it remains intact. Now, of course, we can use this intraday too, but if all I did is honor that buy signal, well, the S&P since then is now up 22.5%, right? Very similar to, let's say, the NASDAQ 100. If all I did is honor that buy signal in April, right? The NASDAQ 100, however rational or irrational I might think that is now up 32%, right? And so if all I had to do is follow the buy signal and then sell when there's a sell signal, I think that would be, for most people, a very liberating feeling to have. Even we can look at something like gold, right? So let's say I took the signal in gold, the GLD ETF. In fact, actually, guys, close the window. It's pretty loud out there. Give me just 1 second. There you go. Okay. So if all I did on gold, say on the GLD ETF, is follow momentum, I would have received a buy signal there. And I'll talk about these green dotted lines and the red dotted lines shortly. But I received a buy signal, and if all I did is hold it to the next sell signal, that made 17, 16, 17%. We then had a sell signal that didn't work, okay? But then we just got a new buy signal the other day. So momentum allows us to ebb and flow with the market without having to fight it, right? Or even we can look at stocks like MU, just like Micron Technology, right? So if all we do is follow momentum, we got a buy signal in August. And again, I'll explain what these green dotted lines and red dotted lines are. They're very important. Well, MU is now up 94%. Yesterday it was up 104%. That's up 94% since then. So momentum is a very, very powerful force, right? And if all we do is follow momentum, then essentially what we're doing is we're following the computer algorithms, which I'd like to explain to you a little bit right now. So momentum, what is it? Well, my definition of momentum is a bit different than what you get in the world of physics. So I don't know how many people here are physicians or live in the world of physics or engineers, right? Numbers people. The mathematical formula for momentum is essentially expressed as P, which is momentum, is the product of m, which is the mass of an object, times its velocity. And that's sort of the definition in physics and again engineers and so on will probably know that. My definition as it relates to the markets, and I specifically say my definition because I know some people, the more quantitative people get, the more they have a bit of a more defined definition. I'm going to keep it rather simple here. My definition is essentially the acceleration of a move. And so if you think about a car driving along at 45 miles an hour and speeding up to the highway to, let's say, 75 miles an hour, to me, that is the momentum, right? That's the change. It's the acceleration. Again, so please take that with a grain of salt if you're an engineer or someone who's deeply into this, right? I'm trying to make it simple so that it's an easy concept to understand because it's not a difficult concept in general, right? It's just the question is how complicated do we want to make it? Um, so again, it's essentially the rate of acceleration. Now, I think what's important about momentum, and this is critically important, so I would urge everyone to maybe write this down, take a pen and a piece of paper. Market momentum, be that in the equity market, fixed income markets, futures, whatever, what have you, is largely temporary, right? So meaning it's not a constant. It ebbs and flows, right? It's not a constant. And that's important because oftentimes people mix or think that trend and momentum are the same thing, but they're really not, right? Trend and momentum are two very different things. If anyone has any guesses what the difference between trend and momentum is, let me know, or if you'd like me to elaborate a bit more. But essentially, the difference between trend and momentum is that um, trends, as it momentum, excuse me, it says here, momentum is largely fleeting, right? As a trader, most people are looking for momentum. I'm telling you right now that most traders, when they look at the markets, they are really looking for momentum, right? A trend is different. So here's the difference. I'm going to go you this chart. I think this chart shows it very well. So a trend is something that lasts much longer, typically multiple quarters at least, more like multiple at least multiple months, more like multiple quarters. It can certainly go on for multiple years. But a trend is that big green arrow, right? And in our view, it should not be confused with momentum, right? Momentum is when the car that we talked about before accelerates higher, right? So for example, you can see the car was going along at a certain speed, right? And then it decelerated pretty quickly. So that would have been bearish momentum. Like that's where maybe we short something or buy puts. But then when momentum comes back into the market, and this is largely machine driven. I'm going to argue it's 100% machine driven initially. Then we have these sharp bursts. So as a trader, right? If you are a trader, and I'm going to have to assume that at least a good part of you in here are, you're probably investors too, but just from a trading perspective for a moment, what you're probably looking for is these quick bursts. Now, again, these quick bursts, when I say quick, they can last on the daily charts from multiple days to multiple months. Typically, it's multiple weeks on average, right? They can last longer, but that's kind of the average tend to see. We can get the same exact thing intraday, which I'll be happy to show. Is anyone here a day trader? Type in DAY day if you are a day trader, because I'm going to show you guys how this works in a day trading time frame as well. Okay. Now, the typical challenge that we see with people using what's called traditional momentum indicators, which would be the kind of stuff that you would get out of the box from a broker platform and such, essentially what tends to happen is that the signals tend to lag, right? And lagging indicators are lagging signals can lead to false signals, right? Which in turn can lead to more losses, and that can lead to a lot more frustration than necessary. So we uh, noticed that problem a long time ago, by the way, when I was still working at JP Morgan as a side project. We were looking at this. And so we developed something that's much more uh, real time, if you will. And what we are able to do is we're able to detect momentum much quicker, right? Um, we use very specific parameters to provide us with what we think are much more accurate signals. So they're much more timely and they reduce the false positives, right? So it's much more adaptable. And that's really what we believe we need in order to trade uh, momentum. Um, I'm going to just quickly show you this here real quick, and then we're going to go into the charts so you can see this a bit better. But essentially, the charts we're going to go through together are going to have three things. They're going to have either a buy or a sell signal, and then they're going to have a trailing stop and a free profit target. So let me show you what that looks like here uh, on the chart. Um, Here are just some of the things that have taken place here in 2025. Be that intraday where we got signals right before some of the just uncanny how momentum has been working this year. Like literally before that 8.9% intraday S&P rally where Trump delayed the tariffs in April by 90 days, we received a buy signal about 45, 50 minutes before. But we don't have to go that granular. I mean, even on daily charts, you can see massive buy signals in stocks like CoreWeave, where it then rallied 171%, and then ultimately we got a sell signal, right, to go short. Or uranium, which we got a beautiful momentum buy signal on in April, rallied 67%, and ultimately, uh, actually, I'm not even sure if we ever received a new sell signal in uranium. I think it's still going. Maybe we did. Cameco, it's one of those stocks that people were focusing on a pure momentum trade, right? That we get alerts on like this, where there's a buy signal, the free profit target, which again I'm going to talk about in a second, and the trailing stop. So silver and gold and platinum and all these kind of things, and of course a ton of stocks like meme stocks like Open Door Technologies, which by the way, I don't know if you know what these guys do, but they're essentially a house flipper. Um, Anyway, so what we designed the trender momentum indicator to do is address one very specific issue, um, and that is to give people a repeatable process. I think most people that are in the markets nowadays don't have what we consider to be a repeatable process for entry and for risk management, right? And so what we see a lot of people do, and you may or may not put yourself in this bucket, is that there's at least some element of a hope and guess strategy, or as one of my colleagues calls it, spray and pray approach. And the reason why that's not very helpful is because if we have this sort of inconsistent process, it leads to a lot of emotions basically doing the work for us, which in terms means that which in turn means that we don't really know, or we have random decision making of where to enter, where to exit. We end up panicking and chasing moves on the upside. We have this constant feeling of insecurity, and we just don't know where to take even partial profits, right? So I think a lot of you could probably, I'm going to have to imagine, could probably identify with some of those emotions that you kind of go through the day with. Now, the trender momentum indicator doesn't just give us a pure buy or sell signal, it also gives us these free profit targets and trailing stops directly on our chart at the same time when we get a new signal. And this is a critical part that's critically important to the whole setup because it embeds what's called a risk management process. Okay. So I'm just going to go through a couple of examples and then we'll go into the charts so you guys can see what this looks like sort of in real time as well. So I'm just going to go through some historical examples first so you can see what this looks like and understand the process. And then we go through. So I don't know if anyone here trying to use like prop trading, like prop accounts, or maybe you're trading at home, day trading, swing trading. Does anyone fall into those categories? Is anyone trying to pass a prop account, for example? And I'm just trying to give you a bit of an idea. So one thing that a lot of people do when they try to go for sort of more consistency, or they try to pass a prop account, is they tend to overestimate how badly a few losses can deteriorate their own self-confidence, right? And so then they end up not taking the next trade. And we believe the cure to that, in large extent, has to do with taking partial profits along. And so what we designed the indicator to do is not only give us defined entry points, so green up arrows for a buy signal or red down arrows for a sell signal, but also, and I'll go through this here in much more detail in a second, these green dotted lines and the red dotted lines, which are essentially our what we call free profit targets and trailing stops. Okay, so let's go through this a bit more one by one so you can see what this looks like. So I'm going to go through a couple of these trades here on the next slides. So you can see, for example, in this case, on this particular stock, we received a sell signal right there where that red arrow shows up, and it actually popped up in our chart. And so what's important about our process is that we trade in pairs of two, right? That means in this case, we would have maybe bought 2 put options or shorted 2 shares of stock, or again, in pairs of 2. Why? Because if we trade in pairs of 2, we can take partial profits, so close half the position once we reach the green dotted line. Why half? Because once we've closed half the position, and this is very, very important whether you're swing trading at home or you work for a hedge fund somewhere, or you're trying to pass a prop account or something like that, right? It's important that we get to a point where it's difficult to lose money, right? I don't want to say impossible because that would be a non-compliant way of me explaining this, but let's say you buy a put option or you buy 2 put options there. Let's say I were to go in and I would buy 2 put options or short 2 shares of stock, for example. I want to close half the position at that point, because at that point, then not only have I closed half the position, but the trailing stop, which is essentially the purple line, has now already moved down, so that by the time I get to the free profit target, I will get stopped out with a trailing stop on the second leg. So it becomes very difficult to lose money. I'll show you this here in the next example. This is the next trade, just like we showed you here. It's just the next one. We're zooming in on this one. I'll just do this one here. And again, you can see we receive a buy signal. And at the same time we get the buy signal, we also, at the same time, this happens simultaneously, we get the green dotted line, which is our free profit target, and the red dotted line. So if I buy 2 shares of stock or 2 call options or pairs of 2, right, let's say 4, just for example, I would close half of it here. Now again, why would I close half of it here? Because once I've closed half the position, the second half would have to really drop quite sharply for me to forget losing money, even just to get the break even, even just have break even, right? And you will notice that by the time we receive the free profit target, right, the trailing stop, which once the free profit target gets reached, turns from the red dotted line into the purple line. You'll see that the purple line, once the free profit target was just about already, almost exactly, at the point where we received the buy signal. So that even the second leg is now above water, right? Does that make sense to everybody? Right? This is a critically important point. And so again, I reiterate, particularly for those people that are either trading at home, or whether you're swing trading or day trading, or you're looking to generate some sort of a whatever your goals are, right? or maybe you're working for a hedge fund, or again, trying to pass some sort of prop account, the risk management is critically important. Because in all of those examples, right, we believe it's important to get to a point where we we get to a free profit target. Again, we call it a free profit target. So, you can like that term or not. It's just we think a, a good terminology because it explains what we're trying to do. We're trying to get to a point where it becomes very difficult to lose money, not impossible, but difficult, right? And so that is really typically what allows us to be able to stick to our rules. Um, the next example, the next trade on that chart that I showed you before is a sell signal. So you can see again here we got a sell signal. So we would buy maybe 2 put options or short two-share stock or multiples of 2, right? And then we get to the free profit target, and then you have the trailing stop there. So I'm just gonna fast forward. So if I were to take all these trades, right, and I add them up, you can see that once I reach the free profit target, right? So results at free profit target, I had already locked in 5% of gains once I reached the free profit target on the first trade, on the second one, and 2.3 on the third one. The final results of each trade was 15.5%, 5%, and 9.2. This is with the stock. With options, it's a multiple of that, 3-4 times. So if I would have done these trades with calls and put options, it would have been 3-4 times that. So 15, 30, 45%, 15%, and 30-40%, right? And ultimately, and the last row here is very important, again, particularly if you're looking to, again, pass some sort of prop account or trying to minimize your losses, or if you're trading for a fund or something. What's important to see is this, right? So once we reach the free profit target and we close half the position, look at what the maximum potential loss with a high degree of confidence was. Basically 0 once that free profit target was reached, and about a half a percent, and actually a gain of 50 basis points, 0.5% in the other 2 examples, right? Now that's not 100% guaranteed, but it's a very high degree of possibility, right? Now I should also say we don't hold trades through earnings reports, for example, so that way we can avoid or at least minimize the degree of big gaps against us. So that might be worth mentioning as well. Okay, I'll show you just one quick more so you can see this, and then we'll go into some more live charts here. This here, for example, is Citigroup, and again you can see the buy signals, the free profit targets, the trailing stops, sell signal, free profit target, trailing stop, buy signal, free profit target, trailing stop. So you can see that on there. So here's the first example on this, right? You get I think we started with this one just so we have just an inch of time, right? Buy 2 put options or short 2 shares of stock, close half the position, trailing stop, right? Buy signal, free profit target, trailing stop. So that's the repeatability that we built into this. And again, same example as before. So after we reached the free profit target, so that first profit target, we had locked in 5.7 and 5.5% of gains in those 2 examples. And the final results were 7.3 and 40%. And I think this one actually is still going on, to be honest with you. But again, that's with stocks, right? If I would have done it with options, it's 3-4 times that. So let's call it 20, 30% and 120 or 160% of gains, right? And again, most importantly, more than anything, is that after I reached a free profit target, it would have been very, very difficult to lose money. In fact, it would have been very difficult to lose any money after the free profit target was reached. So that's what the way we like to look at this. Okay, so I'm just going to take a real quick sip of water, and then I'd like to go into some examples here that I think I know a lot of people like to see some of this stuff kind of working in if you will, in real time on the charts. So we will look at this here together in just a second. If there's any ticker symbols that you guys specifically want to look at, I'll be more than happy to look at those with you guys. So just let us know if there's any specific stocks or indices or ETFs or whatever that you would like to look at. Okay, but also what we haven't done yet, and I would like to show you this, is how this works on an intraday basis, right? So we'll show you that here as well. So let's just look at this a little bit here. I'm going to quickly bring up a chart. If you guys give me just 1 second. Where were we before? Here. So I think, we can look at, for example, something like AMD, right? Which I think I'm just a couple of stocks here so everyone kind of knows what this looks like and how it works. So I'm going to take a stock like AMD. So this is Advanced Micro Devices. So let me quickly bring this over so you guys can all see this. So here, for example, this is AMD. Okay, so I'm going to make this a little bit larger. Okay, there you go. So I'm going to go with AMD. And what you can see here is the momentum signals, right? Not every single signal is going to be a home run, but you can see that we end up reaching the free profit target most of the time. And if not, we get a very clear defined stop loss. So let's just take these couple of examples here on AMD. So we had a buy signal and it did not reach the free profit target. So this one would have been a stop loss of about 8%. Okay, so that's 8%. And then we can look at the S&P 500 in a minute for those of you guys that are asking, right? Then the next signal, if all I do is go from, so I'm going to keep it really simple here. We're not even going to use the trailing stop. We're literally going to go from signal to signal. So if all I did is then go short or buy a put option and then held that trade until we get the next buy signal, I would have made 5% on that next trade. So this one is plus 5%. Oops. So let's just go 5%. Oh, no. I need to write this down like this, don't I? So 5%. Okay. Then we received a buy signal. And if all I did is buy and then close that position when we got that sell signal, that's 72%. That's 72%. Gosh, here's 72%. Okay. And if then all I did is buy, or short the stock and closed it when we got the buy signal, we would have lost probably about, I'm going to say, just to be really, really conservative, probably, about 1.5%. So that's minus 1.5%. Okay. And then the latest signal just came the other day, and so far AMD is up about 43% or so. So 43%. So if you remember at the beginning of our chat here this morning, I talked about how how momentum allows us to be agile and ebb and flow with the market, right? So you look at this, right? All we're doing is going with the market because the machines are ruling the day. You guys all see that. So instead of trying to fight it, like I could have come up with 100 reasons not to like AMD in April, right? I can still come up with 100 reasons not to like AMD. But the reality is, stock, we lost 8% in the first trade, made 5 in the second, so now we're down 3%, made 72 on the next one, so now we're up 69%, and lost 1.5, so now we're up 67, let's say, and then made 43%. So that's 110% on the stock. If I would have done those with options, it would be multiple hundreds percent, probably, right? Do you guys all see how that works? Right? It's really straightforward and repeatable, and that's really what we're trying to show you. Is the repeatability of it all. Or something like CRWD, right? This is a company called CrowdStrike. I think a lot of people have become familiar with that name this year because it's been in the news. But this is another classic example. Instead of trying to come up with narratives of whether of liking or disliking a stock, let's just go back to April, just so in the interest of time. Again, buy signal, and then again we have that free profit target. It's just a little green dotted line there, right? So we always want to close half the position at the free profit target. Let me walk you guys through that. And then if all we do is hold the trade till the next signal, right? That's the most conservative way of using it. Here's what would have happened. So would have bought CRWD. I would have, again, closed half the position once we reached that free profit target. I'll zoom in a bit more in a minute. But buy there, sell here, that's 25%. It's probably a bit more, but again, I want to be conservative in terms of giving you these numbers. Next, sell signal. And if all I did is hold it until the next buy signal, that's 6%. So that's a 6% gain. Again, with options, it's 3-4 times that, right? So now we're up 31%. Now, again, what's important is that we close half the position. So if I buy a put option here, I want to make sure that I close half the put options once I reach that free profit target. So right there is where I would have closed that. Then we had a buy signal, free profit target, and that one remains valid, right? So now this thing is up 25%. 25%. Oops. Like this, 25%. Let me type this in. 25%. Okay. So now you're looking at 25 plus 25, even I can do that math, that's 50. 56% of gains in 3 trades since April, right? With options, 3-4x that between 75% and 100% is what I would estimate on that. Right? This is all we're doing is going from signal to signal. Now, there's a more efficient way of doing this, or a more effective way, by actually using a trailing stop. But in the interest of time here, I want to show you the most conservative and easiest way of using it, and you can see the results in some of these stocks, right? So hopefully this is giving you some perspective. Let's look at, for example, the S&P 500 or the QQQs for that matter. Okay, I'll go with the SPY. Let's go back a few months so you guys can see this. So we'll start off with, let's just go back all the way to what is that? February. Okay. Now since February, we had basically 2 trades on the daily charts, and we haven't talked intraday yet, but I'll quickly go through it. So we had a sell signal, then the free profit target, so we close half the position there. And if all I did is then close that short when we got to the next buy signal, that's a 7% gain. That would be a 7% gain. That's on the index level, right? That's big. That's a big move. Then we got a buy signal, and guess what? As much as I could have and admittedly thought that this market shouldn't go higher, the reality is we've had a green buy signal in April. This is live right now, and we have not had a sell signal yet. In fact, we're not quite close to one, to be honest with you. It can happen quickly, but we're not there now. So that's another 22% right now. So on an index, this is up now. Let's call it 29%. So it's another 22. So again, with options, if I would have done this with options, again, instead of 29, 30, 90, 120% would be kind of the results. Now, if you're wondering how this looks like intraday, right? I'll quickly turn over to that for a second. Actually, before we go to intro, let me just quickly show you guys, because I want to make sure we stay on time here. And I know I'm probably already kind of going a bit long. One thing I want to just show you, because some people are probably wondering, how do you access the indicator? Well, first of all, you can use the indicator on Metastock, right? So it's very importantly, we're here with Jeff and his colleagues putting on such a nice show. So the indicator can be used on Metastock. So that's very important. It's also available. It's called the TST Trender Momentum Indicator. So if you use Metastock, for example, you can request it there. I give you guys a way to you can actually get access to it. But it can also be used in some other things like TradingView and NinjaTrader, Thinkorswim, which is part of Schwab, right? So it can be used in some of those other things as well. Just so you guys know. Okay. Let me just continue here and just go along before I show you how this works intraday. For those people that like the idea of trading momentum, here is what this looks like from an offer perspective. So if you want access to this indicator, you can get a full year's access to it for just $397. That's 80% off. So you guys know that's a pretty good deal, I would say. If you are wondering how you can get access to it, the the link that you need to use, it's www.metastock.com/trender, right? That's where you can go grab access to the indicator, and then I'm going to show you guys um, how to use this for intraday stuff as well here in just a second. Okay, so intraday looks exactly the same as on the daily chart, but I'll show you guys this here in just a minute. If you are joining us and you want to use this trender indicator, again, whether you're trying to pass a prop account or you're trading for a fund, or obviously if you're doing it at home, which is probably the majority of you, we believe it's very important that momentum is one of those tools in the toolbox that we all use, number one, but also it's very important that we are able to risk manage. So that partial profit taking and specifically the 50% is very, very important. So mathematically, where we place our profit targets and trailing stop is actually very, 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 very important to the success of using this. You can use credit cards and PayPal for this. If you have a question, Metastock has a great support staff that you can reach at the following number there. It's 800-882-3040 on your screen there right now. You get access to a whole bunch of other goodies, by the way, for this. You get access to 3 additional strategies, a short-term strategy, a swing trading strategy, and a long-term trading plan as well, a bunch of checklists, and of course, we do members sessions. So our next member session, and anyone that's joining here, I would really encourage you to join us on November 17th. So that's this coming week. We're going to do a member session where we're going to trade this live, show you exactly how it works, make sure that everyone understands exactly how to use it, right? We'll even do some live trades. So that's what's taking place on November 17th. So if you want to get access to that session and the indicator, you want to make sure you grab this here before the session's over, probably, so that you can grab it at the 80% discount. Now, we talked about day trading. Let me quickly show you what this looks like. And then I know, Jeff, we're probably going pretty close on time here, but I'm going to be quick. But I want to just quickly show people what it looks like intraday so they have an idea. So for example, this was the NASDAQ 100 yesterday. I'll show you what it looks like right now in a minute. But this is a 5-minute chart, so you can see we get a buy signal right there, right? And then it has a free profit target and the trailing stop, right? Same thing like right now. Let me quickly fast forward to where we are right now. So right now, we actually have a short / sell signal on the NASDAQ 100. Let me quickly show you this so you guys can all see this. So here, right, so this is live right now. I couldn't make this up if I tried. So we got a sell signal, and you can see the profit target. The free profit target is right there, these green lines. But if we're lucky, it's going to reach it here shortly. That would be pretty cool. But you can see this would have been where I could have bought a put option or shorted the stock, whatever, right? Again, the point is to then take partial profits here. So that means 50% of the position. So if I bought 2 put options, I want to close half of them here, right? And then I can use the trailing stop or just go until the next up arrow, the green buy signal appears, okay? Jeffrey, I'm going to pass it to you, or at least make us interact in some shape or form if you would like. But I thought I would show this in the multiple time frames. I think that's probably helpful for people to see. If we're lucky, this is going to reach the profit target here. That would be pretty cool to see. But anyway, hopefully that was helpful for everybody to see.
I thought it was great. Thank you, Serge. And I want to show just kind of some of the Metastock integrations. So if you don't mind, I'm going to take control.
Yep, please do.
All right. Thank you so much, Serge. I really appreciate it. Let me go ahead and do this. Push this button. Okay. And then you should be able to see a box. All right. Let me go ahead and run, and I'll, just for fun too, go ahead and let you see me. Hi. I ran a really quick scan. I wanted to show how easy this is to use because it's not hard at all. And so I set up a little bit of a scan using our Power Console, and it only took a few minutes. I just ran it. And the results are right here. But what I decided to do, just to kind of give you an idea of how this works, is I came in here, did a little search for everything that starts with TST. You can see I did the swing mode. That's the one that looks at the daily charts. You could also do the day trader mode, which would look at the intraday charts. And then there's also a custom mode. But just to kind of give you an idea of how this works, I came in here and said, well, okay, let's quickly run a scan of the NASDAQ 100, the S&P 500, and there's some other stocks that I kind of make a list of every month that are in a trend. And so those stocks that are trending, let's run a little bit of a scan. Let's find kind of the results. So in total, there's about 1,500 stocks that I scanned through. And out of those ones, and just within a minute or two, it came up with a list of everything that had a long opportunity for today, right now, or a short opportunity for right now, today. And so if I look at this, in terms of the actual exploration, anything that has a 1 in this long column is going to have that long opportunity. Anything that has a short is going to have a 1 in the short column. So very easy. I can even sort it based on the criteria. I keep talking about this. I talked about it all day yesterday, but I love the ability to just say, okay, I'm looking for an opportunity. I don't necessarily want to look at, in this case, I did a scan against 1,500 stocks. Just show me the ones that have a potential opportunity. Let me look at those and make a decision on the ones that I like the best. So I'm going to go ahead. New Mining Corporation came up as something that has an opportunity today. I want to open this up. I'll just take a look at it real quick for you. We are kind of running a little bit out of time, but I want to show you how cool this is. So we'll go ahead and pull some data. It's pulling it up on an hourly. Let's go ahead and change that to a daily basis. And here we've got a little bit of our indicators. I'm just going to zoom in here. And this may not be showing. Well, let's take a look here. Let me make sure, since it had I want to make sure we have the correct indicators attached because that's what we're looking here. You can see that opportunity that shows up right here. What happened is I had the intraday version. So on a daily basis, this is forming a long opportunity. If I want to get a little bit more information about that, I can see the moving averages. I can see exactly what happened with the crossover here. I can see every time that's happened in the past. If I want to get a little bit more detail on this, I love this. I'm going to go ahead and click on View, Expert Commentary, and it's going to give me some explanations that Serge put together around this signal. Okay, so right here it says a TST trender indicator is designed to take advantage and give signals. Kind of gives you an overview. I'm not going to read this all, just mostly because of time, and I'm not great at reading out loud. So right now it's saying that we currently have that long opportunity. It gives us a profit target, 91.94, and a trailing stop loss. And those will update on a daily basis as you go through. And it's really, really straightforward. It's very, very simple. But that's how you can kind of go in and find the opportunities. It's easy. It really doesn't take a lot of time to talk about. It's a very simple tool. We've designed a MetaStock to make it very easy to.
We're getting real close right now, by the way, for that intraday signal in the NASDAQ 100 to reach that free profit target that I showed you before, just so you people know.
You're cool. I just jumped out of my chair because I didn't expect talking.
Oh, sorry. I didn't mean to scare you, Jeffrey. I'm still lurking in the shadow.
I'm jumpy. Yeah. Cool. In any case, in terms of this add-on, the indicators that are included. You get the custom version. There's one that's kind of streamlined for day trading, and one that's custom made for swing trading. And you can actually go in and test different moving averages, different options, and actually customize it. And that's why you have a version that you can customize. And in the training that's kind of included with it, we'll talk about that in a second. But in the training that's included, I actually go through and show you how to run that test, how to run all the custom stuff. It's straightforward. So as part of the add-on, you get the custom mode, the day trading mode, and the swing trader mode. Those are all built into the platform. You do have the ability to test, and you do have an optimized test. So you can test the pre-made variables. You can also go in and test and kind of custom build something to kind of work for you as well. So I show you the expert advisors. I love the fact that it just kind of gives you some pretty important advice. Like, okay, if you're having a long signal, where's your stop going to be? Where's your profit target? Those are kind of the things that you need to kind of have a business plan in place. So there's your commentary. As Serge had said, it includes 12 months to his room, to his education service, 12 months of the trade alerts. Included is a risk management for all trades, a step-by-step tutorials on how to use TST Trender. live monthly coaching sessions, the 3x. All of this is like $397. So we also did, Serge and I sat down right after the launch of this. We recorded a training. He talks in it quite a bit about DST Trender. And I actually go through and kind of show how to exactly do the scanning, how to optimize the settings if you want to, all that kind of stuff. Very, very good training, available instantly as soon as you're ready, as soon as you place your order, basically. So normally this is $19.97, $397, includes a money-back guarantee. You can get that if you call us at 800-882-3040. I know we had a lot of charts that we just didn't have a chance to look at. We'd be happy to send you charts if you want to see charts. Chat online with us, metastock.com/saleschat. You can also take advantage of this at metastock.com/conf-promo. So with that being said, that is right on time, Serge. Thank you.
Thank you. I appreciate it, guys. And again, just keep in mind the markets are ever more algorithmically driven. So momentum is the name of the game. It's just important to stay flexible and just respect what the machines want to do, because they have more money than I do, certainly. So they're going to
for
dictate,
sure. Me too. By a little.
Really?
Serge,
come on.
I'm going to excuse you, but I want
Thank you,
to
guys.
say thanks for having you. All right, cool. We try to excuse people because otherwise they get an option to end the room, which is never that fun. Anyway, metastock.com/conf-promo, 800-882-3040, metastock.com/saleschat. As we move on to our next speaker, I want to say thank you to the American Association of Individual Investors, which I find easier to say than AAII. You can find out about the AAII, the American Association of Individuals, at AAII.com. It's a great organization. They've been doing their nonprofit work since the 1970s. If you've heard about the AAII investment survey, they do that. They do a ton of research on different companies. They do a lot of fundamental things, but they also do an active investing group as well, AAII.com. I very much appreciate the support and the sponsorship that they've done for the conference we're doing this week. We'll talk about the other sponsors today. What I don't want to skip is a prize. Mr. Lewis, will you help me out?
I absolutely will.
Do you like prize time?
I love prize time. Is my favorite time. Everyone loves prize time. Hey, have we taken a moment to thank our veterans today?
I don't. Yeah, happy Veterans Day, everybody.
Happy Veterans. Thank you all for your service.
Right. Yeah. Also, let's see. Let me give away this book, High Profit Candlestick Patterns by Steve Bigelow. Steve Bigelow was a good friend of mine. Very likable guy. Super, super nice guy. Learned a lot from him in terms of my own trading, and always has a special place in our heart, for sure. I want to say we're going to give away one of his books, The High Profit Candlestick Trades, or Candlestick Patterns. And it's right here. I'm going to actually take this to the post office. Maybe not exactly this copy, but send it to a few winners next week. So, Mr. Lewis, what I need from you, I've got the list ready to go.
Yes.
I just need a number between 1 and 5,599.
1 and 5,599. Whoops, just a second, please. Okay, according to Google Number Generator, that is going to be 2,134. 2134.
Okay, that is Jerry M., who has an email address that's ITRB. It starts with ITRB. I'm trying to give you just enough information. If it's you, you know who it is. If you're watching, Jerry, and that sounds like your email address, sounds like it might be you, say hi in the chat because you just won this book. So, Greg, thank you very much for the assist.
You are welcome.
Also, I will tell him. If you're watching us on YouTube and you want to be eligible for all the prizes that we give away every day, just make sure you register. There's a pinned comment at the top of the YouTube chat that'll allow you to register for the event. If you're watching us in GoToWebinar, we always get this question. If you're already watching us in GoToWebinar, that means you're already registered, which means you're already on the list. So you don't need to worry about it. So in any case, I do want to go to the next slide. Oh, this is the wrong order. This is not who's coming up next. Let's go ahead. Oops. Our next guest is Rahul Mohindar. And Rahul is a great friend of mine as well. It's not Jeff Tompkins. That's the next one. So I need to kind of do some slide reordering. I'll do that in just a second. Rahul is a very, very good partner of Metastock. He's been a partner of Metastock for as long as I've been an employee of Metastock. And I think he started exactly the same year I did. Over the years, Rahul has trained a big number of people how to trade in India. He's been featured in CNBC India, CNN India, and he's also the RMO model that's built into Metastock is actually the very first trading methodology that I actually traded my own money with. So we love Rahul. He's a great friend of Metastock, and we're going to get him started right now. Rahul, let's go ahead and get you started.
Hi, Jeff. How are you doing?
Good. I'm glad we can hear you. All you need to do right now is just click on that little share button by the microphone button.
Yep.
And then that should allow you to share your screen. I can see it already. Rahul, thank you for joining us today.
Thanks, Jeff. It's always good you guys keep doing these events, and I keep saying it, and at the cost of repetition, I'd say there are very few companies out there who care for their customers and traders as much as you guys do. I mean, been in the industry over 2 decades, just like yourself, and I think kudos to the entire team at Metastock. The fact that you set up such events and give users a plethora of speakers, not just one or two.
Right.
Sometimes I feel it's a lot to digest, but we all try and do a little bit to make sure that everyone leaves with something which they can write home with.
Cool. Yeah. Well, and we love we love you. I'm going to turn the time over to you, though. I can hear you good. I can see your screen. So it's your turn. Go.
Thank you, Jeff. Friends, welcome to this brief yet powerful presentation that I'm going to make on the RMO ATM. I know a lot of you know me for the inbuilt RMO, or the Rahul Mohindar oscillator, which has been part of Metastock for several years. And what happened was, from the RMO, I progressed into introducing the automated trend module. So ATM stands for automated trend modules, where we elevated the RMO system itself. We looked at possible optimizations. And today what I'm going to talk to you about is a couple of systems which have been recently introduced within the ATM, and at the same time some things which you could immediately use that are very powerful. So I'll try and give you a brisk overview of the RMO, and I'm not going to take a lot of time on the original RMO, because I did see that later down the day you will have a wonderful session by Kelly, where he's probably going to talk a little bit about the RMO and how you can interpret the inbuilt RMO inside of Metastock. So I'll leave that thunder to him. I'm going to just give you a brisk overview of the inbuilt RMO and then dive straight into the ATM, which I think is something all of you can really do well with. So first, a brisk overview. The RMO, Rahul Mohindar Oscillator, as it stands for, is a tool which I designed so that you could detect the longer term primary trend. So if you use this indicator, the idea is to get a focus as to, is the primary trend positive or negative? Are we bullish or bearish? As simple as that. It comes up in the form of an oscillator. And why did I design this? Just to give you some science and thought to it. I was like one of those traders who like to use the MACD, the stochastics, the RSIs, and nothing wrong with these tools. But what I felt was sometimes I was not just lagging, I wasn't very superior to what anyone and everyone was using, but at times I felt I was really in an inefficient mode where I was drawing too many lines, trying to detect divergences manually, and hence I needed something a little more automated. For example, on this chart, as the market was making newer highs, you'd call it a negative divergence on the RSI. So prices make new highs, but the RSI is unable to make. And you keep extending that on the right, and that's not a good thing because whilst the market's going up, you're only in a state of fear, keeping on stating negative divergence. So we really didn't understand where did negative divergence end. Or, the MACD often crisscrossed 5 or 6 times, and that could often, throw me astray. So I was trying to bridge the gap between a lot of confusion, manual drawing of tools, which is where I said the only way to kind of remove emotion and manual approaches would be to get to something which is automated but yet not at the cost of accuracy. I needed something which did that more mechanically for me, which is how I introduced the inbuilt RMO. The inbuilt RMO is a green oscillator, and if that green oscillator, like you see on this chart, has been above zero, and I'm just taking a very old chart phase, a phase between 2017 to 2021 on our favorite Apple, it shows the RMO has been on a positive mode ever since those 4 or 5 years. So it's a wonderful way to understand that how it's trying to keep you focused on the buy side of things, where if you see the RMO is above zero, you're constantly looking at where to buy. Now, in case you're wondering why have I kept the RSI and MACD, it's more to show you a MACD could have a lot of crisscrosses in this journey, but this RMO, when it went positive, it just stayed above zero. I'm not worried about the curling or the shape of the RMO. I'm just looking at the fact that it's green, it's above zero. That's the oscillator, which is positive. I'm not worried about drawing divergences. Every time the market made a new high, I'm not going to get worked up with negative divergence because that, my friends, often is not what you're supposed to be looking for. The real question is where does divergence end? And that answer is not given necessarily immediately by the RSI. So I'm not getting worried about overbought, oversold, MACDs, moving averages. I'm just simply looking at a longer term trend being in force. The second element which I want to talk about is, so applying the template will give you a few things. You get arrows, bar colors, and I'll come back to the slide in a bit. You get three things. You get arrows, which are here, which is the short-term trend, bar colors, which indicate the medium-term trend, and finally, we are talking about the long-term trend, which is the RMO oscillator, or the green one on top. If I didn't use these histograms, I could just look at the chart here and understand that when I got the blue arrow here, that's a buy on a short term. When I get a blue colored bar or a blue colored candle, that's medium term switch up on trend. And then the long term switch up comes in over here when the RMO shifts from a bearish to a bullish. So if you don't like to look at the oscillator up top, at the bottom, you do have the x-axis, which gives you the ribbon which shows you bearish and bullish zones. So the good thing about it is you're looking for where there's a synchronization of short term, medium term, and long term. And this is where I come in and keep reminding users that look, there's no need to use three different charting styles. You can't use a daily, weekly, and monthly all the time. You can't say I look at a 5 minute, a 15 minute, and a daily. So there's no need to try and do that mix and match because quite rarely would all three be in perfect synchronization. You should in fact focus on using one time frame, one rule set of studies, and in that one time frame use an indicator suite like this which does the analytics from a short term, medium term, and long term all on one page rather than having to go around the bush and trying to figure out it manually. Right? So buying into the trend requires three elements to recap, where you're looking at a buy arrow, the blue colored arrow that is, which I showed you, a blue bar, which indicates the medium term trend, and finally a positive RMO, which is the main indicator for us. The longer term primary trend is positive if this green histogram is above zero, right? So here I've marked out on two verticals where you have this synchronization of all three. In other words, why did I mark this? Notice the arrow came in here, the blue bar comes in here, and it's only down here if you look at the x-axis bearish switch to bullish. That's the first point that all three align. This, my friends, the second one is an add-on where you got a red arrow, but it's switched back to blue. So this is just a short-term shift. So this is what I call an add-on. This is what I call the first breakout. What do we need to do? Focus on the first breakout rather than the add-on. So in other words, the first time when it rotates from a bearish to a bullish zone is what I'm trying to help you focus on. So don't get too mechanical and just say, I got all three over here. That means I'll just dive in. So sometimes when you see a red arrow, you may see some short-term pressures, but again, try and make sure that you are understanding that the texture of the long-term trend is still positive if this RMO is bullish. Now, don't think that this is only for buys. This is beautiful when it comes to sells as well. You've got red bars which indicate bearish price action on the medium term. Notice you get the arrow which always comes first. So it's very common to see that first comes the red arrow, then comes the red color, then comes the oscillator, right? So when you have a synchronization of those three, those are indications. This is the first time when you shifted from a bullish to a bearish, making this the marquee signal or the first signal. These are what we call add-ons because, okay, these still are red bar, red arrow, RMO negative, right? You follow the three rules for the sell and that's how you get it. Now always use a rule of trigger to qualify your entry. So sometimes you get a buy like this where you can see I've marked a dotted line. This is the bar where everything synchronizes. But notice it does not cross the high of the bar. So when you get a signal, I needed to use a rule of trigger. So let me repeat. Getting a signal is not good enough. I needed to trigger. I needed to follow through. I needed to confirm. And the simplest form of confirmation for a buy is going to be go above the high of that signal bar. If it doesn't go above the high, please consider it as a dead signal. In other words, it never really fired, right? So I want to make sure that we understand this. Once you identify a signal, make sure you use the high as the trigger. Let it trade a couple of minutes above that, a few ticks above that. I want you to watch that before you just mechanically, push the button on it, right? So use a rule of trigger and don't expect the RMO setup to be a lead, right? Now, again, if you look, the market dropped quite a bit in this case, and here comes a sell. Why? Because you got the red arrow. See, if you want to get sensitized, the first comes the red arrow over here. You get sensitized to a short-term pressure. Then comes the red bar color, medium-term pressures shift in. Then comes where does the RMO go negative? So if you watch down on that x-axis, you can see there's that. The low of that doesn't break, which means the long-term texture doesn't break, right? So in other words, if you're going to necessarily think that I'm going to wait for all three and try and catch the peak of the market, that's not going to happen. But the whole point is, I don't think we're here to catch peaks and bottoms. My philosophy is very simple. When you trade, I want success ratio, I want comfort level, I want you trading in the direction of the longer term trend. And that is why I would say that please focus on trying to trade in the direction of the RMO, right? Don't expect it to be, a top or bottom picker. Now, within the ATM suite, I do have an indicator. If you're someone who's, a money management freak or someone who really enjoys tweezing those tops and bottoms, you can definitely use tools like the counter trend indicator, which are very specifically designed around the fact that you may want to be looking at how to corner into potential tops and bottoms with lower risk, right? So those are great studies for you if you're looking at, top and bottom picking. But the RMO is all about, understanding the texture of the long-term trend and trading in the direction. So quick recap on it. First or add-on breakout, I need you to focus on the first breakout. Always trigger with a filter. The next bit, which is the most important bit, and I could spend days on this, but I just have a few minutes. Stay disciplined with the rules. I reminded you that try and stick to one or two stocks, try and stick to the same rules, the same quantity, at least 10 times in a row. That's how you know you're 7 out of 10 correct or not. What happens to a lot of us is we have, maybe 15 different items or 15 different symbols we're trading. We keep switching up the time frame. You take a trade on the 5 minute, you switch it to the 15 when it goes wrong. So no twitching around with time frames, no twitching around with symbols. Don't suddenly just chuck a stock and say, okay, this doesn't work for me, I'm going to move to the next one. I need you to be consistent to evaluate yourself. Give yourself a fair shot. Same stock, same rules, 10 times in a row. that's a fair shot, because if you're going to say, look, 2 trades went wrong and I cancel the stock out, when the big move comes, you're not going to be there, right? So try and give yourself the room to be successful. The beauty is the entire ATM suite comes to you with inbuilt explorations. So this exact philosophy of, where do all these three signals synchronize? I call this the 3D buy setup, or the integrated buy setup, where I have the arrow, where I have the bar color, and I have the RMO signaling. And mind you, these could all happen at 3 different points in time. But the first time that happens, it is going to come up on the scan. And the beauty is that is provided to you through the Explorer, which you can scan through and find out where do I have a 3D buy and have a first signal, right? So the beauty is the Explorers do a fantastic job for you. We further couple it with templates, expert advisors for that commentary. And again, I'd leave that for you to explore on your own. But let me just tell you that it's not like you're going to go on a hunting spree one by one to find out where do I have this synchronization. You'd actually be spoiled for choice, and you'll get all the stocks which kind of are in alignment with the Explorer. Finally, the super filter, as you can see, the last one over there, the ATM RMO super filter, is another included aspect within the ATM suite. And I'll tell you where it's different. The original RMO just had 2 colors, red and blue on the bars. But if you look at this chart now, there are 4 different colors. There's a light blue, there's an orange, there's a red, and a dark blue. I repeat, light blue and dark blue, orange and red. And the whole idea is you should understand the light blue suggests mild bullish. When that mild bullish changes to a deep red, that's extreme bearish. And when that red shifts to an orange over here, that tells you from a very bearish, I'm kind of moving to just a bearish. I'm not trying to say that's a buy, but you get to feel the texture of the trend. And I need you to understand that, because that'll help you in inculcating, your behavioral tactic towards your trade once you understand how that trend looks like. So if you look over here, and I just did a quick snapshot of some data of 1 year from Jan 24 to about Feb 2025, and this is the Indian index, where you can see that either I've been light blue or dark blue right through 2024, and then from October 2024 we've been in this down phase where you've had red and orange. Of course, this is not up to date. Again, I'm not trying to make commentary on the markets here, but how does it score over here is, notice the RMO went bullish. But what happened to the bar colors? The bar color stayed orange. So why is this more superior to the RMO? Why is it that it could, help you not get trapped into a buy over here? Is because of the fact that the super filter, as the name suggests, is a super filter to the inbuilt RMO itself. So why is it a super filter? Because what happens is, since the RMO has been fairly old and it's works to what we call static values, the super filter concept works on dynamic values. It does not work on a set value, right? So in other words, it's tailor made to the volatility of the chart you open. So for example, if I told you use a 200-day moving average on a particular stock, you cannot do that for every single stock necessarily. Well, you'll not get great perfection if you just try to make that a simple process as just one average for all. Maybe the 80 period works very well for one, maybe the 3 period works well for one, maybe the 32 period works well for another one. So this is doing that little tweak where it's factoring in. And how is it doing that tweak? It's judging by the volatility of the stock. If the volatility of the stock increases, it needs to help slow down the signal. If the volatility of the stock decreases, it also needs to help stabilize the signal, because otherwise a lot of chop comes into trading. So this whole speeding up of the signal or slowing down of the signal is something that it intelligently is doing. If you look over here, you've got a couple of blue bars. Now I'm comparing the old RMO here to the new so that you just understand the texture of what's going on. Blue and red, a lot of blue and red, a lot of bearish going to bullish over here. And if I just looked at that whole setup. I don't have that. That's all orange over here, right, in the new one. Now let's show you something a little more current. This is not absolutely live, but it's fairly recent. I mean, probably till a couple of hours ago. This is XAU, or some of you like it as gold, right? And what I'm showing you is a 2-hour chart of gold. And mind you, of course, XAU as an FX symbol, I believe, does trade virtually 23 hours plus. So we're dealing with a lot of data, which is why I've chosen a time frame like 2 hours, right? So each bar that you see is 2 hours worth of trading data. What's happening on XAU? You've had a phase where gold had this big crash from 4,300-ish down to 3,900, fairly severely, fairly quick, and that's big on gold. And if you look, what happened is from light, you were earlier dark blue all the way. That dark blue shifted to light blue, so that's one textural shift. In other words, from a very bullish, you just tapered down to light blue, and then that moved to red, and that's when the big crash came, right? So that's something which is important. Notice again over here the RMO went bullish a couple of times. See here? But the good thing is if you use the super filter, you don't need the inbuilt RMO. This is marked at orange, so you don't get into that situation of unnecessarily getting into buys. Similarly, when you get the dark blue here, takes the high out, it follows through and moves on. So that gives you an idea on a slightly more current perspective how it works. And the reason I showed you gold was a lot of people ask me, look, you keep showing me stocks, but does it work for commodities or FX? Here's euro. I mean, again, it's not an up-to-date chart. It's just for educational purposes. So here, this is a 10-minute chart, which I extracted sometime in February. And you can see over here the same thing. Wherever I get dark blue, high is not crossed. So this is what I mean by a signal, but no trigger, right? You get a red over here, but no trigger, right? So you get the red here, breaks the low, that's a trigger, right? So the beauty is you are able to, latch on to those trends and stick with that direction with absolute ease. It's just color coding the bar. Now it looks very simple, but under the hood, it's trying to check the volatility of the symbol you're on. It's trying to adjust values. It's trying to have a superior finishing in comparison to what you see within the RMO. For example, here the RMO went bullish 6 bars ago, and that would have trapped you into a buy. But here the dark blue comes in over there, the high does not cross, and you're saved. So you're still in that same sell mode. So the beauty is the super filter definitely gives you a more holistic approach where you can see transition and understand that transition with the 4 different colors, and therefore we say it's a smoothener or a filter to the inbuilt RMO, right? So if you do use the super filter template, or what I call ATM RMO, you do not necessarily need to use the old RMO because you are progressed onto a stronger version. Now let's look at what happens is the speed up and slow down. Over here you can see the indicator definitely came in much before time. The dark blue bar is a strong buy indication, and if you look at the older RMO, so you can see over here that the blue bar gives you an early indication of trend change, and therefore you could say that the super filter is much faster. But look here, the RMO went negative, but here it just stayed light blue. In other words, it did not go negative. So now you would say that it slowed down. So you can see that the ATM RMO, the super filter, is not necessarily just a faster indicator. It's fast where it thinks it should become fast, but it's slowed down over here. You know why it slowed down? You probably saw these bars are not moving, and therefore there's a possible chop or a whipsaw that could potentially come, and probably might have slowed down looking at that, right? So it looks at both volume and it also looks at volatility. If volume is not available, it only refers to volatility, and therefore you have a much better throw at your signals. You have a much better take. So if you look at the old RMO, you got just blue and red. If you look up, you got just light blue, dark blue, orange, red, 4 colors. So you're definitely more superior off. You don't get into this chop of red over here because the light blue helps you stay solid, right? Often it's a big difference. It gets you a signal of sell 3 or 4 days earlier, And that could be a magnanimous move, that those 3 or 4 days could translate to sometimes 5 or 6% on price, right? So let's, give some weight to it. Now, let's dive straight into another concept, which is a relatively newer study, which I built around. It was the automatic support and resistance zones. Now, I know this is a very loosely used term, very, very commonly used term, and also a loosely used term, because a lot of traders find supports and resistances very conveniently. They look at previous highs, previous lows. But what I felt was, can we use an automated model which finds out a level above which a vast majority of indicators will go positive, or a level below which a vast majority of indicators would go negative? So my definition was, plot a point above which we will break out on several indicators. That's what I call resistance. I did not call resistance the previous high, or some past historical reference point. So what we've done here is quite groundbreaking. We've tried to find out a level below which indicators are going to switch up to the bearish side, and a level above which the indicators would switch up onto the bullish side. And this is a unique way of looking at support resistance, not that classical approach where you just look at previous highs and lows. And what it does for you is, now if you apply the template, again, this template, for example, is a preset. It would just mark blue points and purple points. So blue points are resistances, purple points are supports. So if you look right down at the base over here, the market held a support and it rotated up. I'm going to talk about these two lines in a bit, but just try and understand first the blue point and the purple points. Purple is support level, blue point is resistance. As soon as I close above that resistance, there comes a big up move. And in between, I do get further support. So when you see a support, I want to see a closing below that level to get worked up, right? So where does that happen? You got a support here, then you got a resistance here. You did not cross the resistance. You started puncturing the support, closing below it, and that's when I smelled trouble, right? So support and resistance is quite amazing as an indicator. Now, if you look at how it's automatically doing this for you, it's such a fantastic study, because now what I'm also going to combine is the green and the saffron line. The green line is what we call a trend flare baseline. Now, this is the next study I'm going to be talking to you about. But just to jump the gun here, the trend flare baseline is the green line, and then you have a saffron line, which is the trend flare slow. So I've got two versions of it. It's more like another confirmation that you've broken out of trends. Think of this as, you're not just crossing resistance, you are above both baselines. In other words, baselines are like, you could say, a boundary wall of bullish and bearish, right? So over here, for example, you've got into a sell where you haven't crossed the resistance, but you broke the support, but you haven't really broken both the baseline. So you're not talking about a major tectonic shift as yet. So once you clear out both the levels, so here you have a resistance. Had I crossed this resistance and I would have crossed both the baselines, I would be really confident, like here. Okay. So let's look at some more up to date. I mean, this is absolutely not today's data. Again, let me remind you, but probably till yesterday or day before, whenever I built these slides in. So look at this point on the NASDAQ 100 index, the very volatile. Some of you traded through the QQQ symbol, but here I'm just looking at the NASDAQ 100. So here's where the resistance came, crossed that level, and that was around 24,750-ish. So as you went to 24,800, you really cleared the baseline, which is green. You crossed resistance. You further crossed 24,900 to enter a zone where you're above both baseline, and boom, you saw that nice follow through. Similarly, if you look at what happened just last week, we were at support level here. We broke the support. In other words, we closed below it and we punctured both baselines. We came below both green and what happens? You go, flash crash. Look at over here. You've got a situation where you got two blues. In other words, you got two areas where you crossed what we call resistances. However, didn't really follow through both baselines, right? One crossed one, but couldn't really follow through. And the minute you see it breaking, so you'll never have 100% perfection, obviously, in any study. But when you can see that, okay, even if I bought over here and I couldn't follow through, the minute I broke support, I need to get on the short side of things, because when I break support, not only have I closed below the support, I've also punctured both baselines. And this is as simple as a 5-minute intraday chart. So imagine you could be day trading using something so powerful. Let's look at a daily chart. For those of you on the end of the day, you might like a daily chart. This is Apple. And when you look at Apple on a daily chart, and this is as up to date as yesterday, I reckon, you will see that the first time we really crossed, look over here, resistance, 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 resistance. Okay, this entire phase, March, April, May, June 2025, here, resistance, 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 not able to get past it. Here, finally, not only do you get past the resistance, you're above both baselines and you've held this support, right? In other words, this is a beautiful breakout at that 220 mark, and now you flipped off to 275-ish. So that's a nice, fantastic move, and you can look at the clarity of trend that comes in. Similarly, if you're trading the short side, friends, you close below a support. Look at what happened in February and March. You close below that support level, you're below both the baseline. What happens? You get that huge, quick move. And that's not small. That's a $220 move down to 175-ish. Right? So they're fairly big moves that you're seeing once you can clear support and resistance. And again, these are not manufactured charts. Real charts, real data, absolutely, you know, the signals which come. Mind you, these signals do not change. I've seen a lot of algorithms and systems and add-ons which often change their signals a little later on. Mind you, none of our studies, none of the ATM studies go and backtrack or switch up signals. So whilst they are optimized, they work to a concept where they never change. So once a signal is displayed, it's locked in, right? You'll see that for the rest of time. Now, let's look at some more data. And let's again look at a 5-minute chart. And I'm just showing you the last 2 trading days on what we call the Indian Nifty. Think of it as our NASDAQ in India. And when you look at what happens here, very similar. We broke the supports. You see the supports. See, first sign, don't cross resistance. Right? That's the problem. You didn't cross that blue zone. Broke the supports. Punctured both the baselines. Boom. Crossed the resistance. Right? This happened yesterday, or rather actually today, where we crossed the resistance, broke through both the baselines, and we had this nice follow through up. So very interesting how simple concepts of support and resistance. Mind you, this is no RMO. This is part of the ATM suite and part of the process of automating support and resistance. So these are fantastic studies. They are put across very simply because, as I said, the name is automated trend modules. They're put across to you in a very visual approach so that it's more actionable and implementable, right? It doesn't want you to be the analyst. My goal is I want you to be the trader. I want you to focus on money management, taking the trade. The analysis piece is going to largely be done by the ATM. So if you look at Forex instruments, so the whole idea of showing you so many examples today is I've shown you gold, I've shown you the euro, I've shown you the Indian market, I've shown you the NASDAQ 100, is you can understand even the current scenario, which has been extremely volatile, this has been able to survive a lot of this fluctuation, right? Mind you, these supports and resistances are beautiful pieces to understand because you can see it all starts when a resistance does not cross, a support breaks, breaches both the lines, right? You have the crash. Then comes when the resistance crosses, notice the support holds, resistance, like a painting. It just gets past it, crosses both the baselines, the saffron and the green line, and you have that follow through. Mind you, these supports that come up, you could, upgrade your stops to these levels. But here, this is another resistance, goes through, you see further follow through on it, right? So just to further explain to you what is the trend flare suite. So one is the support resistance tool, which I talked about. Let me now bring into you the slightly more elevated trend flare suite. So I talked to you about two things as of now. Well, actually three. I first gave you a basic overview of the inbuilt RMO. Second, I moved to the super filter and showed you how significantly superior it is to the inbuilt RMO because it's self-adjusting and optimized for the symbol you're trading. So that's where you have the four bar colors: orange, light blue, dark blue, red. So super filter is one model of the ATM. The second model I showed you was automated support and resistance, a very recent addition we added into the RMO ATM suite, and it's a fantastic tool, probably one of my absolute favorites. And mind you, we are not a company, and I'm not a person who'd like to add studies just for the heck of it. I'm not somebody that has to come out with a phone every year or a new upgrade every year just to change a model number. What I'm chasing is, if I've upgraded from version 2 to 3 or 3 to 4, there has to be something that meaningful that it actually adds value and probably adds more superiority what was already existing. So for me, it's a very passionate uh, element of adding a study. It's not just about throwing something in to pump up a version number. And again, I speak to you, as you can see, as a trader to a trader, an investor to an investor. This is something I do with my own money. I am not somebody who's trying to give you an advisory service here. I'm not somebody that's going to try and sell you an educational course. I'm just trying to share tools that I use and tools that you can use, courtesy the power of Metastock. And I think with each year, you've seen not just Metastock get elevated. Fortunately, with every elevation of Metastock, it is of explorers. You have a greater depth of the expert advisor, where automation is getting to a point where you actually think that you need to work more extensively on your trading skills and money management and less on the analytics. And I keep saying this because a lot of times people are still trying to figure out what's the right moving average to use, what's the right indicator to use, what's the right time frame to trade. Let's walk out, let's kind of move to the next step. That's what I'm trying to signal to you here. So let's look at what is the trend flare template telling me. Now, there are a lot of things on this chart. Don't worry. We need to first understand the simplest piece, which is the green baseline. So this green line that you see on the chart is my dissection of positive and negative territories. Now, mind you, I have two versions. As I told you, I have a slow version and a normal. What I'm showing you is the normal or the original version. I'm not showing you the slow one. Why do I have a slow one? Because there are some traders who do not want high frequency or uh, you know uh, trades, or they want to have a pace which is definitely not just slower but also lesser in terms of signaling. So I kept both, keeping in mind that not every trader is the same. Well, some of us crave for a lot more trading in signals, but some of us do crave for lesser trades, but maybe a more stable count on it, but yet do not mind taking a trade a little later yet safer, right? I think you know where I'm coming from. So someone who's more in the active trader bracket, he's obviously going to use the normal or original, which is what I originally designed and tested it with. So that's what I recommend using. And the slow one is of course for those who want to. But one of the places where I do use both the baselines, as I showed you prior in the support resistance template, I like to put in both the baselines, slow and normal, and that gives me a great confirmation too that I'm breaking out a resistance or a support and punching out both the baselines, right? So that really gives me a sense. So baseline is the easy part. Now, why is it called flares? Why is it called trend flare? Now, if you look at over here, we've got these little flares going up and down, the orange flare going up and down, right? So a flare down obviously signals a negative signal, which is also marked in the form of a diamond. So if you're someone that doesn't like to study the indicator and prefers the actual marking on the chart, look at the diamonds. The orange diamonds indicate flare downs. Similarly, the blue diamonds indicate flare ups. I also, in my language, call it as SS plus. That's sweet spot, right? SS plus is a positive sweet spot. In other words, a flare up. Similarly, I could also call them SS minus or sweet spot negative, right? So in other words, if I'm trying to short the market, those are negative sweet spots. Now, what I should further understand is if I have a positive sweet spot which is punching out a baseline, that is fantastic. If I have a positive sweet spot that's above the baseline, that's great. Similarly, if I have a negative sweet spot over here, if I break the low of that and I can see that the baseline is also getting challenged, that's a fantastic signal. But I want to be a little careful if I'm getting a sweet spot over here, for example, right? I got to look at different elements here because I'm getting a flare down, but the texture or the baseline is not really breaking, right? So you may say that, look, I really want to look for these sweet spots where maybe I'm coming close to baseline breach, right? Let's give you again a more current. I showed you that 5-minute chart on the NASDAQ 100. Here's another example, a 10-minute one. I mean, more to give you a flavor because look, not everyone in this room necessarily trades a 5-minute. I'm sure some of you trade the daily, some of you trade the 10, some of you trade the 30. And again, what I'd kind of tell you is me as an educator or someone trying to help you understand the program will show you a whole set of different time frames so that you get a better understanding. However, don't think that you should keep switching time frames. Try and focus and work with a few fixed symbols, fixed time frames. Don't keep twitching the time frame around. Otherwise, you'll never know you're 7 out of 10 correct. So here you have trend flare, which is on the 10-minute chart. You can see these are the two recent buys that came in, which was again earlier on last week, and that's moved to a good up move. And if you look at the sells that came in, it's all started over here where you have the trend flare down, and you can see the green line got punctured, right? So if you look, you're a fast, sharp trader. You got trend flare up. You've gone through. You got to follow through, and then you got the first warning here, flare down. But as soon as you breach the baseline, there's a problem, and that's when you can see the whole drop comes in. Another example, XAU this time. Earlier I showed you a 2-hour chart. I've now moved it to a 4-hour chart, assuming you may be a trader that wants more stability. And mind you, why am I using a 4-hour chart? As you all know, the XAU does trade around the clock. So you may want to look at a higher interval for your own protection. And you can understand over here that this is where XAU moved into a trend flare down. So you can see that little flare down or the triangle over there. So you can say that, look, how many systems do I use? Should I use the super filter, which you talked about? Should I use the trend flare? Should I use the support resistance model? Well, each one is doing a different thing, right? I don't need you to necessarily combine everything. But mind you, what am I talking about? The whole ATM suite is about giving you 7 or 8 different templates. And, it's good enough if you just use 2 or 3, right? You don't have to use everything. The whole idea is to use, any of these studies in a more solid manner, a more consistent manner, in a more automated manner so that we remove the room for a lot of manual analysis, right? So if you can see over here that on the bottom we even have the axis marked out as a a green zone or an orange zone, which is based on the baseline. So if the prices are trading above the baseline, you see it green, and if it's below the baseline, it's orange. Mind you, all of these studies come with inbuilt explanations. There's a manual which explains all these rules. In fact, I have to admit that this is actually an extract from the manual. I've just copy pasted a chart from the manual. So you will have a lot of this information well explained there. There are webinars to back it up. And plus, we at Veritech are there to help you not just install the product, but to help you understand the indicators. And the beauty is that Veritech, being based in India, literally helps you round the clock, because if you're US timings, you've got the Metastock office to help you. If you're off hours, we're there to help you as well. So works in great synergy in your advantage. Now let's look at a final thought process. We even have scanners. We even have a beta of what we call a power screener, where we can help you get a tabular format and give you signals where you have an upshift, downshift, sweet spot. All of those elements can be brought to you. I'm kind of out of time, so what I'm going to do is, since we have just about 10 minutes, I'm going to hand it over to Jeff and open it up for questions. And he can also share with you elements like pricing or an offer that you could sign up with. And let's take up any of your doubts, because otherwise what will happen is if I move to the next indicator, we will not be able to finish on time, and I don't want to be the spoil sport that ruins the rhythm of the day. So thank you, folks. I'm going to hand it over to Jeff for questions.
All right. I don't have a lot of questions, Rahul, but I have some comments.
Great.
Kumar says that was a very good suggestion. I'm not sure what he was talking about or when he said it exactly, but he said it about something you said. So, Sharinjit says,
That's good. Yeah.
He says, I'm from CS Basin in India. Good to have you here. And that's it. So I can. What I want to do is actually kind of come in and talk a little bit about the offer and what's in there.
Right.
Do you mind?
Absolutely. Take over.
All right. Let me go ahead and do this. I'll share my screen. All right. Here's a picture of the box. You can always tell when one of our products has been very, very well liked if it's on version 2 or 3. The RMO's on it version 4. People love it. As I had said a little bit earlier, the RMO is one of the very first systems that I've built, or that I've traded. I didn't build it. Sorry, Rahul, I'm not going to take ownership of your product. But it's one of the first ones I've traded with money. And over the years, to see RMO kind of grow and kind of the methods and the kind of the creativity that Rahul has bring to his systems has just been amazing. So let's talk a little bit about what's actually in there. This is not a methodology that you're just going to buy and you're going to have one version of one thing. There's methodologies in here for breakouts, strength and weakness. There's his super filter, the trend decider suite, RMO 2, the counter trend indicator, a trend flare suite, and automatic support and resistance. All those are just kind of built into Metastock. They're ready to go. And so it's a very, very complete arsenal, if you would, of tools that kind of allow you to do it. I have a little bit of a breakdown of the different tools. Here's a little bit of the breakdown. There's the strength and weakness. The strength and weakness looks at volume at its core ingredients and measures trend strength on a time frame that you give it. Excellent gauge of strength in there. There's a super filter. There's also the trend decider suite, the RMO 2. There's just a wealth of systems that are in here that are part of it. If you're interested in counter trend and counter trend methodologies, there's a very, very well thought out counter trend. And then the ones that he added new to RMO 4, so those have been there for a little bit. For 4, he added the trend flare suite and then the automatic support and resistance. It'll help you find support and resistance breakouts and that kind of stuff. So all of these are included as part of the RMO ATM 4. There's a complete list again. I won't read it twice. But all of those have their own explorations. You can run scans for them. They've got their own expert advisors. So you can get buy and sell recommendations. You can get commentary. All of those are included. They've got a full built. They've got their own templates. They're fully built to kind of support the core Metastock power tools. So normally, the ATM methodologies are $149 a month. If you go up to the website, that's what you pay. You'll just pay $149, and then you'll be able to get those. What we're doing as part of the conference promotion is, if you want to try them, we're going to give you a permanent discount of that $149, and it'll be $129. So it's a little bit part of a bigger package that we're offering. One of the things that we did, obviously with Rahul, a lot and all the methodologies, it's really important to understand kind of how to get involved or how to work through all of this. So over the course of a couple sessions, over a couple weekends, Rahul and I sat down and we were actually recorded some methodologies that are he recorded a bunch of training on how to use ATM4, the trend flare strategies, trade management, refining the trades that you're looking at, the ATM trend decider suite, the filtration approach. These are very, very thorough sessions that Rahul did. The second session, it was more about trade detection and integration. You can kind of read the bullets here. These classes were somewhere just over an hour long when we recorded them, and they're available instantly as soon as you subscribe. So with the subscriptions, when you subscribe to them, there's no obligation to keep them. If they're helpful for you, we want them to be helpful for you. So what we're doing today is the normal price for the training, that training session, is about $886. We're going to slash the price down to that, where if you actually do the $499, that'll include 3 months of the RMO ATM. It'll also include that masterclass. So for this, just $499, $500 today, what you're going to get is you're going to get 3 months of that ATM. You're going to get the masterclass. And then if it's something that you like, you can keep using it. People have been using the ATM for it's one of our most successful, most well-liked subscription add-ons. So you can pick it up if you go to 800, or if you want, you can give us a call, 800-882-3040. Go to metastock.com/conf promo. And if you have any questions, if you want to see some charts, if you want some more information, feel free to get in touch with us at metastock.com/sales trend. Just looking over here to see if I have any other questions. I don't. Let me check the YouTube real quick. I don't want to kind of leave anybody hanging. Okay, yeah, Amit, I'm glad I checked the YouTube comments. Wants to know if the trend flare system can be used for option trading in the Nifty options. Rahul, are you still here?
Absolutely.
Okay, so I'll let you take that question. Did you hear it?
Yeah. So the Nifty options are a great segment to be trading from an India perspective. Very, very liquid, in fact. So yes, to answer you categorically, you can absolutely trade using some of the ATM systems. Just to give you a heads up, we do have a study called the RMO 2 system, which I didn't run by today, but that is definitely something you want to look at if you trade options as well, in addition to what we did today. So, which chart to use, that's a common question I get when you trade options. I would try and look at the Nifty spot chart, or what we call the cash symbol, because if you look at the futures charts, you don't have a lot of historical data. Sometimes there are a lot of gaps because months are rolling over. So try and focus on the cash chart. Or if you're a very short-term trader, you could actually look at the options strike that you are trading. You could look at that individual chart as well. So try and pick between the two. So if you're a very short-term 1 or 2 or 3 day type trader, go into the exact strike price of the option that you're trading, the exact contract that you're trading. But if you're someone who's doing options, let's say for a couple of days, a week, 2-3 weeks, you definitely want to keep cash as the focus chart. And not just today's studies, but probably chip on the RMO 2 template as well.
Which I pulled the slide up for it since you started talking about it.
Oh, thank you. That was efficient.
Yeah. It says an option trader's go-to study. So there you go. Not very good. Let me go ahead and kind of go back in here. Rahul, thanks a lot. I appreciate you.
Thank you, Jeff.
All the work you've done with us over the
Thank
years.
you, everybody, for being here.
All right. Cool. So again, to get that, what you want to do, actually, let me put right here. You get a training, you get the classes, you get 3 months of access, no commitment to keep it, but you're going to want it. It's only $499. And you can do that 800-882-3040, metastock.com/conf promo, or metastock.com/sales chat. Again, big thanks to all of our speakers, Rahul as well. Nice having everybody here at the event and all of the great stuff. I've learned a few things already. I hope you have as well. As we move into our next speaker, I do want to mention the Traders Forum first. One of our sponsors. Actually, I think I'll do Traders Forum in a minute. I think I forgot to talk about stocks and commodities. I think it's their turn. So I do want to talk just a little bit about Stocks and Commodities Magazine. Stocks and Commodities Magazine has been an ardent supporter of the fora, the classes that we do, the online sessions that we do. They've supported them. They've sponsored them almost since we've started them about 15 years ago, these big online events. So really appreciate the work that they've done. If you're a trader, and one thing that I know is important to you because you're here, is just keeping moving in terms of the industry knowledge, in terms of what you're learning about it. And I personally think that when you're doing something, anything in life, you're either getting better or you're getting worse, And one of the things I like about Stocks and Commodities magazine, John Bollinger was here yesterday, and he said he had every single issue, and I had a little bit of an envy. But I have about 27 years worth of issues, and I just love getting the magazine in the mail, being able to kind of see what people are thinking, what the articles are, all that kind of stuff is really, really cool. If you decide to get a Stocks and Commodities magazine subscription, not only do you get the current articles, and if you're in the US, it's still a physical magazine. It's mailed to you every month. But you also get 17,000 articles in a searchable archive. So great magazine, great way to kind of make sure that you're staying on top of everything. They've been publishing it since 1982. And a big heartfelt thanks for the support they've done for the conference over the years. You can find out more about Stocks and Commodities at traders.com. So as we kind of get it ready for our next speaker, we are going to give away another prize. Greg Lewis, I hope you're ready. Because it's prize.
I am.
All right. We're going to give away
another. It's amazing. I don't know why that keeps on coming in so dark, but I guess it doesn't really matter. You don't need to see me. I'm amazed that there's still a magazine you can buy and order online and have a physical magazine show up at your door.
Yeah, there are definitely things that are going away. There's the lights. It's nice that you got out of the dark.
It doesn't matter, but there's some little additional app on this camera that I have to open for it to work and blah, blah, blah.
All right, let's give away this book. This is Steve Bigelow again, a huge friend of Metastock, somebody that we worked with helped me literally as a trader as I was learning and kind of learning the ropes. A lot of the lessons I learned were from Steve. Steve has a special place in our hearts. Great business partner, great guy, great at jokes, even better than you, Greg. I'm sorry.
Oh, I will ask Steve. Well, at least for dad jokes, he was definitely, although some of them were inappropriate for dad. They were great jokes, I gotta say.
Yeah, for sure. I want to, maybe I'll do this over the holidays, but I just want to put together a little bit of a reel that just kind of has his jokes in it. I think that would be fun.
That would be awesome.
We could put that up on our YouTube channel. It would get tons of views. Anyway. Yeah. The Candle Prophets, Eliminating Emotions is a great book. We're going to give a copy of this away. If you're watching in GoToWebinar, great. You're already registered. You're on my list. If you're watching us on YouTube, what you want to do is like and subscribe because I hear that's good karma. But when you're done doing that, there's a pinned link at the top of the chat. And if you just click on that, you can register for the event, which means you'll be registered to be in a drawing. So, Greg, what I need from you is a number and oh shoot. Okay.
Between 1 and 5,599.
Correct. Although, I'm getting a pop-up in my system tray from Samsung. But yeah, 5,599.
Computer pops up or something I found you rarely need to actually worry about.
Well, I could miss a very important special from Samsung.
So it is Black Friday's right around the corner. Hey, Black Friday's right around the corner. Wink, wink, hint, hint. Okay. The number between 1 and 5,599 is 2,968.
And that is Scott D with a looks like LSTCAPT as the start of his email. So if that sounds like you, Scott, and you just want a prize, you don't have to be present to win. You just have to register to win. But if that's you and you are here and you're watching live, let us know in the chat. We would love to congratulate you for the win. So anyway, I will take probably not this copy, but I will take this to the mail or a copy of this to the mail for you and send it off next week. Greg, thank you for the assist.
Mm-hmm.
All right. Our next speaker is Jeff Tompkins. Jeff has a great first name. But in addition to that, we have a lot of history with Jeff. He's been working with us, I believe it's 7 years now. When he started working, he's just kind of blown up. When he started working with us, he had taught a lot of people how to trade through a website called Udemy.com, which specializes in teaching people about just about anything. over the years that we've known him, he's developed the trade trend strategy, another strategy called the price action pivots. And in addition to that, he's opened his own hedge fund, and he's an awesome all-around guy as well. So I like Jeff because when he talks, I have an ability to understand what he's saying. He lays it out in a way that makes sense to me. And so let's go ahead and get him started. Jeff, how are you doing today?
I'm well, Jeff. How are you?
Good. Oh, I forget. I don't have to make you the presenter anymore. You can just start sharing your screen.
Yeah. I'm trying to get used to this new format, but I kind of like it.
Yeah.
Let's
They
see.
tried to make it look like Zoom. Is really what they did.
Yeah, I realized that. It kind of looks like Zoom.
All
Well,
right. Cool.
I learned something new today. I'm older than Stocks and Commodities magazine.
Really? Huh.
Yeah, I am older than the magazine.
Me too, actually. I said that,
But
and then I remembered it was started in 1982, so that makes me almost a decade older than the magazine.
yeah, there you go. There you go. Well,
All right.
interestingly, one of the indicators we're going to talk about today was featured in Stocks and Commodities magazine. I think it might have been the June or July issue of last year. I can't remember if it was last year or the year prior. So yeah, well, got a lot of great things to cover today. So I'm going to go ahead and dive in. We're going to be
Right.
looking at two simple indicators to accurately and consistently forecast market direction. So before I get started, I'll just cover a quick disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options. And of course, must meet suitability requirements. Past results are not necessarily indicative of future performance. I am going to be sharing some real world, real money results with you, and as well as some hypothetical results. But just know that anything I share due to the time critical nature of trading, brokerage fees, activity of other traders, we don't guarantee anyone will mirror that performance. All right, so I'll just give you a brief background on myself, and then we'll get into the good stuff. I have over 2 decades of experience trading the stock options and futures markets. Received my professional training as an intern at the trade desk at Morgan Stanley back in the early 2000s, and we're actually right up at our 10-year anniversary. So a decade ago, I founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. And as Jeff mentioned, I'm also a hedge fund manager, so I manage money for my clients at Altos Capital. And in fact, the methodology that I'm going to share on the session today, as well as the many of the tools and indicators that we're going to be looking at, I utilize inside my hedge fund. So this is kind of a unique opportunity to get some insight into the operations of a hedge fund manager. And as Jeff mentioned, I'm also the founder and creator of the Trade Trend Signal software, which we're going to be looking at today as well. So let's talk about some of the difficulties that we encounter as traders and investors. And there are a host of challenges that we face, but a lot of it can be boiled down to psychology. Interestingly now, algos are dominating the market, right? A lot of trading decisions are algorithmic, but nevertheless, there's still some psychological component involved because there are people developing and controlling the algos. There's still the risk management, capital allocation decisions that we have to make, and that's really where the psychology comes in. But this is a really, I think, interesting and accurate kind of curve that shows the psychological process that we go through when we interact with the markets, when we place trades and make investments. So I'm going to walk you through this because, again, we're all vulnerable to it. Even if we're using a very strict system and we're adhering to that system, this relates to the markets. So what typically happens is when we get into a trade or an investment, right, we have some degree of optimism, enthusiasm, even exuberance and euphoria. Obviously, we wouldn't get into the trade otherwise, but we typically will encounter this when there's a high level of financial risk in the markets. And of course, we know that markets don't go in a straight line. There's, of course, volatility and, trend reversals and all these things that we encounter when we get into a directional trade. So we've all experienced it at any point in time, right? A trade can move against you, the markets could sell off, there could be a black swan event, and that exuberance and euphoria can quickly transition to anxiety, denial, fear, even despair. But interestingly, this can be the best time to trade and invest, right? And so that when we get capitulation in the markets, that discouragement and dismay can then transition into renewed hope, relief, and even optimism. And so this cycle just repeats itself over and over again. Okay. And so there's some challenges around this psychology of failure, because anytime we enter a directional trade, our goal is to, of course, buy low and sell high, but that actually goes against our human instinct. Okay, so instead, when a security's gone down, we tend to sell it. So this is why we see panic selling in markets when the markets sell off. And then when it's already gone up, we tend to buy it because we have a fear of missing out mentality. Okay, so it's a FOMO mentality. And to compound that problem, we're wired to repeatedly make the same mistake. Okay, so we'll buy high and sell low because that's what our emotions tell us to do. And we're often behind the curve, right? So without a solid trading plan, we're vulnerable to our emotions. And in addition to that, if you lack a strategy that can identify momentum shifts, which means that you don't know when to get in or buy low and get out and sell high, this can pose a major problem for inexperienced traders and investors, and even experienced traders and investors face this problem. So we're going to turn the tables on our session today. And it's that great Warren Buffett adage, be fearful when others are greedy. And this is what we call a contrarian approach. So instead of getting into, like a bullish directional trade when there's a high level of financial risk and panic selling when the markets are selling off, right? We're going to flip this around. And I'm going to teach you how to use a contrarian approach. And we're going to be looking at taking profits and getting out of the market when there's a high level of financial risk, or even initiating speculative bearish positions, okay, when other retail traders are panic selling and losing money, okay? And then that creates a huge opportunity for us, okay? So when other traders are losing money, there's an opportunity to come in and buy, and that's really the best time to trade and invest. Okay, so kind of take a mental snapshot of this psychological curve, because it's going to tie into what we're going to now dive into. So what I'm going to give you today on the session to make this all easier is you're going to discover my slingshot setup. It's worked 100% of the time on the major indices. So if you apply this to the S&P, the NASDAQ, any of the major index products, you go all the way back to the dawn of the stock market. And we'll look at some recent examples. And this year was a great one. We had the tariff crash. Okay, if you apply this slingshot setup, okay, it plays out 100% of the time with absolute certainty. So there's no doubt, okay, that we'll know when markets are vulnerable to a sell-off and when they're likely to rebound. So I'll show you how to identify the setup, how to trade the setup, how to profit from the setup, how to get in near the bottom and out near the top. And we can get remarkably close. Of course, we're not going to pick an exact bottom or top to the penny, but we can get remarkably close. I'll show you how to apply the setup to any market in any time frame. I'll show you a really simple but highly effective trick to eliminate a lot of losing trades. Okay, this is just a simple technique that will keep you out of the market when conditions are not favorable and keep you out of what would otherwise probably be a losing trade. Okay, we'll look at some trade examples together, and then stick with me to the end. I'll show you how I can copy my success and get my trade signals that I use to make a living in the markets. All right, so let's start out by imagining if we could buy low and sell high without using any guesswork. Okay, all too often we use some degree of guesswork or intuition in our trading decisions, and this is where that psychological component can come into play, right? So if we don't have a really solid plan in place, or we don't know with absolute certainty where we would get into or out of the market, right, then we start to second guess ourselves. We start to, get FOMO mentality. All these things start to come into play. Now, there's one volatility study that's made this possible since the beginning of the markets, and it's a unique setup that, again, I call the slingshot, that's allowed traders to buy low and sell high with 100% accuracy. So again, if you apply this to the major index products, the S&Ps, the NASDAQ, okay, the Russell even, okay, this is going to tell us where the market's likely to sell off, okay, and when it's likely to rebound, okay. And again, once you have all the knowledge following our session today, I'll challenge you to pull up a chart, go back as far as you can on that chart, pull up a chart of the S&Ps or the NASDAQ, and you'll see this plays out with 100% accuracy. So it also warns us of potential market sell-offs. Okay, and again, we'll look at some charts and some recent examples, but just imagine if you could remove that fear, from your psychological, the psychological component of your trading decisions, right? It immediately can improve your confidence and your consistency if you just know when the market is likely to sell off. Now, once these bands of the market can't be stretched any further, they have to bounce back. Okay, this is an inevitability in markets, and we wouldn't have trends, and markets wouldn't, make directional moves if this didn't work. Okay, so I call it a rubber band effect, and it makes it possible to accurately identify tops and bottoms in the market. So we're just going to look at a basic candlestick chart to start out. Okay, this is from a prior year, back in 2020. So when I demonstrate the slingshot strategy, I like to use some of the worst market conditions that we can find. This is a daily chart of the S&P 500 index, okay, the SPX. And for now, I'm just going to point out a couple things, okay? So back at this point in time, okay, the S&Ps were hitting new all-time highs. Now, as we walk through this, again, keep that psychological curve that we looked at in mind, okay? Because we're looking to approach this from a contrarian perspective. So when markets are hitting new all-time highs, okay, most of the retail trading crowd is buying in. Okay, maybe they missed out on the previous run up in markets. Maybe they have open long positions on, but they're uncertain whether to take profits. They have FOMO mentality of missing out on further upside in the market. All these things start to come into play. But as a slingshot trader, you're actually going to know that this is probably the best time to sell. Okay. Now, we know what happened back in the COVID crash of 2020, right? S&Ps sold off to the magnitude of 30%, plus in just a matter of a few weeks. So we have this major market sell-off. S&Ps were previously up around the 3,400 handle, and again, by around the third week of March, we're down around the 2,200 handle. Okay, so we have this major sell-off of over 1,000 points in the S&Ps, but that creates opportunity, right? And traders obviously came in and bought down around that 2,200 handle and drove the S&Ps back up to where that sell-off initially ensued. Okay, now this is where we want to look at buying or selling and booking profits. Okay, so during that sell-off, right, we have the bulk of the retail trading crowd experiencing heavy losses. Okay, but again, that creates opportunity, and we're going to come back to this chart and apply the slingshot to this chart. But interestingly, okay, if we consider the catalyst that caused all of this, okay, COVID, by June of 2020, we didn't have any real resolution to this catalyst. There weren't, viable treatment options, vaccines, and unfortunately, the pandemic had gone on to get much, much worse. Okay, yet the markets recovered as if that was not the case. Okay, so we commonly see this. We're seeing it right now with tariffs, right? We had the tariff crash this year. Maybe you could argue that there's been some resolutions, but there's still a lot of unanswered questions, and we really don't know what the long-term impact is going to be to inflation and other macroeconomic factors. So, but yet markets are continuing to put in new all-time highs. Okay, so this is just how markets work. Okay, so we're going to come back to this chart. By the end of our session, you're going to discover one trade setup that's never failed going back to the beginning of the stock market. Again, you can go back all the way to the dawn of the stock market. It's so reliable, it's worked 100% of the time on the major indices. It hasn't failed once, including the Corona crash, including the 2022 bear market, including the recent tariff crash. It happens with repeatedly with astounding predictability. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets, especially as markets become more volatile, more erratic, and we have some major macroeconomic factors that at any point in time can derail the market. So you're going to discover why volatility is one of the only leading indicators of market direction, how to identify when markets may be vulnerable to a sell-off. Again, this removes that fear component from the psychological curve we looked at. This can completely turn your trading around. It can improve your confidence and remove the guesswork, right? How to identify when the market is likely to go up, okay, after there's been a market sell-off. How to determine exactly how far the market is likely to go up. This solves what I call the trader's dilemma, right? You get into, let's say, a successful long trade, it's going in your favor, but you're then uncertain when to get out, when to take profits, right? We're going to solve that problem with the slingshot. How to get your hands on a tool that will change your trading forever. And this is a bold claim, but one that I make because it's this tool has changed my trading forever. Okay, and I'm going to share that with you on the session. So let's start out by imagining a slingshot. Why do we call this the slingshot strategy? Well, as we pull a slingshot back, muscle energy is transferred to elastic energy in the bands of the slingshot. Now, after the slingshot's released, the elastic energy is transferred to the stone as energy of motion. That's what's referred to in physics as kinetic energy. I'm not a physicist. I have physicist envy. I love physics, but that's about as much as I know. But the important thing is kinetic energy actually kind of plays out in financial markets in the form of supply and demand, right? So when we get demand after there's been a significant market sell-off, right, that creates demand and there's buying pressure. Okay, so once the band becomes overstretched, it gives us a buy signal, and we can enter the market with high confidence that prices will go up to the initial resting point of the band. Okay. Now we're going to apply this slingshot effect to the markets using a volatility study. Now there are different types of volatility, namely historical volatility and implied volatility. So historical volatility looking at past, and implied volatility projecting into the future. And we're mainly concerned with implied volatility, which is a forward-looking predictive indicator. Now we're going to use volatility bands, which will tell us when the price has moved too far from that mean or the average and is likely to reverse direction. Okay, and the study we're going to use is Bollinger Bands. Okay, and I heard Jeff say I think John Bollinger was on the summit yesterday, but great indicator. It's available on virtually any retail trading or charting platform. You can find it right in your Metastock platform, and it can help us pinpoint turning points in a security with astounding accuracy. So like any other indicator, there's all kinds of ways you can use it. Okay, we're going to look at a unique way, which is a way I don't even think John Bollinger designed the bands to be used, but it's a unique way that is not commonly used amongst the retail trading crowd. Okay, so for right now, I just want you to visualize a couple things, and then we're going to get into the rules. So we have this chart. Doesn't matter what it is. It could be, just call it ABC stock, okay? And we notice a couple things here. So we see price rotating lower and breaching the lower band. And by the way, if you're not familiar with the Bollinger Bands, I'll give you a high-level overview of what they are. But for now, I just want you to visualize. Okay, so we're breaching the lower band. Okay, and then we see there's a sell-off. Okay, now at some point, remember that kinetic energy. Okay, buyers come in, they see an opportunity, and they drive price right back up. So whatever this asset is, ABC stock, catches a bid, reverses trend, and returns right back up to that price level where that sell-off initially ensued. Okay, so kind of take a mental snapshot of this. This is the slingshot setup. Okay, so we're going to start to dive a little bit deeper. I'll give you just a brief high-level overview of the Bollinger Bands if you're not familiar with them. They consist of 3 lines on your chart. So we take a simple moving average of the security's price. Okay, that's going to be the center band that you see on your chart. We then take the standard deviation of the security's price. Now, standard deviation is just a mathematical measurement of average variance. Okay, but the important thing to know is that it measures how spread out numbers are from an average value. We won't go into the calculations of it, and you don't need to calculate it because the indicator does it for you. But what's important to know and understand for background knowledge is that because standard deviation is a measure of volatility, when the market becomes more volatile, we see the bands widen. And when the market's less volatile, the bands contract. Okay, so keep that in mind. That's really all you need to know for the slingshot. Okay, wide bands, we're in more volatile market conditions. Narrow bands, we're in volatility contraction or low volatility. Okay, now as far as settings, most platforms will default to a 20-period SMA or simple moving average. That's again the center band, and then 2 standard deviations from the mean. Those are the outer bands. I'll refer to them as either the outer bands or the upper and lower band. Okay, so this is what it will default to in the Metastock platform. You don't need to change those. You don't need to change them for time frame. You You don't need to change them for asset. Okay, it's just same settings across the board. Okay, now how do we use these to buy low and sell high? It's actually very simple. Okay, so I'm going to walk you through the rules using a very basic technical analysis tool. Okay, and we won't go into all the background of how, when these were developed and why. But John Bollinger, of course, developed them for a specific reason, and that mainly was to identify whether an asset was oversold or overbought. Okay, but we're going to use them a bit differently, okay, in a unique way, and this is where the slingshot comes in. Okay, so as we'll look at on some charts here momentarily, okay, price can exceed or hug a band envelope for prolonged periods during strong trends. Okay, and what we're going to do is wait for the lower band to break, and I'll explain what that means. And then we're going to wait for a buy signal. Okay, and then we're going to exit when price returns to the breaking point. Okay, it's that simple. Okay, and it, as I mentioned, occurs with astounding predictability. So if we apply this to the major market indices, they've all returned to the initial volatility breakout with 100% accuracy. So that includes the bear market of 2022, the flash crash of 2015, the flash crash of 2010, the crash following the 2008 mortgage crisis when markets lost over half their value in the second half of the year, the 2000 dot-com bubble, the Corona crash, every black swan event, market correction, major crash, bear market, you name it. This plays out in the way that I'll demonstrate. So we're going to look at charts of each of these scenarios. Let's start with the 2020 COVID crash. Okay, so I told you we'd come back to this chart of the S&P 500 from early 2020. Okay, now we have the Bollinger Bands plotted. Now, I'm going to point a couple things out here. We'll start on the left edge of the chart. Okay, again, at this point in time, S&Ps are making new all-time highs. Now, what do we notice with the Bollinger Bands? We notice that they are relatively, the outer bands are relatively narrow. They're close together. They're parallel and horizontal. Okay. What does that mean? What is it telling us? It's telling us that we're in low vol or low volatility conditions. Okay. So now let's think back to that psychological curve. What is going on in terms of mindset amongst the retail trading crowd? Okay, probably complacency, maybe some FOMO mentality. Okay, I've missed out on this big run up in the markets. Should I jump in now? Putting in new all-time highs again. Okay, and we're kind of experiencing this now in the market, this current market environment. Okay, now what do we see happens around the third week of February? Okay, we start to see a little weakness inside the S&Ps. They start to rotate lower, and they breach that lower band. Now, this is where the slingshot starts to get pulled back. Now, there's two things I'll point out here because they're critical as it relates to the slingshot. These both have to occur for this to be a valid slingshot setup. So number one is we need a breach of the lower band. Okay, so that occurs right here. Okay, and then simultaneously, we need a divergence of the outer bands. Okay, so those are the two things that have to occur. And one other thing I'll add into that, prior to that happening, we need to have vol contraction. So we need to see either parallel or converging outer bands prior to a breach of the lower band and simultaneous divergence of the outer bands. Okay, so that's the start of the slingshot. Now, we of course know what happened, right? The S&P sell off. That creates buying opportunity. Traders come in, bid the S&Ps back up, and they return right back up to that initial volatility expansion level, right around roughly the 3,200 handle on the S&Ps at that point in time. Okay. Now, again, we know that there was no real resolution of the catalyst that caused this sell-off at that point in time, but the market doesn't care about that, right? It simply reacts. This is a perfect example of emotions taking hold in the markets. Okay. all the price action that you see in the market is simply the reaction of all market participants. It's the aggregate of all market participants' behavior, right? Buying and selling. So there's panic selling, but then that creates opportunity. Buyers come in and drive price right back up. So from a contrarian perspective, right, we want to be on the right side of the market, and we want to be either out of the market or selling, initiating short positions when there's a sell-off, when we get a breach of the lower band and simultaneous divergence of the outer bands. So we're going to now dive a little bit deeper into all the rules here, but let's look at some other charts just to kind of solidify this idea. Okay, so this is because you can apply this to anything. This is a chart of Apple, okay, a past chart. What do we see on the left half of the chart? Apple's in a strong uptrend. Okay, it's trailing the upper band until right around the middle of the chart, we get a rotation lower in Apple and a breach of the lower band. Now, prior to that, the bands are relatively parallel, right? They're moving parallel, and then Apple starts to sell off. It breaches the lower band, and what do we get? A simultaneous divergence of the outer bands. Okay, this qualifies as a slingshot setup. So the slingshot's starting to get pulled back. And for any of you who are, candlestick analysis traders, right? We actually had two bullish reversal candlesticks right at the lower band. So a common technique, and I'll go through some of the others as well, but that Bollinger Band traders use is to buy at the lower band and sell at the upper band. Okay. Well, as you can see in this chart, that doesn't necessarily work so well a lot of the time. So a lot of traders probably got trapped here. They saw two bullish reversal candles right off the lower band and thought, well, this is just a temporary downside retracement in Apple, and the uptrend is going to resume. Well, we can see that didn't happen immediately. In fact, Apple sold off from right around the 196 handle all the way down to the 168 handle. Okay, there's the sell-off. Okay, it sold off into a prior pivot. If you look at the very left edge of the chart, right around that 168 handle, into a support level, which created buying opportunity and drove the price right back up to that 196 handle, right where that initial breach occurred. Now, interestingly, notice what happened. You'll see this on other charts as we look at them. Notice what happens to the price of Apple once it returns back up to that level. See how it kind of goes sideways there for about a week? Okay, because again, we're looking at a daily chart here. Okay, this is probably profit taking. So it kind of stalls out right at that level for about a week before it goes on, and resumes its uptrend. Okay, which is, by the way, an extension of the slingshot. Okay, now let's look at another one. So this is the Qs. This is from back in 2018. Okay, so on the left edge of the chart, what do we see, right? We have a fairly weak uptrend, but we're in an uptrend, maybe a little bit more of some sideways consolidation. Okay, we're hitting that upper band. The bands are parallel and even converging a little bit. Okay, that's good. That tells us, we're in vol contraction, and we want to be, on our toes and ready in case the Qs rotate lower. And of course, they did that in early October and breached the lower band, and we get the simultaneous divergence of the outer bands. Okay, this is our warning that the Qs are likely to sell off. They're vulnerable to a sell-off at this point. So we're contrarian traders, so we want to what? If we have open long positions, we want to book profits. Okay, protect any open profits that we have, or initiate speculative bearish positions. The Qs sell off, create buying opportunity. Buyers come in, bid the price right back up to where that initial sell-off ensued. Does this work on intraday timeframes? Absolutely. It's the same idea, same methodology. All the same psychological factors are at play. So this is a 5-minute chart of advanced micro devices, AMD. Okay, what do we see on the left edge of the chart? Okay, we're in a consolidation range, right? So we're just bouncing from the upper and lower band, okay, which is again a technique that some Bollinger Band traders use, and that would have worked out probably okay for a few trades until it didn't. We start breaching the lower band. In fact, there were a couple embedded slingshots in here, right? But we had a couple breaches along the way, divergence of the outer bands, but that created buying opportunity and traders came in and bid the price right back up to where that initial volatility expansion level and started, right? Okay, so it's probably arguably the easiest component of the slingshot is identifying when the markets may be vulnerable to a sell-off, right? That's the breach of the lower band, simultaneous divergence of the outer bands, and prior convergence or parallel outer bands, okay? So the most challenging part is how to identify the buy zone, okay? If we get a market sell-off, where do we get in? And on the long side, and this is really the challenge that I had to address when I developed the slingshot strategy, right? And there's a number of ways to approach this, but that is the trick. So identify when the band is overextended and ready to snap back. So you can use, and this is what I used to do. For instance, candlestick analysis. You can use support levels. You can wait for price to rebound to a certain degree back into, occasionally I would use like a 1 standard deviation level away from the center band, the average. Okay, but I was finding that I was missing a lot of the trend by doing that, or I wasn't, the slingshot wasn't done playing out. It hadn't fully developed, and so the accuracy wasn't where I wanted it to be. Okay, so I spent well over a decade and thousands of hours trying to determine when momentum is shifting and when a new trend is starting. And once I got this formula dialed in, I then had to configure it to work on all time frames, duplicate the success across all markets, because I don't just trade one market, right? I trade, equities, ETFs, futures. And so I needed this to be adaptable and algorithmic. So I wasn't, using intuition or guesswork. And I wanted to be able to reliably predict market trends. So the result is a tool that provides accurate buy and sell signals near the outer channels of the Bollinger Bands up to 3 candles in advance of the move. Okay, and this is a very powerful algorithm that combines momentum studies, volatility studies, and price action that can accurately identify buy and sell signals at the outer bands. And it can also be used as a standalone. It doesn't have to be used with the Bollinger Bands. It can be used by itself to identify accurate buy and sell signals. And this is what's programmed into the trade trend indicator, which we've developed in partnership with Metastock. So trade trend gives us accurate buy and sell signals up to 3 candles in advance of the trend. It does so with a proprietary momentum algorithm that reads the market in real time and includes trailing stops to help lock in profits. And it can help us forecast short-term and long-term trends with astounding accuracy. Okay, this can be applied to equities, ETFs, futures, Forex, crypto, any asset class. It also includes a scanner, which will allow us to scan for buy and sell signals, again, up to 3 candles in advance of a forecasted trend on any time frame. Okay, so if you're doing this on a 5-minute chart, you have up to 15 minutes of advance notice with the exact price level that you would get in to the trade at. No guesswork involved. I love using this indicator to supercharge my directional options trades, okay, which of course are very time critical. So if I'm putting on a directional options trade, I want to have some degree of advance notice and not be using a bunch of lagging indicators, okay? Trade trend does not repaint. Okay, what that means is that once you get a confirmed signal on your chart, it's there to stay. Okay, unfortunately, there's indicators out there that do repaint and they look great in hindsight on the chart, but then when you go to use them in live market environments, they fail miserably. Okay, so trade trend does not repaint. It has built-in protection to avoid whipsaws, keep us out of the market when conditions are not favorable. It helps us capture most of the trend before it reverses. It's designed to limit losses and let profits run. It can be used with any other indicator or system for added confirmation, as we're looking at today, and applying it to the Bollinger Bands and the slingshot setup, and help us remove the guesswork from our trading. Okay. Now, I mentioned I'd give you a little trick to help eliminate losing trades. And this is actually programmed into the trade trend indicator. And it's just a very simple order type. Okay. Now, most traders, and I've actually looked at this data across some of the major, broker dealers, will use market or limit orders, and that's fine. it's not that there's something wrong with that. They might be appropriate, but that is the bulk of orders you're going to see are market or limit orders. Now, when we're placing directional trades, wouldn't it make a lot more sense to use a buy stop or sell stop order to confirm the momentum direction? So we use a buy stop to enter long trades and a sell stop to enter short trades. That can actually help filter out false signals and improve consistency and increase profitability, because it requires the asset to make a directional move in the direction that we are forecasting. So if we're looking to go long, if we think, ABC stock is going to go up, if we jump in right then and there with a market or limit order, okay, and we're wrong, okay, and the market instead goes down, we're in a losing trade immediately off the bat. Okay, whereas if we use a buy stop order, we place that just above the current, mark price, there has to be follow through, okay, and that follow through will often put us in a winning trade right off the bat, okay, and will also help keep us out of a lot of bad trades. Now, we're still going to have losing trades. We can't, completely eliminate those, but incredibly, this will keep us out of a lot of trades. And this is programmed into the trade trend indicator. So it actually gives us the buy stop or sell stop price for any buy or sell signal. Now, I use this indicator in virtually all of my trading decisions. Okay, I was using it back in 2020 during the COVID crash. And I was also using the slingshot. Okay, so this is, of course, it's now Schwab. Schwab has recently acquired TD Ameritrade, but this is my TD Ameritrade brokerage statement from back in 2020 using the trade trend indicator and the slingshot strategy, like I've demonstrated for you on our session. So this is from February, when the market, we got the breach of the lower band and the markets were selling off. Okay, I had identified that. I got a sell signal from the trade trend indicator. We saw the breach of the lower band. Okay, so those are the two criteria that I need to line up. I need the trade trend sell, and I need the breach of the lower band. Then I start to short. Okay, I was being relatively cautious. So these are just my trades from the last week of February. Okay, and so those trades from that last week, okay, by February 28th, I booked over $13,000 in profit, trading the slingshot on the way down. And I was just doing relatively small positions here. I wasn't even trading 10 lots, right? I was trading a relatively small number of contracts. Now, in March, trade trend flashed the buy signal. Okay, so this is, again, kind of the more challenging part of the slingshot, is where do I get in on the long side after the sell-off has already occurred? So I got the buy signal from trade trend, and I was booking profits on my short positions because I played it on the way down. And then I started to put on some long positions. Again, relatively small position sizes, just you can see 1, 2, 3 contracts. I was starting to go long, but I was putting on more positions. Okay, but I was still being relatively cautious because there was, a lot of uncertainty around this particular catalyst. By the end of March, I booked over $27,000 in profits. So in one of the worst market environments that we've seen in the past 5 years or so, when retail traders were taking heavy losses. In fact, I had just recently launched my hedge fund at this point in time. I was aware that an unprecedented number of hedge funds were folding. There were all kinds of margin calls. We of course had a record spike in the VIX, and people were over leveraged. Okay, the retail trading crowd was certainly panic selling, taking heavy losses. Okay, but just using the trade trend indicator in the slingshot setup, I managed to book over $40,500 in profits. Okay, so I'm using a contrarian approach here. Okay, so and this isn't to brag or anything. It's just to demonstrate that what's possible. Okay, and of course I can't guarantee anyone will replicate that, but this is what's possible. And all I used was the trade trend indicator in the slingshot setup. So this can be applied to any market, any time frame. You can do this with any size account. And trade trend will give you predictive buy and sell signals before the move occurs. So it's designed to give you a buy or sell up to 3 candles in advance of a forecasted trend. So again, that means if you're trading off a daily chart, you have up to 3 days of advance notice. If you're trading off a 15-minute chart, you have up to 45 minutes of advance notice. And trade trend has forecasted every market crash and rebound in the history of the market. And I'm going to let you know how you can get this indicator for your own charts in the Metastock platform in just a second. But I'll challenge you to go back, apply the indicator to a chart of the SPY or the SPX or the Qs or the NDX, whatever market index. Okay, go back as far as you can on your chart. Look at every black swan event, bear market, market crash, whatever. You'll see the trade trend sell signal, and you'll also see a buy signal when the market rebounds. And we're going to look at some actual chart examples of that. Okay, so this is the flash crash of August 2015. Okay, no one saw this coming. Okay, August 19th rolls around. This is the S&P 500s. They weren't doing a whole lot in May, June, July. They were basically range bound. Okay, trade trend flashed a sell signal August 19th. Okay, well, that's kind of interesting. We're range bound. The S&Ps are down at the lower end of the range. Based on what's happened over the past few months, it looks like we should just bounce right back up off that lower band, back to the upper band. Okay, trade trend told a different story. It said, be ready. Okay, we actually get a breach of that lower band, and the bands start to diverge. So there's also a slingshot here. And trade trend gave us 1 day of advance warning before the markets crashed. Okay, this is the '08 mortgage crisis. Okay, once again, think back to the psychological curve. We have FOMO mentality. We've got this big housing bubble, but right around May, so this actually would have been, I think, May 20th, trade trend gave us the sell signal. Literally 4 days before the S&Ps breached the lower band and markets lost over half their value in the coming months. It also gave us an accurate buy signal towards the end of November before markets rebounded. Let's go back over 2 decades of the 2000 dot-com bubble. Okay, you guys can now spot the slingshot. What are the Bollinger Bands doing? They're converging. What are the S&Ps doing? They're hitting new all-time highs. They're hitting that upper band until early September when they breach the lower band, trade trend flashes the sell signal, the dot-com bubble bursts, and markets crash. Trade trend also gave us a buy signal towards the end of September, early October, before markets rebounded. This is the 2022 bear market. Okay, kind of like now, S&P's continuously putting in new all-time highs. Everything's looking great. People have FOMO mentality. There are probably a lot of retail traders jumping in near all-time highs, afraid of missing out on future upside in the market, unsure when the trend's going to end. Trade trend told us right at the beginning of 2022. I think it was literally the first trading day of January. It flashed a sell signal 1 day after S&P's put in new all-time highs, and literally warned us of a shift in not just the trend, but the entire secular bull market that we've been in for probably about a decade at this point, and we go into a bear market. Okay, this is the tariff crash from this year. Okay, once again, S&P's putting in new all-time highs. Everything looks just fine. Okay, except towards the end of February, trade trend gave us a sell signal. Literally a day. We had a day's warning before the S&P started to crash. It actually gave us 3 highly accurate sell signals on the way down. Okay, there they are. And then it gave us a buy signal on the day that the S&Ps had that incredible rally and ultimately rebound. And you guys can see the slingshots in there, right? There's actually a couple of slingshots embedded in here. Okay, I traded this just using the trade trend indicator. Okay, and I traded a lot of different assets. This is just on the micro S&P futures. Okay, so I traded the MES over 40,500 in profit. Okay, using trade trend. So guys, virtually every system will produce winning trades if you can stick with it long enough. But the problem is they don't keep you out of the market when conditions are not favorable, and you end up giving back your profits on the losing trades. Okay, we're here to change that. We've all experienced it, right? But I strongly believe in backing up anything that I teach with real world, real money proof. Okay, and this again is right out of my Thinkorswim account. This is just using the trade trend indicator. So again, you can apply the indicator to, like we did today, the slingshot strategy. You can use it alongside other indicators, but I think it's important to demonstrate the power of the indicator by itself. So I especially at this point in time, was doing a lot of my trading in the futures markets. Now, I wasn't doing anything crazy here. I think these were all just one lots, one contract positions. Over 8 grand in a day, over 6,500 in a day, over 6 grand, as much as 27,000 in open profit. There are always going to be losing trades. I have my losers in there. Trade trend helped me keep those contained, and it helps my successful winning trades run. Okay. This is again real world, real money proof. This is using trade trend with the slingshot strategy. Okay, so I was just trading a few futures markets here, and using the trade trend sell signal, so trading on the way down, and then also the buy signal on the way back up, and had over $26,000 in P&L on the day. And I'm just doing a few contracts here, guys. I'm not doing anything crazy. I'm not like I'm trading a 10 lot or a 50 lot or 100 lot, right? But as much as 115,000 in open P&L. Okay, just using the trade trend with the slingshot strategy. So guys, now I want to make a promise to you. Now I can't guarantee that you'll replicate any of the results that I shared with you on the session, but I can guarantee that I will teach you all the knowledge that I've accumulated over the decades and the tools that I use. So I want to help you have days like these, and I'm going to give you access to the exact indicator I've used to achieve the results that I've shared with you on our session today. All right, so this is a one-time opportunity to join me to discover how I make consistent income in the markets day after day, week after week. I reveal every one of my special techniques and indicators that make profits like this possible. I don't hold anything back. I don't give you a redacted version of any of the educational stuff, any of the strategies. I don't give you a lower basic version of the trade trend indicator. I give you the full thing, okay, everything. Okay, so I'm going to walk through what you get today for being here on the session, and that's going to include 12 months of trade trend. And again, you can use this for any asset class that you like to trade: equities, ETFs, futures, forex. You're going to get exact entry and exit signals, so you're never going to be guessing. Am I on the right side of the market? Should I be short? Should I be long? What price should I get in? The indicator is going to give all of that to you. You're also going to get weekly live interactive strategy sessions with me. So we meet with our members at Altos every Tuesday at 7 p.m. Eastern, and kind of like we did today on our session, we focus on a new strategy each week. We do a general market overview, map out key levels, look at trade trend signals, and we host a ticker roundtable where our members can throw out symbols that they're currently trading or watching or maybe interested in trading, and we run a technical analysis, and we use the trade trend indicator. We also record these sessions, so they'll be available in the members area, and you can immediately get years and years and years of education going all the way back to when we started doing these sessions, which we've been doing for many, many years. And you're going to have at your fingertips all of this education. Okay, but if you miss any of the sessions, it's not a big deal. We do record these, and you get full support and coaching from me on these sessions. So I'm there with you every week. Only limitation is I can't give you, personal, individualized trader investment advice, but I'm there to help coach you, help support you, and give you all of my very, very best strategies. We do a lot of strategy around trade management. And adjusting trades. So I'm going to also give you some really powerful online training and curriculum for adjusting losing trades. We can take a lot of these trades that aren't working out, mitigate losses, and in some cases even turn them into net profitable outcomes. Okay, and I also am going to let you know how you can get what I'm currently looking at. Okay, so I'm also going to give you the tickers that I'm watching. Okay, this is all designed to help you cut the learning curve and help start trading with more confidence, more consistency. But there's even more that comes in the package. So let me quickly walk you through this, and then I'm going to let you know how you can get it. So you get 12 months of the trade trend indicator on the Metastock platform. You get weekly live interactive strategy sessions. You get coaching from me on a weekly basis on those sessions. My personal coaching typically starts at $19.97 and goes up from there, but that's going to be all included in this package. You're going to get exclusive invitation-only access to our private Facebook group of around 900 members who use the trade trend indicator and our other strategies. You're going to get the online training for trade management and trade adjustments. This focuses on adjusting options strategies and trades that aren't working out. But again, goes through different tactics to mitigate risk, and in some cases even take a losing trade and turn it into a net profitable outcome. And ultimately learn to trade equities, ETFs, futures, Forex, options, whatever market you are interested in with consistency, which is priceless. And you're going to get a couple of really powerful bonuses. You get my top 2 weekly trade trend picks. So every Monday, each week, I go to work and I find the top 2 buy or sell signals, and I send those out to our members. Okay. So those get sent right to your inbox each week. You're going to get those. We normally retail that service alone for $5.95, but that's an extra bonus in the package today, as well as my latest ebook, How to Create Risk-Free Trades, which is a powerful ebook that covers money management tactics to mitigate risk and even in some cases eliminate it from your trades, which we normally retail for $97. So the total retail value on this package for the Metastock event today is over $5,000. We are knocking 80% off the retail value. You literally get all of this stuff, including the trade trend indicator for your Metastock charts, at only $9.97. So it breaks down to just a few bucks a day, and most people are probably paying more than that in broker commissions to their broker, right? So it's an incredible steal. For that reason, we do limit it to 25 seats before we put it back up to the retail price. So you can still get all these things once those 25 slots are scooped up, but it will go back up to the retail price. All right, so if you want to take advantage of that 80% discount, the link is altostrading.com/Metastock, and you can get access to everything you see here, which again includes a ton of really powerful training, the trade trend indicator, weekly strategy sessions and coaching, a whole lot of really, really great stuff. You also get the bonuses. This is what one of our weekly alerts looks like. You get the buy or sell signal for the stock. This one was one we did on CRISPR Therapeutics, sent this out to our members. You also get a supplemental option alert. So if you prefer to trade the option in lieu of the stock, it comes with instructions for an options trade as well. This is just a snapshot of some of our track record. This service alone has just been on fire. It's just absolutely killed it and done incredibly well over the years. The ebook is bonus number 2. In the interest of time, I won't go through all the testimonials, but we do get hundreds, if not thousands, of testimonials from our trade trend members. And they write into us, and really I want you to of course be my next success story. So I'm going to offer you the trade trend indicator, and I hope that it does for you what it's done for me and for our other members, and that one day you write into me and tell me how well it's working. I do have a guarantee for you. So if you don't earn at least the cost of your membership fee back in the first 90 days, we're going to give you an extra year of trade trend on the house. Again, that's a $1,499 value. We want you to be successful, right? We want to give you enough time to do that. We realize life gets in the way, people are busy. So even if it, sits there for the first 3 months, you haven't had time to use it yet, that's fine. Just write us in. We won't ask questions. We'll just comp you an extra year. Okay. If you're just paper trading, which we encourage you to do, okay, before you ever risk any of your hard-earned money, that's fine too. Then you haven't made any money with it. Okay, and just let us know, and we will comp you that extra year. All right, so I know I just have a few minutes left here, but I do want to give you our contact information. Our email is support@altostrading.com. Our phone number is 800-895-9348. If there's any time for questions, Jeff, I'd be happy to take questions. I haven't actually been monitoring the chat, so maybe if you could relay any that have come in, and I think you also broadcast to YouTube, which I can't see.
The first question is, can you help me find my microphone?
Oh.
We do have a couple quick questions. Neil said, with the brokerage account statements, were those a demo or a real account?
So I missed kind of the first part. The broker. Oh, those were real accounts. Yep, that was real money.
Okay, very cool.
Not a demo, no.
And yeah.
I'm going to show it just while you're relaying questions. I'm going to show it on the Metastock platform as well, just so people can kind of see it. I know I went through with only an hour. I had to go through things pretty fast, so I'll just kind of show you. But these are the.
I know those hours go fast too.
Yeah, right. So the symbology, the diamonds, the green diamonds are going to be your buy warnings. What is this? This is NVIDIA. There's a chart of NVIDIA, and then. So that's your advanced warning, and then this is the arrow is your confirmed trigger, so you've reached the suggested entry price, It also gives you the exit as well. There's a sell warning, there's the confirm trigger. But that's what the symbology looks like on Metastock.
Okay. I don't know if Theodore wanted to know if you could show the charts again, but I don't know if we have time for all of them. But
yeah, it would be a little challenging for me to go all the way back and pull all those charts. But
yeah, it's not a problem because we did record it. So
there you go. That's why we recorded, right? Yeah.
Metastock, you can watch all the chart sections again and pause. Take notes if you want. So
yeah, but that's why I wanted to kind of show you on the actual platform, and to kind of give you an idea of what it looks like, and you can kind of see all the buys and sells at major pivot points. But these are this is just this is live real time, showing you the charts, and you can see the buys and sells at all the major turning points in the market. Here's another market top. Oh, I pulled up some weird. I tried to pull up the SPY and I pulled up some weird security. Doesn't matter what it is though, right? So yeah, whatever this is topping out there, and there's your sell signal. You can see the nice buy signals near the bottoms, but that's what it looks like. Yeah.
I bet if you try again, you could get the SPY.
Yeah, probably get it. Let me.
Emily wants to know if you can use it on NSE stocks. National Indian stocks.
Yeah, you can apply it to anything, and I believe, right, Jeff, you have those available in.
Change that to starts with, and that's what all you need to do instead of contains.
Say again.
Starts with.
Oh, starts with.
Yeah. There you go.
I was like, why is that not pulling up? Okay.
Yeah.
There we go.
Okay.
And we actually just recently had a sell signal here on October 31st. But you can see all the signals at major turning points on the S&Ps. Nice sell, and I don't have the Bollinger Bands here, but of course you can apply the slingshot to these as well. I mean, you can see right at market tops, right? Boom, there's your sell signal. There's another market top. There's your sell signal. You're getting incredible advance warning, but that's what it looks like on the chart. And then of course you get the power console as well. So this is where you can run your scans and find all your forecasted buy and sell signals and so on and so forth. So
awesome. So the website address again to go to is I'm sorry, I had to put it in the chat. It's altostrading.com/metastock. You can also call us at 800-882-3040 if you're in the US or Canada. And it doesn't matter where you're at. As long as you have internet, you can chat with us at metastock.com/saleschat. So, all right. That's all of the questions, Jeff.
All right. Well, thanks so much. It's always a pleasure, and I'll pass it back to you.
All right. Very good. Let me do this. Oh, and go ahead and turn my camera on. Share my screen. All right. And as we move on to the next speaker, I want to thank one of our sponsors, the Traders Forum. If you're at a computer right now, want to join an active and growing community that talks about technical analysis and candlestick patterns and all kinds of good stuff, you can do it for free. You can join the tradersforum.com, where you can chat with other traders, learn about the markets. We do all kinds of lessons about different technical analysis indicators. We're in the middle of a series where we're doing options, where we're talking a little bit about the basics of options and stuff like that. A community of traders designed to help traders. All of that I mentioned right there, you can do for free at thattradersforum.com. So go ahead and join. It's a great place to kind of be, thetradersforum.com. In any case, let me go ahead and kind of jump over to us. And Kelly, I know you're the next speaker, so I'm going to enlist your help. Are you ready?
I
hope so.
I'm ready.
All right,
Here I am. Yes.
Okay. It's prize time.
Oh, I love prize time.
Well, let me find a good one. Actually, I have it. Actually, I need to kind of make a little bit of a change right here just so I can see the list. Let's do, okay, so Dave Landry is coming in a little bit later in the week. He's got a lot of methods that are just built into Metastock as part of the platform. Probably one of the reasons Metastock's been rated #1 in its price category for 32 years in a row.
Yeah, agreed.
He has some services, and this is that he's got a gold membership, which is trading courses that address money management, trading psychology, and methodology. He's got Trend Traders Interact. Basically, it's a year of all the service that he offers for free. It's a $1,200 value. It includes his gold membership. It includes a PDF of all of his books, access to his chat site, all the stuff that he does. Absolutely complimentary. Sounds like a pretty cool prize, right, Kelly?
Sounds like a good price to me. Do I get to win? Since I'm a presenter, do I get it?
Did you register? Because like what you need to do is, if you're watching us on YouTube right now, you need to register. There's a pinned link in the top, and if you get in there and fill out, you'll be eligible to win the prize. So you do have to register. Did you register in advance, Kelly?
I did.
You're like, oh, well, but if you pick your number, I'm going to make you pick a different number. All right. So the number, what I need from you is a number between 1 and 55.99.
Between 1 and 59.99, you said?
55.99.
55.99. Okay.
And actually, it should be 2 because there's a header row.
Let's go 33.66.
Okay. Randy N. And Randy, if you have your name and your Gmail address like I do, you might have just won. Also, you're in the USA. So if you are here and you win a prize, you don't have to be present to win. You just have to register by clicking on the link in the top of the YouTube. But if you do that and you're here and you win a prize, let us know. We love it when you're actually present and win a prize.
Yeah,
so
that'd be cool.
Our
You're
next
welcome,
speaker,
Randy. You're welcome.
Yeah. Somebody said something. I don't know if it was Randy or not. I can't see it.
No, somebody said 59. I think they were giving a number that to.
Oh, okay. Yeah. Okay. Our next presenter is the handsome and talented Kelly Clement. Kelly has a long career here at Metastock, including he started in our sales team. After that, he was our director of sales. After that, he was the president of Metastock. When he started, he had a full head of hair. But running a sales team has its hardships and its challenges in any case. Kelly does a great job.
That's the best thing I've heard all day, Jeff. That's the best thing I've heard all day. I love it.
You're going to talk about system, looking at system tests and kind of doing some more system testing. Correct. Okay. Let me. I know it's a little bit of a new interface. I don't actually have to give you control. You can just hit the share button over by the camera button and just share your screen, and it'll take mine away.
Let's say it's thinking hard about it. It might let me do it.
First try. That's a picture of Kelly when he had hair.
That's me,
All right. Kelly, we can see you. We can hear you. It's all yours. I'm going to get out of the way. I'm here for you.
Thank you so much, Jeff. I appreciate it and wish you still did have that head of hair. But that's okay. We can move forward. So yeah, today my name is Kelly Clement. As Jeff said, I am excited to be talking to you about Metastock, what it can do and how it can help you in your trading. But beyond that, I actually want to talk a lot about the emotions of trading and how we can kind of overcome some of the emotions of trading. So let's go ahead and jump right in. Now, the first thing, of course, you've heard this before, but we do have the quick disclaimer I have to go through. So let me read this and then we'll move on and get into the presentation. So this demonstration is designed to instruct you on using Metastock and accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of any security, nor is it paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or solicitation to buy or sell any security. So basically, I'm not here to tell you to buy or sell anything. I'm just here to show you Metastock, talk about it, and talk about some of the emotions of trading. Okay, so let's go ahead and go right into the presentation. And let's start with emotions. I mean, obviously, I think if you've been trading at all, or if you've ever traded, you felt emotions in your trading. It's hard to overcome emotions and trade non-emotionally. And I think these three screens right here talk to us about the emotions we all feel when we're trading. I mean, first of all, we all love this feeling right here, that feeling of elation where you're in a trade, it's going your way, things are just kicking, and you're like, yeah, I'm killing it. I am killing it in the market today. And then the next day comes along, something happens, and everything goes against you. And you're just like, well, wait a minute. Why didn't I follow that trading plan that I have? Why, then you start to get into well, I'll just let it kind of sit. I'll let it, it'll bounce back. It'll come back. And then we get down into this. We get into that feeling of just like, oh no, it's gone against me now. I'm too far gone. What am I going to do? And that's what we want to talk about avoiding. How do we get out of this mess, right? I mean, we all love to feel this one, and it's great to feel that elation when we're trading, but we want to avoid these feelings, right? And that's what I want to focus on today. So I have a couple quick questions for you, and I'd love your answers in chat if you could throw numbers in here for me. So first of all, what do you find it harder to do? One is overcome the basic emotions of trading. Or two, do you find it harder to be able to follow your checklist, your trading plan? So if you could just throw a 1 or a 2 in the chat, I'd love to hear from you on that one. Then the second poll is, which statement describes you more? What A, so we're doing 1s and 2s and A's and B's, is I'd rather miss a trade than lose money. Or B, I'd rather take a loss than miss a big move. So let's go back to number 1. So overcome the emotions, or 2, be able to follow your checklist. I'm already getting some answers in there. Thank you very much. Thank you, Neil. I appreciate that. So overcome the emotions, and there's no right or wrong answers here. Nobody's going to judge you on anything. So I just love to know a little bit what's harder out there. Overcoming the emotions or being able to follow your checklist, 1 or 2. And then which statement describes you better? That you'd rather miss a trade than lose money, or you'd rather take a loss than miss a big move? Okay, let's take a look at some of the answers coming in here. Okay, 1, 2, A. Yeah, so we've got a little bit of both. And the interesting thing about this poll, if you think about it, and if you don't answer, that's okay. Just think to yourself what you would think. What's hard? Overcoming the emotions. Okay, emotional trading, that's tough. Being able to follow your checklist. And why do we get into being able to follow our checklist? That's a tough thing as well. Great. Okay, so we're getting a lot of answers here. A lot of 1s of overcoming the emotions is harder than being able to follow your checklist. Okay. And then we're getting some both of A and B on this one. And a lot of this is tough because it is emotions. A lot of this, being able to follow your checklist, that's hard because emotions get in the way, or just having emotions. And both of these can be emotional. There's a lot to that, and that's what we want to try and focus on here. Thank you so much for your answers. I really appreciate it. It kind of helps as we kind of go through the presentation. So let me talk about one thing here that I like to talk about quite a bit, and that's the cockpit of a plane here, okay? Whenever, and I'm sure most of you have been on a plane at some point in your life, maybe not right now, it's probably a little rough out there getting on a plane, but when you walk onto that plane, you look over and you look at the pilot sitting in that cockpit, what are they doing? They usually have these pieces of paper in their hand, and in that piece of paper, they are going through their checklist. They're going through step by step of everything that needs to happen to make that plane go. Now, they've been on these planes forever, right? You know, you talk to pilots, they've got 20,000 hours, 25,000 hours of flying, but every time they get on that plane, they do that checklist. And that's an important thing. You know, I watch this TV show a lot. probably too much, but it's called airplane disasters. And they talk about the tragedy of airplane disasters. Obviously, if something happens bad on a flight, they have these investigators that go in, and it's these investigators' job to figure out what happened, what that made that plane go down or have that accident. And they'll research it and they'll find that there may have been a mechanical issue, something went wrong on the plane, but sometimes it comes back to pilot error or even pilot emotions. And what happens is a lot of times they'll go through, and if they find something, they'll find that the checklist wasn't followed. They didn't do exactly what they needed to do. And when they find out these reasons, they'll always go back and they'll issue these directives telling people how to better their flying. And it makes flying safer for everybody. And that's kind of the same with our trading, right? If we talk about, hey, what's harder to do, overcome the emotions or being able to follow your checklist? Well, these can both get in the way of trading, right? It's a very difficult thing. And let's talk about how do we overcome some of these things when we're doing this. So what we're going to talk about today is I'm going to talk about trade identification. So I'm going to talk about how to find the best symbols to trade, when you should get in and out, how to test your system before you spend your first trading dollar, and how to add clarity to your trading decisions. Now, this one is a big one, how to test your system before you spend your first trading dollar. We're going to talk about why that's so important when you're trading and trying to identify. So I'm going to be doing all of this in Metastock. Well, what is Metastock? Well, Metastock is, you've probably seen through the day, it's an advanced charting package. It offers so much in its abilities to chart that it's one of the best rated charting softwares on the market today. So it's very well known for its charting. It allows you to create your own analytics, your own indicators, if you have ideas about how you want to develop things. Market scanning, we're going to talk about market scanning today and using market scanning. We're going to be talking about back testing. So these are the two big things we'll be focused on today. But you can also forecast in it, which Scott Brown will be talking about tomorrow, so you should tune in for that. Options analysis and expert advice. So we'll be talking about expert advisor a little bit as well and how that can relay into that. So that's a quick overview of Metastock, but let's talk about how we identify trades. Okay, so if I'm looking at indicators and trading systems, typically they fall into four main categories. So we talk about things like trending indicators, momentum indicators, volatility indicators, and volume indicators. And that kind of falls into these groups. So let's give some examples of these different indicators. So if I'm talking about trend, I'm talking about things like moving averages, MACD, things that most of us use just about every day in our trading. A lot of people look at the 20, the 50, the 200 period moving averages. They're just kind of the basic moving averages that everybody uses. People use MACD a lot because it helps identify trend. Okay, so those are examples of trending indicators. Now, obviously, this isn't all inclusive. This is just a quick overview of some of these indicators, but momentum would be things like stochastic or RSI. Get into volatility. You just heard Jeff Tompkins talking about Bollinger Bands, which is a great measurement of volatility and how to see volatility on your chart. Average true range. Volume, we have on-balance volume, Chaikin money flow, volume as basis. Okay, so these are some of the examples of these types of indicators. Now, when we're trading and when we're doing this, what we get into is we kind of get into this confusion. If I'm looking at a chart, and it could be any given chart, how do I know on that specific chart which group of these indicators works and which one I should be trading with? Even down to different time frames. So if I'm trading Apple and I'm looking at a daily chart, well, it doesn't trade the same way a 5-minute chart of Apple does. So how do I know which indicators I should be using? Okay, so that's what we're going to talk about, is how do we kind of narrow this down and how do we get into the nitty-gritty of what I'm looking at? So here's an example of oil. Okay, so if I'm looking at oil here, how do I know which of these groups is the best? So I have trend here. I've got some pretty big volatility here. Okay, we've got some great momentum here. Okay, where am I at? What indicator should I be using to trade? And that's what we want to figure out. Okay, so we're going to talk about two different workflows through this. One, we're going to talk about how to use your preferred indicators. So if you have one that you love, let's say you love the MACD, great. Let's show you how to identify opportunities with the MACD and then take that and see if you can find the best stocks to use them on. Okay, so that's what we're going to do with our first workflow. And then let's say you have something that you love to trade. And a little bit later, I will ask you for some examples of stocks or futures or Forex or whatever it is you trade. I will ask you, hey, which ones, let's look at a few of what you like to trade, and we'll find the best indicators that work on those. And so we're going to do these two different workflows. So let's go ahead and jump over to market scanning for just a moment. So let's identify an opportunity. So if I go over to Metastock, okay, so you have Metastock here, and I have a chart open. Okay, so let's use as an example the MACD. Since it's such a popular indicator, people really use it a lot. Let's use that as our starting point. So what I'm going to do on this chart is I'm going to apply the MACD. I'm just going to search for it in my indicator list here. I'll just drag it on my chart, hit OK, and now I have the MACD on my chart. Now, you may or may not know how the MACD works, and that's okay. Either way. So basically what we're looking for here is we're looking for crossings of these lines to help us identify opportunities. So if I came back here and went right here, see, I have a crossing of the signal line above, so that triggers a buy opportunity for me. If I come a little further down, okay, that would be a sell. Okay, so it has very simple ways to identify opportunities. Okay. Now, you may not be the kind of person who likes to go through and look for those lineups. So one of the tools we do have in Metastock as we get to market scanning is our expert advisor. So the expert advisor is awesome because it can give you expert advice right on your chart. Okay, so it can tell you where the buy and sell signals are based off of the criteria of the indicator. So I can see here, I have my buy signal, and there I have my sell signal. Currently I have a buy, and there I have a sell or a short. Okay. If you want more information on this, you can go into Metastock's expert commentary, which went to my other screen. So here's the expert commentary, and this walks you through everything that's going on that trade. Okay, and you can apply this with anything else that you want. If you wanted candlesticks, or if you wanted RSI or stochastic, or any of the other indicators, there's an expert advisor for that. So what we're going to do here in our example to start is we're going to look for MACD signals, either buy or sell, on a market scan and see what kind of results we get. Okay, so we're taking that MACD example, and I'm going to pull up my Power Console by clicking the P up here, and I'm going to go to this Explore tab. So here I can tell Metastock that I want it to look for the MACD, but you can see there's a huge array of scans that you can do. You can even develop your own if you want to, but I want to use this MACD expert scan. Now, if you didn't want to scroll through there, you can just type MACD. Okay, so there I've got my MACD. You see it filters down. I'll just select MACD here. And then what I want to do is I want to tell it what list of securities I want it to go through. So I want it to go through, let's just say the S&P 100 right now. So I'm going to select the S&P 100, and what it'll do when I hit Start Exploration is it'll go through all 100 of those stocks to see if there's a current signal on it. Now, I could do this, right now I'm using Metastock DC, so I have daily, weekly, monthly, quarterly, yearly. If I had Metastock RT, I could do this on a 5-minute, 10-minute, 30-minute, or whatever time frame. Okay, so I'm just going to do this on a daily, and I'm going to go ahead and start that exploration. Now, what it's doing here is it's churning through and it's looking for those current opportunities. So you can see it's going to churn through that for just a second. Now, as I go through this, let me bring my market scanning up. Now, why market scanning is just so important is it allows me to save time from sitting down and going through each of those 100 charts individually and then making a list and identifying if there's a current signal, when Metastock can just do it for me on its own. That makes it way easier for me to be able to identify signals and just get a pre-made list for me rather than going through and identifying those myself. Okay, so you can see we're about halfway through this. So it's going through and it's looking at that current bar to determine this. Now I could go back and I can do yesterday's bar and see if there's something that's changed from today. You can do that as well. You can even go back and scan on a specific date to identify if there's something. So if you went back 3 years and you wanted to see something. So the Explorer is very flexible in that way in letting you do what you want to be able to do in identifying signals. Okay, so we are all set here, and let's go ahead and take a look at our results and see what we have. So I have down here, these are my results. I have 21 results, 79 rejects. So if I look at my results here, what you're going to see is you're going to see buy signal as a label. So I can double click and rank on these and see which ones are a buy opportunity. I can rank on sell and see which ones are a sell opportunity. And then this OB and OS, what that is OB is overbought. So there's a couple ways you can use the MACD. You can use it buy and sell signals. You can look for overbought, oversold, or you can even look for divergences with the MACD. So there's 3 ways to trade it. This scan is looking for these 4. Okay, so buy signal, sell signals, overbought, oversold. Okay, now what I could do if I re-rank on my buy signals here is I could go through and I could open up each one of these, put on the expert advisor and go, okay, well, if I were to open Ampol here and then put on the expert advisor, look at the commentary, I still really don't know if this is a good opportunity to trade. And that's what I want to figure out. So before we do anything else, what we want to do is backtest this. So let's talk about backtesting these signals to see if we can identify what's best. Now, backtesting, if I click on my down arrow instead of my up arrow, we'll get to what backtesting is. So backtesting, quite simply, it's this. And I'm just going to read this because it's a great description. Backtesting is a method of evaluating a strategy or model's performance by applying it to historical data. It's commonly used in finance to assess the viability of trading strategies, and it's used by all levels of traders from beginning to institutional level traders to identify the best opportunities. So let's break that down just a little bit. So first of all, backtesting is a method of evaluating a strategy's performance by looking at it historically. So what it's going to do is if I were to go back here, and let's look at Apple here, since we have the expert on it. What backtesting will do is it'll go back through however much data that I load here. So let's say I've got 5 years of data on this chart. If I expand this out, okay, you can see I have a lot of signals in there. If I was to go in there and try and figure out my performance of every trade in here, it would take me a lot of time to try and figure out. So what the backtester will do is it'll apply this for us and take all those trades instantly, okay? Think of it kind of like a dating app, right? Like Match.com or something. We're trying to match the personality of the stock with the personality of the system. So the MACD is a trending indicator, so we want to find stocks that are trending. And this can do that for us by matching them up to identify if we're having a good personality match, okay? So it's commonly used in finance to assess the viability of trading strategies. Okay, so if we're starting to talk about emotions of trading and taking emotions out of trading, if I can see if something has worked well historically, it's going to give me a better odd of success that it's going to work well moving forward, okay? And then finally, it's used by all levels of traders. Now, we have people using Metastock that are just starting trading all the way up to top level institutional traders who use Metastock and backtest to be able to assess the viability of their trading strategies. Okay, it's a very important concept to be able to work with. So why use it overall? One, you can quickly determine whether your idea might work before putting in any real capital. So instead of having to paper trade something, which is always still good, but you can assess how well it's worked historically by using the backtester. You can avoid costly mistakes. You can see how it performs in different markets. This one is my favorite one, because if we're talking about trading, we want to go into a trade with confidence, right? If you know your strategy has proven success, you're going to go into that with a lot more confidence than just taking a trade because it's there, right? So you can optimize your performance and then finally understand your risk. Man, if you can walk into a trade understanding the risk of that trade and how it works, all the better, right? Understanding your risk as a trader, hey, maybe this one has worked really, really well, so I'm willing to put a little bit more capital into it. Or this one has been kind of iffy, so maybe I don't want to risk as much because I understand that risk of how well this is performed. It's a great way of analyzing the market and understanding what your trades are doing. Okay, so let's go back to Metastock. Let's go back to Meta. Come on. Okay, so what we're going to do, let's go ahead and close Apple here. So what we're going to do is we're going to backtest those 21 securities that we had that had an opportunity on them, and we're going to see which one of them is the best performer, which one gives us the most confidence and has the less risk to it. Okay, so we're going to go to the system tester here, and what I'm going to do is, again, we want the MACD, so I'll just search the MACD to backtest, and down here in our symbol list here, you always have this last exploration result. So I just ran that scan, I got these 21 results. I can now look at it and say, okay, these are the ones I want to test. So quick, easy way to get to your list of what you just did. Now, as we go through this, everybody in here has a little bit different way that they trade. Everybody has different risk tolerances. And so you have to tell the system tester a little bit about you. As we're filling out that Match.com profile, right? We got to tell a little bit about the way we trade, our equity, how much we're willing to risk. There's a lot to put in here, okay? So we're just going to look at, you can say either I only take long trades, I only take short trades, or I do both, okay? I scanned for both buys and sells, so I want to look at both. But you could just say longs or shorts, and it would change the way your system test results come out, because long trade only is very different than longs and shorts. You could tell it how much time you want to test for. So I could say, I want to test over the last 5 years, or the last 2 years, 1 year, the last 30 minutes if you have RT. So you can customize that. And when you're setting this, I like to look at it as, how does this thing perform in different markets? How's it done? How's it gonna hold up if something goes sideways? Okay, and that's one thing I want to look at. Tell it what interval. We scanned for daily buy, so we're going to do daily. And then trade options here. What we're going to do is, this is just kind of a one-time set it and forget it. Okay, we're just going to go through this pretty quick because we've got great training that shows you how to do all this when you're up and going. So let's go to account. Now this is the big one that you kind of have to determine. Okay, if you are a futures trader or a commodities trader, you just come over here and you'd select points only test, because you're testing on points. Okay, if you're an equity trader, you can tell it how you trade. Okay, so you can tell it, hey, I trade on just a set number of units. I trade 50 shares at a time, or 2 shares at a time, or 1,000 shares, whatever it is. You can tell it, this is how I do it. Transaction cost, you could say, hey, I always put $1,000 into a trade, or $10,000 into a trade. It's always that fixed transaction cost. You can do that. Or you can say percent of available equity. So what this one is, and this is the one I typically like to use, is you can say, I have this much money in my trading account. Now, if I were to ask you, and this is not an answer to put in chat, is how much do you have in your trading account? Again, I don't want to know. Don't put that in chat. you would put that in here, okay? That is, so you put in, I have $100, I have $10,000, $1 million, whatever it is, okay? So my example here, I have $100,000, okay? And then you can tell it how much you're willing to risk. Now, I have in here 20%. Now, would I ever put 20% into a trade? Probably not. It'd have to probably be a pretty good setup for me to do that. But the reason why I use that is because the math is easy here. Okay, so if I'm risking if I have $100,000 and I'm willing to risk 20% of that at any given time, I'm risking $20,000. Okay, if my money goes up to $200,000, well, now I'm risking $40,000. If my money drops to $50,000, I'm risking $10,000. Okay, so you can go through and you can customize that. Okay, broker, you can put in here if you trade on margin, if you trade on a money market account, you can put that in there. If you have margin requirements, you can put in here commissions if you pay commissions when you trade. I know most people based in the U.S. don't pay commissions anymore, so that's defaulted to 0. If you're international, I know a lot of markets you still have to pay commission per trade, which is a real cost of trading. You need to put that in here to get an accurate system test. So you just put in, percent of transaction points or what your cost is in out of a trade. And then trade execution. This is the last one we set. So this is basically saying realistic market prices. So what that is I have a buy signal today. Most likely, I wait till the close of that bar for that trade and then get in market on open on the next day. Okay, so that's what realistic market prices is. But you can change that to say, hey, I want to buy on the open or the high of the low, and I want to wait 3 days on the high. So you can set that and customize that. Most people just leave realistic market prices. And then slippage is basically, hey, I get in on market open, but sometimes it might not be right at market open. It might be just half a point up or low. So you can customize that in here if you want to as well, if you like to get that granular. Okay, so that's all I have to say here. Let's get in and let's system test and let's see what these results look like now. Okay, so we're starting our test and it's going through and it's scanning, it's testing through those 21 securities, taking every trade over 5 years for me. You can see it's just chewing through that really quick. And I have my results. Okay, so imagine the time it would have taken you to go through and measure all this, and the system tester just does it for us. So let's just kind of expand this out here to take a look. Okay, so now obviously up here we have our results in a graphical formula. You can see up top we have some greens and we have some reds. Okay, so the green ones obviously did well, the red ones did not. So I can kind of throw those out. But let's come down here and we can rank on these. So I have my instrument, my symbol. It looks like I actually selected the wrong list when I did it. I did the S&P ASX 100. So we didn't do the S&P 100. So that's why everything has a .ax on it. So we'll maybe redo that here in just a minute. Okay, so I can rank on these and I can see how these have performed. Okay, so I'm looking at Whitehaven here, WHC.AX, my date range. So my net profit over that period of time was 10%. I had 240 trades. And then I had 118 winners, 122 losers. Okay, so if I was trading the MACD systematically over 5 years, I would have had 118 winners, 122 losers, but yet it's still my best performing system. Well, what does that tell me? Well, it tells me that my wins are probably much bigger than my losses. Okay, so that's something good to look at. Okay, so I like big wins. I like little losses, right? Okay, if I went down, I can see and I can just go through that. But let's go in. Let's get a little more granular here. Okay, now there's a lot of information that you can pull out of the system tester. You see I have a full page here. I've got an orders tab that shows me all my orders. Show me the positions, how they all worked out, what happened, how many units it bought. you have this equity line that we'll get to in just a moment, and then you have your system and how your system is developed, okay? Now, really, when I get into system testing, I just look at a few quick things, okay? And I'll just walk you through those. I like to look at my average profit, which was about $1,000 to trade. My highest profit was $5,800. My average loss was $933, and my highest loss was $3,900. Now, one thing to consider here is, and I know everybody does this, I just know it, is stops. Does this account for stops? Now, the way I tested this just to say, hey, when it says buy, buy, and when it says sell, sell. So I'm just looking at the system on its own. So how does it stack up? How does it do? Well, when I look at it this way, okay, I'm not accounting for stops. You can account for stops in the system tester. Okay, so there's a setup for that. I'm not going to walk through that today, but again, we've got great training and great support to help you do that. So how does this stand up on its own? Well, I look at this, and then I go over to this tab. I just go to this equity line tab. And the equity line will tell me very quickly, hey, how is my money doing with this system over time? Well, if I look at this, what is my money doing? It's going up, it's going down, it's going up, it's going down, it's choppy. It doesn't, it goes up, but it's choppy. It doesn't. What I really like to look for with this is a nice, smooth upward equity line. And I don't see that here. So even though this is my top performer, I mean, I could trade this, but I'd want to probably trade it with tighter stops if I was doing that. Okay, so if I went to my second one here, and I just went right to that equity line, okay, now this one's a little bit better. It's not as choppy, right? So I have my initial money back here, $100,000. It grew up to 115 here, but then what has it been doing? It's been kind of drawing down, and here we have some increase on the equity line, but not much, okay? Let's go to our third one. Okay, a little bit better, but really what I want if I'm trading is I want confidence in my trade. And if I can look through these and go, you know what, none of these look like a great opportunity to me, that's okay, because what do we want to do again? This one's a little bit better, because in current markets, we are seeing this increase upwards on the equity line. I mean, I know back here it's flat, but we're seeing an increased one, but I still don't really love anything of what I'm seeing. So this lets me just say, well, hey, do any of these trades look good to me? No. And that's okay, because I want to walk into a trade with confidence, and I want to understand what is happening. So let's maybe do our same test here really quickly, but select the S&P 100 to see what we get. Now, while I'm doing this test, I would love for you, for our second round of testing, is I'd like you to put some symbols into the chat that we can look at. Okay, so what I'm going to do now is, again, I'm going to choose the S&P 100 here in the US rather than the Australian S&P 100, and let's see if we have any opportunities there. So while we're doing that, let's go ahead and have you put some symbols into chat that we can look at in just a minute. Okay, so you can see this scanning here, looking for symbols and identifying what we've got going on, and we'll then look at some of your symbols. And it's okay if you don't have a symbol, but typically a lot of people have a symbol that they like to look at. So again, please feel free to throw something in chat. I'd be happy to look at it. I am looking at the YouTube chat as well. Let's see. Okay. All right. So we can see we're just about done here on our market scan, so we can look at what's happening with the S&P 100. Okay. So here I have 13 opportunities. Okay. So we can see our opportunities here: 3M, Booking, General Dynamics, IBM. Okay. Let's go ahead and throw this into the system tester. Now, I don't have to go through all those steps in the system tester again. I've already configured it to the way that I want it. I just need to select that list again and do this. Now, so I ran my scan in under a minute. I've set what I'm backtesting here. I've got my backtest results. Okay, now I've got some back tests here. Let me just pull this out this way here. Okay, so now what I'm going to do, again, rank on percent gain. So Eli Lilly was my best one here. Let's go ahead and look at that one. Okay, and go right to my equity line. This is right what I like to look at when I'm system testing. Okay, so this equity line, it's pretty good. It's better than what we were seeing earlier. So I have this. Let's look at how it's holding up in the current market. Okay, we're having a pretty smooth equity line. We've got some drawdowns in here. So it's something to think about in analysis. Let's look at IBM. Okay, well, if I'm looking for a nice smooth equity line, IBM is a nice smooth equity line right from there. So let's look at IBM and see why this matches up. Okay, so let's go back to chart here. Let's just pull up IBM. Okay, and I've got my MACD on here, and let's see why IBM seems to be performing well. Now, if I look at this, what do I have here? I've got trend, 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 trend. So you can see it is actually a very well trending stock. It has been trending. It's been doing a lot of trending, and so that's why the personality of those match up. Okay, because it's trending. The MACD trends. So we've put together that personality test. Now it looks like today's signal has disappeared because I'm still during market. We're bouncing up and down. So that line was probably pretty close on going up and down and changing. Now, I'm not saying trade IBM based off the MACD. You need to do that research. Again, I'm not here to tell you to buy or sell anything. I'm just kind of here to show you how all this works. So that's the way that you can kind of go through it. Now, again, if I was looking for, let me bring that back up here. Okay, so if I was looking for this again, and I was looking for ones that trend and have a great trending, okay, that's a great example of a smooth equity line. That'd be what you're looking for, is that because it's telling you that it's consistent, right? Let's just look at 3M to see what it's doing. Okay, now here we're riding the roller coaster a little bit, right? We're going up, we're going down, we're going up, we're going down. So this is how my money, if I'm trading with the same consistency. Now, I will say it's wise to go in there and say, if your trading rules, if your checklist says, if it moves X percent down, get me out. Or if it moves down X number of points, get me out. Put that into your system test, and that will change the way you see this. But you have to be able to follow your rules when you're doing that. So I like to look at it both ways. Standalone, how's the system do on its own, and how doesn't it do? Okay. Let me scroll up here. See. Okay, so Michael, thank you. He's given us a symbol to look at for our next workflow. So you can see how quick that was. Scan in under a minute there for the S&P 100, then back test it in 3 seconds, pull up, look at the equity lines really quick and say, well, here's one that I have a higher confidence level in. And that, again, is what we're looking for in our trading. So our next workflow is a little bit opposite. Okay, so here we scanned the market, we looked for opportunities, then we back tested and found to see what's working, what's not. Okay, so now what we're going to do is we're going to look at a symbol provided by Michael here, STRL. Now I don't know what STRL is. Let's go ahead and, I've got to close this over here. Okay, so let's pull up STRL. Okay, so Sterling Infrastructure. If we pull open that chart, wow, okay, well there's a trending stock. Okay, so what we're going to do here is we're going to say, well, I want to know what indicator works best on this stock. So you can select from a group of these. So if I go into the Power Console again, and I come down here and I go to System Test. Now I don't know if there's a current signal from anything on Sterling, but I want to see if there's what is trading best, so when a signal arises, I know which one to take. So I'm going to, as an example, use what we call in Metastock the performance systems. So there's these 80 performance systems inside Metastock that you can use to help you backtest. So I'm going to select all these systems. So there's 80 of them. And I have a couple other things. We have the Ichimoku indicator in here as well. We'll leave that in here. And we'll test all these systems in here. Now I may also go through and add the standard MACD. Okay, let's add the MACD, and let's add the standard R relative strength. Okay, relative strength. Okay, and now, so we've got 86 systems. So we're going to put 86 systems against STRL. Okay, so what this is going to do is it's going to take 86 systems now and put it against this one symbol to help us identify what's trading best on it. So let's view our report here. Okay, so it looks like we have a few big winners in here. Let's go ahead and rank this. Let's rank this on net profit here. Okay, so of those systems that we selected, we have a profit of 232% on the first one. But look at this, 13 trades, okay, that's okay, right? One was a winner and 12 were losers. So is that something that you want to take when it only 1 out of 12? That doesn't give me a lot of confidence. It probably picked up the signal like right at the beginning of that big move and ramped up is probably what that was. So one winner, I'd probably be a little hesitant on. So let's maybe look at the Stark Band system. Okay, so this one had a couple of trades. Okay, and this one was fairly consistent, had a bit of a drawdown on it, but it's moving upwards. Okay, so something to think about. The pattern trading system, let's see what it says. Okay, so with this, let's look at it here. So if I were to say the pattern trading system, let's go back and see how many times it traded. So this one's a little more active, 157 trades over that 5-year period, 91 winners, 66 losers. Okay, so that is probably a little more active, probably more my trading style. So I'd go into that, and then I could look at my equity line and say, hey, that's a consistent trader. That trades consistently. It has a smooth equity line, and I'd be a little bit more interested in that. So let's actually then take that system. So if we go back, that is the pattern trading system number 1. So what I could do is I could now go back and go to my expert advisor, and I could just search for the trading pattern system number 1 because I know it's the one that has performed best, and then I could attach that. So you can see it is a lot more active. It trades in and out, but it catches those moves rather well on this chart. Okay, so it's easy to backtest a security. Now, my challenge with this one is I don't have a current signal versus the other one, and I'd have to wait for an opportunity. Okay. John's asking, where will these recordings be available? These will be available on YouTube, on our YouTube channel, youtube.com/Metastock. All these recordings will be available for you. Great question, John. Okay, so let me jump back over to my PowerPoint. So that's our 2 workflows. Now, obviously, when we're backtesting, we're looking historically, right? We're looking at that time frame of the past. But what happens next is always the big question. And that's why we want to improve our confidence levels. If I go back here, so knowing my strategy has a proven history, it gives me more confidence to stick with it. And I understand my risk. Okay, so I've answered 2 of those big questions with backtesting. How do I improve my confidence and do that? So if I can then know that I have a higher confidence level and I understand my risk, I can go into that trade more informed. Again, I'm not recommending anything to buy or sell today. I'm just showing you how this works. But backtesting combined with other analyses can really help you identify and be more confident in your trade, which is what ultimately we all want to do. So how can you use it? Well, Metastock, first of all, when you get Metastock, we offer free white glove support setup to help you get started with Metastock. We offer free lifetime support, so you can call, chat, or email our support anytime. Friendly personal answer and help you out with your problems. Again, phone, chat, or email. We have free training videos on our YouTube page that you can go through. All kinds of support. So whatever you need, Metastock is here to help you get set up, get going, and be using Metastock in the long term. And how to get started with it is, well, you can get a 3-month trial. You can buy 1 month up front and get 2 free. So that's going to take you through November, December, and into January. So you've got 3 months, you've got holidays coming up that you'll be able to really play with Metastock, learn how it works, get everything going to apply it into your real trading. So that includes Metastock 19, a data region of your choice, white glove installation support, and Unleash the Power of Metastock, which is a bonus ebook and a set of videos that only people who get Unleash the Power of Metastock have access to watch to help you get up and running. So there's 2 versions. There's Metastock DC, which runs about $75 a month, and that includes global markets, Forex, global markets, minus exchange fees if there's exchange fees to access delayed data, but you get daily delayed data. And then there's Metastock RT, which starts at $199 a month, goes up to $265, and that allows you to analyze in real time, 1 minute, 5 minute, 30 minute, 60 minute, daily, whatever you want. So it's $165 plus exchange fees, $265 to have Metastock on there. And then you can try this again, 3-month trial. And all you have to do is go to metastock.com/saleschat or go to metastock.com/comp-promo or give our guys a call at 800-882-3040. I'd recommend giving them a call. You can talk about the ways that you trade, if you're position, swing, or whatever type of trader you are. They can guide you to the best version of Metastock that would work for you. So give us a call, 800-882-3040, or visit us at metastock.com/saleschat. We'd be happy to answer any questions. Jeff, let me go ahead and bring it back to you.
All right. Great job, Kelly. Appreciate it.
Thank you so much. Thanks for having me here, Jeff.
I'm going to go ahead and jump over to this share. Thanks again, Kelly. I think you got all the questions, so I don't have anything to reiterate with you. All right. Let's go ahead and jump over here. Share this screen. All right. Okay. Again, all of the specials, including the extended trial, you can find at metastock.com/comp-promo. If you have any questions, let us know at metastock.com/saleschat. Feel free to give us a call, 800-882-3040. Big thanks to Kelly for for doing that, talking a little bit about system testing, all that kind of good stuff. And I do want to say, as we get going here, I do want to say thank you to AAII for sponsoring today's event. AAII has been a sponsor for a couple of years. They do a really, really good job. And they're nonprofit. They were started in the 1970s. Very well respected, very well reputed company. And you can find out more information about them at AAII.com. Mr. Greg Lewis, I'm going to ask you.
Yes, sir. Yes, sir.
Prize now. Let's look at the prize list. I need to actually, I think one of the things I'm going to do after we start our next speaker, which is the fabulous Sunny Harris, is I'm going to have an update of the list. That means if you're watching us on YouTube now and you haven't registered, you have just a few minutes to register so that you can be in the next prize drawing. Okay. Let's see.
By the way, I think I was going to say that the last presentation by my boss is by far the best presentation so far by anyone this week so far, right up
Oh.
until my boss's boss presents tomorrow. And I'm pretty sure that will be even better.
Oh, yeah. He's not here. He
Oh,
left.
never mind. It was okay.
All right. I'm looking at the list of prizes. The next one we're going to give away is from TechnoTrader. Martha Stokes is going to be speaking. I think it's tomorrow, but she graciously offered one of her free courses. The name of the course actually is here. Let me know. I'm like awkwardly this way. I'll just go move it like here. How to trade flash crashes. Crashes, reversals, professional strategies with dark pool insight. It's normally an $800 course. You can learn how professionals anticipate, trade, and manage sudden market events. It starts November 11th. There's limited enrollment. She's got one slot that she's allowed for this. So let me go ahead and pull up the list. Greg, what I need from you is a number between 2 and 55.99.
All right, that number is, according to Google Random Number Generator, 3,794.
And that is Ray S. in the USA with an AOL account. So let me go ahead and make a copy of that real quick. Ray,
congratulations, Ray.
You don't have to be here to win. However, if you are here, you're not obligated to say hi or thanks for the prize, but we love to celebrate with you. Let me see. TT. All right, cool. That's all logged. Thank you for the assist, Greg. I appreciate it.
You are welcome. I'm here if you need me.
All right. And then, as I just alluded to, our next speaker is Sunny Harris. Sunny's been a big friend of mine, a big friend of Metastock, a great designer. She's going to talk a little bit about our SunnyBands. She has a great history of kind of, she's read over 600 books on trading. She's published many, including on how to program trading languages, that kind of stuff. Very, very smart trader. Somebody who's been in the market for quite a while now. She retired at 30. She's been trading ever since. Sunny, let's go ahead and get you started. How you doing today? I can see you there, but I can't hear you just yet.
Jeff, FYI, I also can see her mic is on, but I cannot hear her.
Right. Yeah. Let's see. I do see that your microphone is on, Sunny, but I don't hear you at all. So if you click on the little arrow next to, I can't see your screen though, so there is that. But if you hold on the arrow next to mic, it'll allow you to go to your audio settings. And Greg, I might just have you just say a few things while I get Sunny on the phone and see if we can't work out her audio issues. Oh, wait.
That sounds...
She just went
green.
green.
Are you sure? I got my tap shoes right in the closet over here.
Yeah, I'm not sure yet. I did see your microphone go green for just a second.
That was probably mine. Oh, hers?
Yeah. Anyway, yeah, let's go ahead. I'm going to go ahead and maybe you should, I don't know.
I just do.
Do you have any good jokes you want to tell us?
I don't have a dad joke. Look, okay, I'll tell you what, I'll pull up ChatGPT and say, give me some great dad jokes.
Yeah,
because I'm sure that'll get us along just fine. I'm sure everyone will stay totally engaged as that's going on.
Yeah. I will tell you. Let's see. I might mute myself if Sunny answers.
I understand.
Captioning's on though. Hey, Sunny. Okay, I'll be right back, Greg.
You got it. So everyone, thank you so much for your patience. You are currently on day 2 of the Metastock Traders Conference, and we're waiting patiently for Sunny Harris to come on board. Her presentation today will be Dancing with the Markets. And that always features her SunnyBands. Let me see if I can get you some information about Sunny to share with you before she starts. Just a moment, please. Yeah, okay. Again, thank you for your patience and just ignore Jeff behind the screens over there. As we're trying to get Sunny Harris set up, we've got a little technical issue. Regarding Sunny Harris, she's the author of Trade Along with Sunny, and creator of SunnyBands. Sunny is a full-time trader for 43 years and frequent contributor to trading magazines and speaker at trading webinars and seminars. She's also been published in the Trader's Catalog and Resource Guide magazine for 8 years, beginning in 1993. Sunny sponsors the Money Mentor on the internet since 1995, and she was rated #1 trader in the under 10 million category 2 years in a row by Stark Research. By the way, while I'm droning on trying to keep you all engaged, if you have any questions about today's presentations or about Metastock, now would be a pretty good time to chat it in. I can answer them as best I can. Let me pull over to questions so I can actually see your questions. All right, don't see any questions. Additionally, about Sunny, she is her second book, Trading 102, Getting Down to Business. Excuse me, we're getting hit out from all of them. Okay. Her second book, How to Trade Like a Pro, sold out in its first 2 weeks and continues to be a financial bestseller. Trading 102, Getting Down to Business, was released in October '98 and has also received record sales. In early 2000, Harris released Electric Day Trading 101, addressing the basics of trading online and through direct access brokerage, followed by Getting Started in Trading in 2001, and TradeStation Made Easy in 2011, for which she won the prestigious Star Award. Sunny has now released her 7th and 8th books, The Complete Guide to TradeStation's Easy Language and EL Programming. Jeff, I hear you again. Oh, maybe you didn't mean to come back. Also, and again, I'm sorry, I'm not prepared at this particular stage to show you Metastock. Oh,
let me have you go ahead and test it. Yeah, no. Wait, can you hear
Well,
Sunny?
what's weird is her computer can hear her because you can see the text below it. So why aren't we hearing it? That's the weird question. All right, Sunny is still apparently having issues. Coming up today, let me go ahead and share my screen. One moment. Again, if you could please wait for just another moment. We're trying to get Sunny Harris, our next speaker, up and running. She's having some technical issues with her audio. And while that is happening, I'm trying to keep people engaged, and I'm not very good at it. But let's see how I can do about sharing my own screen over here, which I've never done before. Sure, there we go. All right, just to really quick let you know, we do have more people up. Coming up this afternoon, next after Sunny, assuming we can get Sunny up and running, is John and Jack Kosar. They will be discussing following the data, systematic investing for a changing market. After them, at 4 p.m. Central, East Coast time, will be John Seville. He will be discussing marketing mayhem, the one pattern that shows up before every big move. And after that will be Larry McMillan at 5 p.m. Eastern. Larry's a longtime speaker on Metastock and just been in the business forever, and he's very good at discussing options. He'll be discussing what McMillan's option-oriented indicators are saying about the market now. And then I believe the final presenter today will be Buff Dormeier. He'll be discussing intro to volume studies, decoding money flow for market insight. Okay, I'll ask again, if anybody has any questions, I'm going to go over the questions. I don't see any questions. I also don't see a lot of people dropping off, so we do appreciate your patience at this time. I'll look over at YouTube. Someone asks, Still Lake says, I'm wondering if the government shutdown is about to end When will the SNAP benefits return so I can avoid all the EBT queens at the grocery store? That's a really good question, Steel Lake, and I can tell you that since yesterday, I've heard that they do have a plan to end the government shutdown. Regarding SNAP benefits and your personal experience at the grocery store, I'm afraid I don't have a really good answer with that. If we have any other questions regarding Metastock and not just world events generally, please go ahead and ask them in our chat. And we'd love to hear from you during this time while we're waiting for Jeff to oh, I guess I can't do that when I've got people sharing my. I just looked behind the screens to show you what's going on here at the Control Center in Southern Texas. I guess we could talk about the upcoming week. Again, this is a 5-day event. What you're watching right now is a technical break of the Finish Strong in 2025 Traders Conference. It goes all this week from Monday, November 10th to Friday, November 14th. And again, we are currently waiting for Jeff to help out one of our speakers to get, let's see how he's doing, on board. He's still not able to do that. In that interim, my name is Greg Lewis. I'm the marketing manager for Metastock, and I'm here to sort of keep you engaged until he comes back. Tomorrow, I should point out, we do have a whole, I'll just go through the schedule this week. Tomorrow we have Dan Passarelli. He'll be discussing winning with momentum trades. Next after him is Price Headley. He'll be discussing tomorrow at noon Eastern, at 11 Eastern, how to trade NVIDIA options with Donchian channels and multi-time frame signals. And then after that is our very own Scott Brown, who will be predicting price action using Metastock Forecaster. Again, my name is Greg Lewis. I'm the marketing manager for Metastock. This is an unfortunate break we're taking while we're trying to get one of our speakers hooked up with audio. If you could please hang with us. We hope to have Sunny.
All right, Greg.
Online. Oh, please. No, don't stop me now because I'm on a roll. He has some major feedback going on.
Yeah, that might not work. We were going to have. Well, here, let me try it without any audio here. Okay. Let's give this a second.
Okay. Again, folks are waiting.
Yeah, that's not working.
Whatever you're doing is not coming through, Jeff. It's not working. Are you trying to pipe her through on a cell phone to your mic? That could work, Jeff, if she would mute her mic on her end and you make sure there's no speaker going on your end. All right. Again, apologies for the interruption. We
Greg,
are waiting.
Let's have you turn off your microphone first.
Well, okay.
Okay.
Testing. 1, 2, 3.
Yeah, does she have to turn off her microphone? Well, you have to turn off your microphone or your speaker.
Yeah, something. Yeah, we're getting feedback from somewhere. Somebody's got a live. Greg, I want you to turn off your speakers, maybe. But why would that be picking up?
If my microphone's not on, Jeff, my speakers have no bearing on what's going on. Also, I expect she has her computer's mic on, or you have your speakers on in the office. Are you trying to patch her phone through to your microphone?
Yeah, that's exactly what I was trying to do.
Yeah, that should work, but you need to turn your speakers off and have your microphone on, and she needs to turn her microphone off.
No, not through your microphone. I still show you're muted.
Jeff, she should mute her microphone. She should only be talking to you through her telephone if you're doing the telephone to the microphone thing. Okay, folks, this looks like we're going to be dealing with this for a little bit longer. Again, we apologize for this lengthy break. Technical issues, unfortunately, are
anymore. I've got no audio on.
Okay.
I've got the camera off.
That works.
That's Greg, working. Not if it's working.
That is working.
Okay, because my speakers are off. I can't hear anything. Sunny, they can hear you though, which is the more important part of this. So
Okay.
I
They
can also
can't
hear
hear me?
you. Yeah, Greg is nodding that he can hear you. So
Okay.
let's go ahead and we'll have you turn on the screen share. I'm very sorry. We'll have to test this and figure out why it's not working for you for next time. But this
There it
should work
says
for now.
you're sharing your screen.
Yep, and we can see that.
Okay.
All right. Very sorry.
We'll go with this.
Everybody, thank you for your patience as we worked that out. That was kind of like a bit of a problem. All right, Sunny, it's all you.
All right. Thank you, Jeff. And thank you, Greg, for that nice introduction. All right, let's see what we've got here. It's not going to the next slide.
Well, when it rains.
Goodness. Oh my goodness, let's see if I click an arrow. Up, down, sideways, no, nothing.
What if you right click and hit previous or next?
No, that doesn't do anything.
I think maybe your PowerPoint has maybe gotten non-responsive. What if you press escape on it?
If I
it moved.
do it, okay.
Yeah, it's moving now.
If I click it on my computer, it brings up the next graphic.
Okay, yeah. That makes sense.
All right. So that's a picture of SunnyBands, which is what I use every day in my own trading and what I've been using for the last 39 years with no changes to the mathematics, to the programming, to anything about it, other than to add features like commentary. So I'm going to talk today about the business of trading. I'm Dr. Sunny J. Harris, and there's today's date. My passion is in helping beginners and intermediate traders, and this talk is for traders who have not yet become wildly successful. And by that I mean 100% or more per year, people who have not traded much and want to learn, and folks who want to improve their trading results. I love to teach and mentor and consult. So give me a call anytime. My number is at the bottom of every one of these slides. It's also at the top of my website, moneymentor.com. So, trading is ultimately a business and should be approached as such. Anything less is folly. Trading is a solitary endeavor, and you have no employees. You're the manager, the trader, the accountant, and the chief bottle washer. Here we have the disclaimer, which is basically summarized by saying, never trade more than you can afford to lose. You can lose some or all of your money, so be very careful. For more details, you can go to my website and see disclosures. I will be posting this talk on my website, moneymentor.com, after the presentation, and then you can click on the hyperlinks. I'm a professional trader, and I have been for almost 45 years, which it'll be 45 years in January. I trade futures, gold, stocks, and crypto. Come on. It's not bringing up the next slide now. For many years, I also traded corporate bonds and investment diamonds. Next slide. But I do not trade options. I found out very early on that I can lose money very quickly and effectively trading options, so I gave that one up. I'm going to tell you a little bit about myself, but first I'm going to show you how I trade. This is a chart that I use. I have price. Obviously, you know what price is in this chart. And I have SunnyBands, which consists of a dynamic moving average in the middle of the bands, an upper inner band, upper outer band, lower inner band, and lower outer band. So I have 4 bands and a moving average. Now the difference between this moving average and any other moving average is this one is dynamic. That's why I call it my dynamic moving average. And that is, it changes the length of the average with every tick of the market. So most moving averages will have fast length of 9 and slow length of 18. Mine doesn't have those inputs. Mine has 9 and 18 on the one bar, and then 10 and 15 on another bar, and then 10 and 20 on another bar. So it's adjusting its length to the speed of the market. And that's done automatically in the mathematics. On this chart, you can see, you can see the yellow dots, which are PHW, potential hourly wage. The yellow dots mark all the ideal highs and lows. Then you have this red line, which is the ideal equity of this chart. And down below, I have a very colorful thing called the dynamic moving average histogram. This histogram measures the difference between the gold and purple lines. So you can see as they get farther and farther apart, you've got more of a trend. And their gold means gold's on top. So in the moving average, gold is on top. When they turn red and start going down, that means we're losing momentum in that long trade. When you go over to the left and you see the purple lines underneath the zero line, that means purple is on top and we're moving down. Green means we've lost momentum in the purple part. So it's constantly measuring momentum and distance. So I said I'm a professional trader, which means I get charged more fees. Since 1981, through the 41% crash of 1987, the 38% crash of 2000, the 52% crash of 2007 to 2008, as well as the 38% COVID crash, and the next one. We don't know when the next one will be, but what we do know is it's likely to happen one of these days. I trade the S&P 500 futures contract on 1 and 5 minute charts, and nowadays I'm using 5-minute and 15-minute charts as well. And the S&P is said to be the most difficult market to trade because it moves so fast. You have to be really quick to catch those trades. I have a live trading room that I do every morning. And in that room this morning, we were pressing the buttons over and over again as the market moved very fast up and down. So I've been doing it for over 44 years. And I also have long-term stock holdings. To me, that means a week or more. So when you're trading on a 5-minute chart, a week looks like a long term. And I do trade crypto. So I'm going to post a PDF of this talk on my website. You can go to moneymentor.com/membership, join for free, and get a copy of these slides. I also do a podcast called The Sunny Harris Show, and I've interviewed 54 of the most famous traders in our business, and it's great to listen to and get an idea of who they are. I also, every night, do a Substack called Where is the Dow Going Next? And I give a little hint into what I think is going to happen tomorrow. And just for attending this session, I'll give you 1 week free of my live trading room, which is called Trade Along with Sunny. We call it TAWS, TAWS. So you can get 1 week free of my live trading room. The live trading room is $395 a month. And just for attending this talk, you can get 1 week for free if you text me or email me. It's Sunny, SUNNY, at moneymentor.com. And my cell phone is 760-908-3070. All you have to do is text me at that number. And it's every morning at 7:30 a.m. Pacific time. So I'm over on the left coast. Just quickly, I was rated #1 trader by Stark Research twice in a row. And I was using SunnyBands in my dynamic moving average, and that's all. And you can see right at the top there's my performance. I grew up dirt poor in Appalachia, and I mean dirt floors in an outhouse. I decided that the only way out was through education. So I got a bachelor's and a master's and a PhD in mathematics. And after I retired, I got an AA in photography. And I've taken many post-grad courses in math and programming. I've been programming for 57 years, 45 years trading. And I started out as a systems programmer for Lockheed up in Sunnyvale, California. Then after that, I helped found a little company called ISCO, ISSCO, and we became the world's leader in machine and device independent computer graphics software, which became Harvard Graphics. When I was 30 years old, I retired from that company, and I gave my money to money managers because I didn't know how to trade. I didn't know anything about economics or trading or the stock market. And so they lost $75,000 in the first 3 weeks. And I decided I can do that poorly on my own. So I taught myself to trade through reading books. And Jeff, I've read 747 of them now.
Impressive.
And I did not enter a single trade for the first year of watching the markets. I just charted by hand on graph paper every day's open, high, low, close. Well, they didn't pass through the open back then. So it was only high, low, close prices that we were plotting. I've written 8 best-selling books. They are Trading 101, Trading 102, Electronic Day Trading 101, Getting Started in Trading, Trade Station Made Easy, and then Going Vegan with my friend Linda Blair, and Using Easy Language 9.x with Murray Ruggiero, and now The Definitive Guide to Trade Station's Easy Language and OOEL Programming with my friend Sam Tennis. Now, Sam died in August, so he's no longer available to ask questions. You have to call and ask me. I've written articles for all the well-known trading magazines, and that's just a few of them. And here are the covers of my books, so you can see I really did write them. It takes about 2.5 years to write a book, so it's really a labor of love. This is the latest one. It's a 2-volume set. And I've got on my website, moneymentor.com, I've got a little section which is boxed in red called Quips. And you can see unsolicited emails from people all over the world who have something to say about what I offer. So, and I even put the bad things on there. So come look at Quips. Oh, and you can see my phone number there. See that? Pacific Standard Time, sunny@moneymentor.com. I also do Substack, I told you, at tcrgsunny.substack.com. And it's called Where Will the Dow Go From Here? So I call it Technical Analysis for Tomorrow. So every day, pretty much every day, I post the latest prediction. And for now, it's free, but in the future, at some point, it won't be. So sign up now and you'll stay free. I have customers all over the world, so don't be afraid to give me a call. People do. So I've got people that are 15 hours away that give me calls. We're going to talk now about how to make a 6-figure income. I get new people who call me up all the time and say, how do I make $100,000 a year trading? Or how do I make enough money to live on? Or I only want to make $2,000 a day. How do I do that? So here's the way. If you say you want $120,000 a year, now that's a big goal, and you can't achieve it unless you break it down. So we're going to break this down so we can actually achieve it. $120,000 a year divided by 12 months is $10,000 a month. So that seems a lot more doable. But $10,000 a month divided by 20 days in a trading month is $500 a day. Now that seems a lot more achievable. But it's just 5 trades at $100 each. That's really doable. And there's usually between $1,000 and $3,500 per day potential in the S&P going both long and short, just one contract. So the money's there. It's just waiting for you to take it. Before you start trading, though, you need to determine your goals. So if your goal is $120,000 a year, put that down. And you divide the goals into attainable dailies, like I just did. And then you develop a written plan. You've got to have a plan if you're going to get there. A plan or a strategy is really just a recipe. So you need a recipe to cook, you need a recipe to trade. Otherwise, you're going to end up with flat biscuits. Plan your strategy, test your strategy, and if the stats are good, keep going. If the stats are not good, go back to step one. Plan, test, and then follow your strategy. Those are the only three things you really need to know. Plan, test, and follow your strategy. There's only one reason to trade in my book, and that's to make money. If you're doing it for any other reason, I dare say you're not profitable. If you do it for the excitement or the challenge, or you want to make a few extra dollars for your family, and the thrill of the win, a lot of people do that. And then the worst one is to live on. If you have to make this money to live on, you're going to be too afraid, too tense, and you're going to lose over and over again. I met an amazing woman the other day named, what is her name? Elena Bradley, A-L-I-N-A, Bradley. And she has done brain examinations to find out how we're motivated and how we keep going. So if you get in touch with Elena, you'll find out how to program your psychology for winning. Let's look at $192.46 per day for 1 year. We'll look at that on a chart. And that's what it looks like. It's a steady climb up, and that's what Kelly said we want. So less than $200 a day, and that's what it looks like. So it's all positive. We're making it every single day, day after day. But I want you to see the chart because I put this line on my chart when I keep track of my successes and losses. I keep that line on there all year long, and I do my best to follow it. So keep the chart. I chart just about everything. If you keep the equity chart every day, you'll be more likely to make the goal. I'm going to put a spreadsheet on moneymentor.com for you to download. Just go to resources, downloads, and you'll see it there. And if you become a free member of Money Mentor, you get access to that and to articles that I've written and presentations that I've given that are not available elsewhere. And it's free. And I don't share my data, by the way. One of the things you need to know is you have to know your audience. So if you're a lone trader, your audience is you. You're trying to keep that equity curve for yourself. If you're doing it for others, your audience is them. So if you're a CTA, commodity trading advisor, then you're keeping those statistics for them. And if you're doing it like I do, which is daily live, your audience is you because you want to keep it for yourself, and them. You want to keep the equity curve for your audience. There will always be losses. We all have them. It's just part of the business. So in your projections, be sure to account for them because they're going to happen. So for instance, if you plan to make $200 a day, then you probably should allow for making $400 a day and losing half of it. Keep track of all the details. So for instance, you want to keep track of your commissions and your slippage. And the commissions used to be $50 a side on the S&P, sometimes as much as $85 a side on the S&P. Now it's $1.20 a side. Per side, I mean $1.20 on the buy and $1.20 on the sell. Stock and ETF commissions these days are nothing. And stock options are $0 plus 60 cents a contract. So there's no barrier to trading anymore except the losses. And where I trade, the margin requirement is among the lowest available in the industry. Now, remember, this is a business, so you want to keep track of your commissions and other brokerage expenses, your slippage. How much do you pay for your office space? So if you're trading out of a closet in your house, you need to know how much that closet actually costs you. You've got electricity and gas and water and all kinds of things that you have to pay for as part of your trading. Office expenses, computers, software, things like that. And taxes. You have to account for the fact that you're going to pay taxes if you make money. A lot of people say, well, I don't want to make too much money because I don't want to pay too much taxes. I think that's just the opposite of the way that you should look at it, or at least the way I look at it. I like to pay taxes. That just means I'm making more money. A retail business is happy with 10% per year. New traders come to me and say they want to make 100% per year. But that's next to impossible. It's really, really difficult to do. I took a look one year at 2000. I had a book of statistics about 2,000 CTAs, commodity trading advisors. Their average, I added all 2,000 up and divided by 2,000, their average was 0%, which makes sense. The top half, so I took 1,000 of them, they made, on average, 10% per year. And the top half of that, which is 25% of them, made 30% per year. That's the best of the best. They're making 30% per year. I have a little program called Trade Log, and if you make lots of trades like I do, it makes sense to get this software to keep track of your trades. And the nice thing about it is, at the end of the year, you can do your taxes with it. And I think it costs $359 a year, something like that. I don't pay attention to that, but it's certainly affordable. If you make fewer trades than that, a spreadsheet will do just fine. The reports from your platform, TradeStation, Multicharts, NinjaTrader, or Metastock should be sufficient. Kelly showed you all kinds of reports that are available in Metastock. And here's my trade log. I keep it on a spreadsheet while I'm trading in my live trading room. And there's the performance equity chart. So I've made 167% so far this year. And last year I made 482%. So if you were someone new and you came to me and said you want to learn to trade, I would try to discourage you. 90% of all new traders wipe out their accounts. And that's the truth. Only 10% of you are going to succeed at this. And it's a pretty dangerous profession. It's the one profession where sometimes you get paid, sometimes you pay it. So proceed with caution. How much is enough? How much should you plan to make in your business? How much is available? If you don't know how much is available, you don't know how much you can make. And I look at this with an indicator I call PHW, potential hourly wage. So potential hourly wage tells me how much money is on a particular symbol. If we look back at Kelly's charts, he scanned through a whole bunch of stuff and came up with viable alternatives. I take it the other way around. I look at how much money is available on a particular chart through trading. And that's the chart that I'll trade, the one with the most money available. So let's look at the SPY for a few minutes to see how much is available. My newest Metastock indicator is PHW, potential hourly wage. And we compare different symbols to see which one has the most possibilities. We look at ideal versus PHW. So I'm going to look at the ideal amount of profit you could possibly make versus potential hourly wage, which is what you could probably make. So here's how I do that. Do you see these yellow dots? Yellow dots mark the ideal turning points. And what I do is I take this as a short, and this is the exit, add up that money. Take this as a long, this is an exit, and add up that money, etc. So here it is on the SPY. This, at the left, this table is, what is it called, Jeff? That's the
expert.
commentary window.
I was trying to turn on my microphone. It's the expert advisor commentary.
Expert advisor commentary. There we go. So this tells you all the statistics from this PHW indicator. And this red line across the chart is the equity that's potential. So you can see there what potential we have for this particular chart. On the bottom, again, we have the dynamic moving average histogram. If you were to buy and hold the SPY, you could make $1,584 with those yellow dots. If you traded the ideal yellow dots, you could make $750,000. PHW I take is 60% of the ideal. So I figure that I can leave 20% of the potential on the table getting in and 20% on the table getting out and still have 60%. So that's right at $450,000. And it was what is that, 3-year time span. Now, $450,000 in 3 years is pretty darn good. Here it is on a screening. You see the yellow column at the end. This gives me the potential ideal profit. No, I'm sorry. The ideal profit is right here under the column that says ideal. It's the white column to the left of the yellow one. So the ideal is what's the maximum income you could make from trading that symbol. The PHW is the 60% that shows us how much is actually realistic. Now, to design your strategy, there's one question that I ask of everything I look at. But first, I look at all the locally available indicators. And by that, I mean MACD, moving averages, RSI, those kind of things. There are indicators in your software already. And you look at all those and see what works. Put them on your favorite chart. And if you don't have PHW, you just mark the turning points with the yellow highlighter and add up the values of profit and loss. So it takes yellow highlighter. And then you ask, what is true? That's the most important question of all. What is true? We're not going forward again. There. And you test all the possibilities. And of course, you have to keep a comprehensive log of your work, or you won't know where you've been and what you still have left to do. This is a list of the kinds of indicators you can see in your software. There's just everything under the sun. And you have to test every one of them, because how do you know if they work if you don't test them? Now, in the disclaimer at the beginning of the talk, it said hypothetical results are not necessarily valid, and that's true, but if you don't test the hypothetical, how do you have anything that you can test? You've got to test something. So we test past prices, and there's just a few of the indicators available. Let's look at moving averages. So I've got a 9 and 18. Let me have a little water here. $19 moving average on this chart, and it's still the SPY. And you can see right here we have a crossover. The typical method for trading moving averages is on their crossovers. So we see crossover right here, crossover right here, whipsaw, and another crossover right there. Here we touch it, it's questionable whether we crossed over or not, but there's another potential. Up here we have another potential crossover and another and another. And that's what led me to design the dynamic moving average, was these crossovers that cause a lot of whipsaw. You can make a whole lot of money in the trending times and lose it all in the whipsaw. Let's look at the same thing with MACD. So here we have at the bottom, we have the MACD, and we have crossover, 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 crossover. What do you think happens with all those crossovers? Crosses over, and you lose money every time because it's constantly going back and forth, and you're not catching any particular trend. If you're interested in this kind of thing, I can help you learn to test your indicators. We can write little programs that do it. Jeff can help you write little programs, or have some of his people, and you can test these configurations, if you will, and see what works. But you need to do it on lots and lots of stuff. RSI. How do you know? Well, you can read a book on RSI. There's a good book. Constance Brown wrote a book, and she talks about RSI and overbought and oversold levels. And she's very, very good. She's a brilliant CMT, chartered market technician, and her work is just excellent. There's another book by Thomas Bulkowski that examines all kinds of indicators and their efficacy. So either one of those books, and you didn't get to see my books behind me, but I have a screenshot of my books that I usually put on my presentations, and I've got 750 books there that I've read, and I learned something from every one of them. So Constance Brown or Thomas Bulkowski are really good. Let's look at what is true of the ADX. Now, I used ADX as a filter on I used it on MACD in the beginning of my trading career. So I would put MACD up there with its signals, and then I would put ADX up there, because if the ADX is moving up, you have a trend. If it's moving down, you do not have a trend. Up is a trend, down is not a trend. So I used that as a filter, so I would only be trading trends. And that was something I learned from Jake Bernstein way back in the dark ages. And it worked really well for quite some time. But then it quit working, as things tend to do. Let's look at what is true with SunnyBands. So we've got the SunnyBands, and where are the crossovers? Let's see, right there's a crossover, and right here's the crossover, and you see how it just keeps going and going and going and going, and we don't get all those crossovers. That's why I designed the dynamic moving average in the first place, was to get rid of crossovers. And this thing does a magnificent job of that. I also have a scan that I run on all the stocks every night, and I look at 3 different moving averages together, 21, 55, and a 200. So if the stocks are above those 3 moving averages, I consider them to be bullish. And this is what a scan looks like. And where it says true, 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 that means that the price of this stock is above all 3 moving averages. Let's look for a second at SunnyBands rules. These are the rules I use in my own trading, and they're for educational purposes only. I don't give advice. Come on. Oh my goodness. There we go. So I'm not an advisor, I'm just a trader. Rules level 1. I enter long when red candles have been moving downward and touch the lower outer band, and then turn blue and move back inside the lower outer band if price confirms. By that I mean if we've got blue bars, we expect price to be moving up. So if price moves up, then it confirms. If after the blue bar price moves down, it does not confirm. I like to buy when the market's moving up and sell when the market's moving down. I don't like to chase the market. I like to know that it's confirmed. Come on. There's the chart. So we can see red candles going down over here. They turn blue and start going up. I enter short when blue candles have been moving down. Nope. I enter short when blue candles have been moving up and touch the upper outer band. So this is the upper outer band. And then turn red and move back inside the upper outer band if price confirms. Once again, if we expect it to go up, I want to see it going up. And that's what that chart looks like. Another way of seeing confirmation is if price moves back through the inner band. So we're going down, 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 and now it moves inside the inner band. So you can look for it going up or you can look for that confirmation. Level 2 is if the DMA line, and remember that's dynamic moving average. So that's the purple and gold lines, and it has a little thin black line in between them. That's the average between the purple and gold. I call that the midline. So if we've got purple and gold being flat, that is the angle is sideways, I don't expect price to move very far beyond the midline. And you can see that that's a barrier to further price movement. And here's level 3. And this says if you have a trend, stay with it. So level 3 is if gold is on top, which it is all through here, then stay long until the DMA is penetrated. So we go long, 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 and then price penetrates the gold line and we're out. Now we're going down, so if we have a trend, stay with it. So you can see it going down, and then it turns and goes up through the DMA. And now I'm out. So you stay short until the purple is penetrated. Hang on one second. My phone wants me to respond. Can you still hear me, Jeff?
I can hear you, yes.
All right, phenomenal. So I'm going to give you SunnyBands for free. Just put SunnyBands in the chat window or text it to me, and I'll give it to you for free for 7 days. So here's my phone number if you want to text me, or maybe Jeff will keep track of it in the chat window.
I will, yeah.
Be sure to tell me what platform you use. So you might use Metastock, Multicharts, TradeStation, or NinjaTrader. I have versions for each of those. So for a free trial with Metastock, give them a call. They'll set that up for you. And the cool thing about it is I do 2 Zoom sessions for free. Now, I charge $535 an hour for consulting. I'll do 2 Zoom sessions for free with you to set it up and show you exactly what I do. I don't think anybody else in the business does that, nor do they put their phone number out there. Be sure to tell me your name and email address, and I'll give it to you free for 7 days. Free orientation and instruction, and it's me personally, not my assistant. And we'll even do a Zoom session in the live market. Everybody wants to see that. So that's last year, 482%, and this year so far. I do a free live trading room every morning. You can have 2 guest passes for Wednesdays before you subscribe. Wednesday morning at 7:30 a.m. Pacific time. 1 hour live trading. Just go to moneymentor.com/guest pass or text me. Now I'm going to give you a real quick live trading room replay so you can see what I do in this trading room. That's my theme song, which was composed by one of my students. Trade along with Sunny. Oh, that says 9 a.m. I don't do it at 9 a.m. Back when there was gold on top, I don't really expect it to go much lower than the DMA. If it goes down and closes into the DMA, then I'm short. Next 1 minute NASDAQ was going straight up. Look, there's $9. We'll see what this one's doing. You can see I've got a target stop in there, and it just got filled. Here's another one. What I'm watching right now. See if that's going to go above this inner band. And if it does, there it goes on the inner band. And we got another order filled. That was good job. In and out. That was a perfect exit on that trade, wasn't it? Sure was. Yeah. I've taken 2 of them, Sonny. Have you? Did you make any money? Yeah. Absolutely. Yeah, absolutely. Okay, I'm going to stop that as we're running out of time. So remember, ask what is true to develop your strategy. You can't force a strategy to work. You can only trade what is true. Create your detailed written plan, and I mean detailed. I used to give seminars, live seminars in person, and I would have people write the recipe to make a peanut butter and jelly sandwich. So that's a detailed written plan. And then they would turn them all into me, and I would pick one of them at random and make a peanut butter and jelly sandwich according to their rules. We got the silliest things, like you take a jar of peanut butter and you spread it on the sandwich. Well, you just told me to spread the jar on the sandwich. So you've got to be detailed in your written plan. It includes your expenses of all kinds. Test your plan for efficacy. You've got to know whether it works or not. And then stick to your plan. And that's all there is to it. I don't really believe in psychology. I believe in testing and sticking to your plan. If you can't follow it, that just means that you haven't tested it enough. If you have a winning strategy, I've got a couple minutes, you can amplify your returns using my Ultimate F spreadsheet. But without a winning strategy, you can't compound your results. Bigger losses will just make bigger losses. But with a winning sequence of trades, you can compound for great success. And this is all based on the works of Ralph Bentz. And I'll tell you more about that later. So this, for instance, is trading one contract at a time. And you can see we have losses and wins and losses. And this is real trading. But if you use my Ultimate F spreadsheet, you can see that blue line down here, and the red line is the compounded results. You can see it makes an astronomical difference. Yes, you have to sit through some drawdown, but it keeps going, and it's just marvelous. I use this all the time. So if you're interested, give me a call, 760-908-3070. And I answer the call myself. I don't have an answering service I don't have my administrator do it. I answer my calls. I don't have salespeople. And you can get me at moneymentor.com anytime. And I'm sorry for the problems we had with the audio in the beginning, and pressing the button doesn't forward the slides. I'm really sorry about this. But such is life. So all the products I have are programmed by me for use in my own trading. So I use them. I know they work because I use them every day, and I make them available to you. And I will show you exactly how I use them. And you can go to moneymentor.com/order and find out all my prices and give me a call. And I don't hold anything back. I'm not like some who do a magic waving of the hands since they see there's the rabbit out of the hat. And I do train you how I use them for free. Live trading room every day by subscription. Trade along with Sunny. It's at 7:30 Pacific time for 1 hour. Text me and I'll get your information and send you the link. And there's my phone number one more time. And because you've attended this talk, let me know and I'll give you a week free. That's $395 right there. Substack, tcrgsunny.substack.com. I post my predictions. And it's called Where Will the Dow Go From Here? Let's see. Let's just run through these. I offer lots of things, but they're all based on my own trading and what I know works for me, and I'd be happy to share it with you. Special offer. Oh my goodness. If you order before the end of this coming week, I can give you 40% off of indicators and mentoring. Oh my God, I should have taken that out. But now that it's there, I'll honor it. And we have a payment plan if you're interested in that. So give me a call, please. Thank you, Jeff.
You're welcome, Sunny. This is not actually the first time I've had to put a cell phone up to a microphone. So,
really?
No. But it's been a while. It is the second time.
Oh, wow.
I'm glad we got it working for you.
You need to use Zoom.
Yeah. I think for sure we need to figure out. We definitely need to test it for you next time. But I really appreciate your patience in getting us running.
No problem. I'm happy to do it.
All right. Very cool.
I hope the audience was okay with that.
I'm told that the audio was actually pretty good. So.
Oh, good.
All right.
Good.
Thank you very much.
Will you have a recording of this?
We will, and we're going to edit about 12 minutes out of it.
Will it be on YouTube or where?
YouTube.com/Metastock.
All right, fantastic. Thank you, Jeff.
You bet. Thank you very much, Sunny.
Bye-bye.
Bye. All right. Cool. All right. Let's go ahead and kind of just resituate, turn back my audio on. And all right. Okay. Woo. We did get that running. I really appreciate your guys' patience while we worked through that as well. I mean, it's not often we have technical issues, but man, when it does, it sure can be a little bit stressful, to say the least. One of the things I really do like about Sunny is she does allow you the ability to kind of get everything for free, try it. And what's been very, very interesting to me is how many people go on to make sure that they have access to it after they've gone through it. And that makes sense. So it's helpful. And I really just think what Sunny's saying here, not only am I going to give you a free week in the room, I'm going to give you a free week to try the things. I'm going to sit down with you twice, once to just talk to you about the indicators and once to help you trade with them. She does a really, really good job. And she, like the people that work with her absolutely love her. So just to kind of recap about SunnyBands, they're designed to hug the price. As part of the package that we have built with Sunny, as part of it, you're going to get the SunnyBands, you're going to get the DMA histogram, you're going to get SOAP, and you're going to get all the templates, all the indicators. Of course, it's going to have scanning. I wouldn't release a product without scanning. It's kind of one of our best features. You get the expert advisor, you'll get the commentary that she showed as part of that as well, and then you'll get those 2 one-on-one calls. So all of that's for free. It's a 7-day free trial. No credit card required. We'll just set you up. We'll set you down with Sunny. You can't do this online, though. You need to call in or you need to go through sales chat because we have to have a very special way we have to set this up. So you can give us a call, 800-882-3040. You can go to metastock.com/sales chat. Both of those are different ways you can do it. So, and for those of you that have put SunnyBands in the comment, we'll be reaching out to you directly to kind of help you make sure that you get that trial set up. So there you go. All right, as we're moving on to the next one, I want to thank our sponsor, Stocks and Commodities Magazine. Stocks and Commodities Magazine has been sponsoring all of the events for about 15 years. They do a great job. We love having them as sponsors. A magazine that they've been publishing since 1982. They've done 17,000 articles. They've also been a great partner of ours. They're easy to work with. Love them. www.traders.com to find out more about Stocks and Commodities Magazine. Whew. Actually, okay. Also, any of the offers that we're doing right now, you can get at metastock.com/conf promo. You can go to metastock.com/sales chat. You can also give us a call at 800-882-3040. So if you're interested in anything we've talked about today, whether it's like the extended trial to Metastock or anything but the 7-day trial for SunnyBands, for that we had to set it up for you. But anything else, metastock.com/conf promo. All right. I'm very interested to see what our next guests, Jack and John Kosar. Jack and John Kosar have actually had an impact on the way I trade this year, in particular. And I kind of like the way they look at kind of research in the market. They do Asbury Research is the name of the company that they found and own and operate. I like kind of the macro stuff that they looked at. And when I said they had an impact on the trading that I've done this year, it has to do with the actual macroeconomics that they were looking at. And some of the stuff they talked about in our February conference got me really interested in alternative country ETFs for a while. And so that was a very, very good play back then. That was something that was well warranted. Some of those just went crazy for a while. And they do a really good job, though. You're going to love them. I'm interested to see what they have to say. Grab a notepad because you're going to want to take some notes. All right. Let's go ahead and get you guys started. John, Jack?
Yeah, can you hear us?
I can hear you, yes. Okay,
Here we
I'm going
go.
to adjust a little bit of volume here. We had a little bit of a technical issue earlier. Okay, I think you're sounding good. Can you give me another audio check?
Yeah, still here. Yep. How's that? You sound okay?
You sound amazing. Amazing. And I didn't even have to type in through a cell phone, so that's cool too. What I need to do is I don't have to make you presenter anymore. Just click that share button.
Yep.
And it'll allow you to just kind of share whatever you want.
Alrighty. And away we go.
All right. I can hear you. I can see you. Thanks for being here, guys. I'm going to get out of the way. I'm going to take my notes.
Okay. Here we go. So what we're going to talk about today is pretty much what we talk about whenever we're on, because it's our own methodology of trading markets. I've been doing this is my 43rd year. Went by fast. Spent 17 years on the trading floor of the CME. There we go. And during that time, I tried a lot of different ways to try to trade markets. I was in the pit for a pretty long time. And for me, I found out that systematic trading was the best. It was numbers-driven trading. Even though I spent all that time on the trading floor, I was really never a good seat-of-the-pants trader. And I found out after I got off the floor that I did a whole lot better if we used what I've learned on the trading floor and just from being around for a while to build quantitative models that tell us when to get in and when to get out. It takes the emotion out of it. One of the hardest things about trading is trying to do the same thing all the time under all conditions, which means sometimes when you get up in the morning and the S&P is down 70 and you're long, are you going to act the same way as if it was just another normal day? So trying to get the consistency, I think you do that by using math, and that's kind of what we do now. So what we're going to do today is show you some of the models that we've built over the years. So we're using these models to trade money for other individual investors. We have managed accounts that we offer. We also offer research, as Jeff said. And we manage money for both other money managers and also for individuals. We're going to show you how we put together some of these models, just maybe to get you thinking in that direction. And then we're going to look at some current charts that I think are really important. We spent a lot of time looking at relative performance between different kinds of assets. I'm a big fan of it. I think it kind of shows you what's going on underneath the hood of the market. And so let's get started. As I said, I've been around for a while, so I've had the opportunity to be on a lot of various spots in the media. I think the one for you that as you're watching is the one up here at the top here, the YouTube channel. We started a YouTube channel. Actually, Jack did. He's much more technologically adept than I am, but we started a YouTube channel 2 years ago.
Yeah.
About 2 years ago, and there's a lot of material there. There's a lot of educational stuff there. There's interviews from various places. I'll be in the Schwab Network tomorrow. in the morning, right around the opening. So if you like what we're doing here and you want to learn more, it's a way to do that for free. Our approach, again, purely data-driven, focused on following the money. We do a lot of work with watching the AUM, the assets under management of various ETFs, telling us what are people buying this ETF and trading intraday and then selling it on the close. That would be shown up in volume. Or are they buying the ETF and taking the overnight risk because they think there's more risk in having to buy it higher the next day than coming in the morning and having it lower? So we do a lot of following the money. And basically, all our models do is tell us two simple things. When I started building these, it was like, what are we trying to do here? Well, number one is we want to know if we want to be in the market or not. How much in the market? Do we want to be in cash or do we want to be in stocks? And then the second thing is, if we're in stocks, where do we want to be inside of the stock universe? So with the intention, with the goal of trying to outperform the S&P 500 or something that's going to be plain vanilla. So should I be in? Should I be out? And if I'm in, what do I buy? And I really think trading just boils down to that. Bunch of models that we've built over the years. The CPM we're going to look at, that's the correction protection model. It's risk on and it's risk off. It's basically tracked very closely to the S&P 500 over the past 8 years, but with about 40% less risk. That's including drawdowns. Our Asbury 6, I'm going to show you actually how we built it. And the Asbury 6 is what we use every day to tell us what the internal condition of the market is. Why did I build it? Because you can't tell by looking at the S&P anymore. It's a quiet day today, right? It's a holiday. The banks are closed. But if you've been trading the last 2 or 3 weeks, we've had several days where the S&P's up 70 or 80 at one point in the day, and it's down 40 or 50 a few hours later. So we built this to tell us daily what the internal health of the market is. In some ways, the S&P has become the noise as far as we're concerned. And the signal has been some of these kind of secondary indicators that tell us, after you get through all the show business of being up 50 and down 50 in the same day, what's happening underneath the market. So we get a better idea of how exposed we should be to equities. Our CEF model, Jackson to go into that in detail. That's a sector rotation model. That answers the question, where should I be in the market? Our CARP model is a cross-asset model. We're not going to talk about CARP, but CARP is cross-asset. And it's another model that tells us where in the equity spectrum is the outperformance. We have a U.S. versus the world model that we're not going to look at that today, but that kind of does the same thing. It tells us, should we be in the U.S. market or should we be in any of the 25 foreign markets? Jeff alluded to this early in the year. We moved a lot of our money into some of the overseas markets. I'll show you the indicator that we use to tell you when there's good conditions to be in overseas equities. It's not all the time. If you're in overseas equities all the time, you're going to be outperforming the U.S. a whole lot. But when certain conditions come into play, it's a very lucrative place to be. We'll show you how we pick stocks, or how we pick individual ETFs is really what we're going to show you. And then we have 4 model portfolios that we use to manage money for others. Here's where to find us. By the way, this PDF is available to anybody who wants it. Go to asburyresearch.com, go to the contact tab. All you need to give us is your name, your email address, and that you're an attendee today, and we'll send you all this because we're going to probably go through this kind of fast. Glossary of terms that we use. Jack's going to let you know what those are. We use a lot of wonky quantitative terms to try to determine how good an idea is, how good a model is.
Yeah, so start off maximum drawdown, and that's just kind of peak to trough, how much a particular model or stock loses in a particular period of time, it really will indicate, especially with when we're talking about our models, what we see kind of looking backwards is the maximum amount that a portfolio loses. We'll also talk a little bit why maximum drawdown is important to investing. Standard deviation, really just how much wiggle you have in your returns. A lower standard deviation suggests more consistent returns with a little bit lower risk. Beta is going to be the volatility in kind of your volatility of your portfolio, your stock, your ETF versus that of the market, and a lot of times it's the S&P 500. Risk-adjusted returns. So, risk-adjusted returns are important for those who tend to be a little bit older, a little more risk-averse. What it is really understanding not only how much you're returning, but how much you're returning per model, per unit of risk. A lot of times you'll see some of these hedge funds with really blown-out returns, but when you adjust them for risk, it's actually quite low. Just because you're taking on the additional risk to pick up those returns, we try to come up with a nice middle ground when it comes to how much you're taking in versus how much you're risking. Sharpe ratio. All that is taking your return that you could get versus a risk-free rate divided by your risk numbers. So that's kind of it's another risk-adjusted metric to understand what a portfolio is returning or stock is returning relative to the risk that you're taking. And then annualized total return, just the average yearly growth of an investment over a specific period of time.
Am I doing CPM?
All right, no, it's CPM. So this is kind of our flagship Asbury's correction protection model, and it kind of the point of it is in the name is try to avoid larger corrections in the market. The S&P 500 over the last 100 years tends to go up. So we built this model with the idea that we want to be in the market as much as possible while avoiding those drawdowns that could really kind of affect your portfolio. We kind of treat it as a dynamic stock bond portfolio. A lot of times we'll see managers or RIAs, kind of have a set it 60-40, set it and forget it type version. We don't really believe that's the best way for investing. We want to take indicators and market internals and have a model that is going to tell us when to be in stocks and then subsequently when to not be in stocks. It's a binary model, risk on, risk off. And when we're trading it in practice, we'll be in the S&P 500, and when we're risk off, we'll be in a cash equivalent like a bill, which is a 1 to 3 month. I think it's now Bloomberg Treasury note, which I think is yielding somewhere in the high threes or low fours.
Yeah. So you can see here just really quickly, these are the risk on and risk off signals. We average annualized over the past 8 years about 5 round turns. So in other words, 1 round turn is risk on to risk off. It's about 5 a year. This looks back 2 years, and you can see does a pretty good job of getting close to the tops and bottoms. Here was the November low of 2023. Here was the April 24th low of this year, and it's got kind of a rhythm to it. We built this to be as least active as possible while trying to capture the big moves.
Yeah, so with that being in mind, CPM averages roughly 5 round turns a year, which is a buy and a sell. No short positions or derivatives. The idea is to be close to the S&P 500, tracking that index, but do so with less risk. It's important for people that are looking to keep drawdowns low, tend to be older investors looking for an ability to keep the wealth that they had without giving it back during the drawdowns, but still growing it. CPM's got better risk-adjusted returns, and we can turn it into an alpha-generating model by using some leverage. And we feel comfortable doing so with the idea that when we're keeping a look at drawdowns, and we add the additional leverage, the risk statistics still say relatively lower than the S&P 500, allowing us to take on, that's that risk-adjusted return talk that we were talking about earlier, taking on a little bit of additional risk, to really outsize those returns. How does that really help, your general trading? The reason we like this is it's systematic. It's not, we don't have any inputs or personal inputs into this model. Obviously, we built it, but we take those signals kind of as they come, and not necessarily looking at the stock market, looking at the line graph of the S&P 500 and trying to pick entries and exits. It's built on the framework of multiple indicators that kind of give us a direction of the market. And I think having that systematic approach allows us to be a little bit more comfortable with taking on bets. Drawdowns. We mentioned drawdowns earlier, and CPM's yearly drawdowns, really, the goal here is to keep those drawdowns lower. Why this is important, we'll get to that in the next slide, but what CPM's allowed us to do is consistently stay under the drawdown of the market. 2020 was a big year in terms of drawdowns. Obviously, this was COVID, with a 33.9% drawdown in the S&P 500. CPM was able to avoid a good chunk of that correction by having a 9%. So why are drawdowns important? Because when you draw down a certain amount, it's not a one-to-one relationship in terms of what you have to then make up in the market to get back to even. Starting down, even with a 10% drawdown, you need to make 11% back just to make it to even. We're talking about that COVID mark, which was somewhere in between our 30 and 40%. If you've got a 40% drawdown, you need to get 67% back just to break even. So again, we tend to deal with a little bit of older investors, especially with our correction protection model, and taking 40% drawdown when you're late in your investing career could really be, a game ender in terms of, waiting just to get back to normal for your money.
Let's talk about the performance, backward-looking performance. Everything is hypothetically back-tested. This is how we build our models. We come up with favorite indicators that I may have had, or favorite strategies that I might have had when I was on the trading floor, or when I first got off the floor in the late 1990s. And then we back test them and we bring in other indicators. If you ever seen the movie Moneyball, and it talks about a guy named Billy Beane. He was the GM of the Athletics back in the 80s. What he did, he hired some kids like from Harvard that were computer and math guys, and they came in and they started to tell him who to draft or who to trade for. And it was like these people that were too slow and too short and too everything that wasn't the stud baseball guys that they were looking for. But mathematically, these guys would do something really well. That, like, there was one overweight catcher that, like, his on-base percentage was 500%. And the guy probably got tired on the way to trying to get to first base, but he was really good at either getting hit by the pitch or taking a lot of pitches. So what we did is we moved that to how we build models, and we will bring in different indicators, like Billy Beane was plugging in these obscure players to build a really strong lineup. So that's kind of that's really, the genesis of what we've been doing here for the past, what I've been doing for the past 20 years. Here's CPM versus SPY. This goes back to inception for us, which is Q4 rather of 2017. And what do you see? You see it sticks like glue pretty much to the S&P 500. Looking back, here it is since 9/29 of 17 through just a couple of days ago, pretty much dead even. Pretty much dead, almost all the way across. What this was meant to do is give an older and more risk-averse investor the S&P 500 with less risk. And here's where we see that. The maximum drawdown in the S&P, this is directly relates to the chart that we just looked at. Maximum drawdown in the S&P during this period, which is 8 years and change, was 33.9. We talked about that. Only 20.2 for the drawdown in the S&P 500. So the same result in terms of the performance, but you're risking less. Sharp ratio, higher than the S&P 500. Beta, lower than the S&P 500. The beta on the S&P 500 is always 1. If something is more, it has more movement than the S&P 500, more volatility, that's the word I'm looking for, like it might be NVIDIA or crypto. something that's going to have a higher beta than the S&P. Something lower than the S&P might be a Procter and Gamble or a utility stock. So you want your betas lower than the market if you can. Standard deviation is lower, 11.9 compared to 16.4. So again, S&P 500 like performance, which with much lower risk. So then you could turn this into an offensive strategy. The guts of a model, of a good model, are what's the difference between how much you risk and how much you make. And that is represented in different metrics. Sharpe ratio is one of those metrics that we mentioned a couple of slides ago. So here's what we did here is we took the CPM, and this is a 50-50. So now all we did, same signals, but now we used 50% SPY. We used the $100,000 hypothetical account to make this chart. So instead of investing all in SPY, we're investing half in SPY and half in SSO, which is a 2 times leveraged SPY or 2 times leveraged S&P 500. And look how these numbers change. So now since inception, 17% annualized performance, again, from Q4 of 2017 versus 12.9.2, let's call it 13 for the S&P. Over 5 years, almost 17 versus almost 14. So we outperformed by 3% a year. The last 3 years, we outperformed by about 2% annualized. And year to date, we're outperforming by a little over 2%. So going all the way back, we're outperforming by about 4%. Here's what the numbers look like. We're still better than the S&P with the risk numbers. The S&P is 33.9 was the maximum drawdown that we mentioned a couple times. Only 31% here. Sharpe ratio, again, considerably higher than the S&P 500. Usually, you'll see this in some of our Sharps. Anything 1 or better in a Sharpe ratio is an exceptional Sharpe ratio. Trying to find a Sharpe ratio that stays over 1 for more than just a year or so is extremely difficult. I've searched it on the internet. There's just not a lot of it out there. Beta is about the same and a little bit higher standard deviation, which means that your P&L is going to be a little more bumpy than the S&P, but not a ton. So what does this mean? It means out the door that I'm still risking less than the S&P 500, but now I'm beating the S&P 500 with still a little bit less risk. To us, we call that, the white whale. If you remember, Moby Dick trying to find the white whale. That's what we do here. Asbury 6 is what I had mentioned earlier. It's a daily indicator. We recalibrate or we update this about 2 hours after the close every day. And we look at 6 indicators. We're going to look at them individually, but we took, again, sort of like Moneyball, right? We took 15 or 20 indicators, I think we started out with, that I've used, through my career on the trading floor, stuff that I use for tactical. And we started to back test them in various groups of 4. When we started this thing, we didn't know if it was going to be the Asbury 2 or the Asbury 10. We just started systematically back testing these together, kind of like a Moneyball thing, and trying to find a lineup that would keep us from getting shaken out of the market. When you wake up in the morning, you sit down at your desk, and the S&P is down 70, you're long and you're freaking out. And now you've lost everything except, oh my God, look at all this money I'm losing. I got to get out of here. This was built for me internally to not do that. And we've made it into a product. 4 or more in the green indicate positive. The market is internally strong. 4 or more negative indicates weakness. The market is internally weak. It's internally weak right now. Let's look at the ingredients of this. Well, first of all, you could see a little bit more information here. We use a monthly rate of change, the relative performance of stocks versus high yield bonds, investor asset flows, volatility, trading volume, and market breadth. You can see from the chart here, it's a lot jumpier than the CPM is. It has about 10 round trips a year, but it's actually a little less risky. What does it take? The max drawdown on that goes 3 or 4% lower than the 20% that we're getting. So it's more active. You got to do more work, but you're knocking your drawdown down by another 4% to get very similar outcome to the S&P 500. So let's look at them individually. This is momentum according to the monthly rate of change. Why monthly? 21 days is a business month. That is what we determined long ago is the tactical time period that we're going to follow. If you're trading, you need to know what your time periods are. Just saying, well, I don't like this 18-day stochastic, so let's look at a 21 or maybe a 31. That's going to, as soon as you start to drift all over the place, you're throwing darts. You have to know what your tactical is. Ours is 21 business days, and what your strategic is. It should be some multiple of that. Our strategic is 63 days, which is a business quarter. Does that mean that we don't want any trades that go up for a year? Of course not. But that gives us kind of like a rhythm between what's tactical and what's strategic. The strategic is what we're trying to capture. The tactical is telling us how to get in and out of that larger trend. So here we are, the first of the A6, the monthly rate of change. It jumped back up hard yesterday. So that turned that particular part of the A6 back, it turned it back to negative. Actually, I've got 11.7 here. I should have 11.10. The reason that these aren't going to match up is we had a signal change. We are now 5 green. So all this happened in one day, and trying to build a slide deck with 40 slides on it, but this is positive now. There's 5 green now and 1 red. So that's why these aren't actually matching up. So this turned green or positive as of yesterday's close, because we had that huge update yesterday with the big gap. If this falls back underneath the 21, it falls back to negative. Relative performance of stocks versus high yield bonds. JNK is one of several ETFs that tracks a high yield bond, the price of the high yield bond. You see when stocks are outperforming high yield bond prices, stock market goes up. That's one of the relative performance metrics that we look at all the time. And you can see pretty much, with just very few exceptions, it's been positive. It's positive now, but it's testing that 21-day moving average. That tells me if the market can't follow through on the upside that we're having today, looking up the screen, the S&P is up 16, these could very easily flop back over down. So I'm not getting too happy here just because we're 5 green and 1 red. We got a tactical point here where we need to pay attention to this. ETF asset flows. It's the AUM, the assets under management that are in any ETF. You can see it's kind of like open interest. If there's any futures traders out there, I think there are. I saw the back part of Sunny's talk. And I know a lot of folks trade, use Equus to trade futures markets. Very, very similar to that. When the assets are expanding on a monthly basis, 21-day basis, the stock market likes that. It indicates overnight conviction in that this particular asset is going to go higher. If you trade something intraday and you're out on the close, you're not really taking the overnight risk. This is showing that somebody is convinced enough the market's going higher that they don't mind taking the overnight risk. So this is expanding, and this is one of the bullish parts of the A6 right now. This is volatility. We look at the VIX, we look at it, and it's kind of a noisy indicator, but if the VIX is above the 21-day moving average, as it was here, we had a little downdraft here, middle of October. We were up for a few days over the 21-day. S&P 500 started to fall. On Monday, as of Monday, we had the gap up on Monday. We're down underneath the 21-day moving average. So volatility is currently positive. This is volume. There's different ways to look at volume. Raw volume to me is way too noisy. I use cumulative volume, which is like on balance volume. It's cumulative, and it you can see we were down here underneath the 21-day moving average. As of October 30th, that gave us all of this. We jumped back up above it, not by a lot. So it back to positive. It's back over the 21-day moving average like it was here, which gave us all of this nice move up in the S&P 500. But if this fails, it's right on that 21-day moving average. This could turn over in a couple of days. So what does that tell me? It tells me as of Monday, the strong day we had Monday, it turned the A6 back to positive, but a lot of these are right on the 21-day moving average. So we need more than just a good day today or tomorrow. If we can't finish the week strong, if we go into Thursday and Friday and start to weaken again, that's going to turn the A6 back down to negative, and we're going to be on pins and needles over the weekend because the market had an opportunity to rise here and there was no follow through. So that is yet to be seen. This is market breadth. We use the NYSE AD line. Look how bumpy it's been. Everything's been bumpy here. It's been a really difficult year. But we had about a week or a week and a half where we fell underneath the 21-day moving average. That gave us this was 4% from the all-time high down to the low on Friday. And then we had the big reversal day on Friday and the gap higher Monday. We're just eked back over the 21-day moving average in the AD line. So again, it's nothing that where I'm going to say, okay, the market's in good shape, I'm going to go away for the weekend. I'm sticking around here because if we can't have any follow through, we're only up 17 here. We have a couple of lousy days between here and the rest of the week. The A6 is likely to turn down. That means the market is getting weak internally, and we start altering how we approach the market in terms of what we're buying and how much we're buying. Turn this over to Jack for sort.
Yeah, so this is our sort partner strategic opportunity radar tracker. This is kind of a top-down thing. Actually, it goes out to our Substack, paid Substack at asburyresearch.substack.com, and this comes out a couple times a week. What is it? It's actually based on a trading principle that we put together. I think we actually wrote an article for Metastock over the summer, a three-legged stool of investing, and it brings together trend, relative performance, and money flows. Actually in that order. So when we're looking for ideas to trade with, we want to make sure that trend is on our side. So, if trend is positive, if asset is trending upwards, making money, that's where we want to be. If it's in a downward trend, we're going to avoid it for now. We're not contrarian investors. Nextly, relative performance. We use relative performance versus the S&P 500 because the reason being is if it's outperforming SPY, we want to be in it. If it's underperforming SPY, we'd rather just buy the market and kind of take our dollars that way. So positive trend, relative performance, and then lastly is money flows. And we take money flows as really conviction. Conviction by investors that they're going to put money into that particular ETF, and then they're going to keep it there. Seeing that growing asset flows allows us to know that now price is on our side, we're outperforming the market, and there's conviction with other investors. And that's where we tend to find some opportunities. The one odd duck on this particular list is crypto. We do not recommend trading crypto, but we do use it as an indicator in terms of risk appetite. When the market is really ripping and it seems that people are willing to take on additional risk, crypto tends to creep up toward the top of this report and flashes all green. Right now, crypto is telling us that there's a little bit of hesitancy on the risk side of things. And as you can see are highlighted right now, commodities, US dollar, and global equities are all showing green. Global equities ex-US. I think we have another chart on this later.
We do.
So sometimes our research magically aligns with itself. But these are the opportunities that we're seeing right now. The way we kind of tell investors is, you can trade those particular ETFs, or again, top-down approach. Drive into those particular sector or asset classes within the market and find things that fit your particular trading style. But we've had some traders tell us that they use this to know that they have some wind at their back if they're looking to put on a trade for a certain commodity, global equities, or in this case, the grand US dollar. Next is our SEAF model, Sector ETF Asset Flows. This is a model that we use to figure out, really track the velocity of money in the 11 sector spiders. It is a sector rotation model. And we do that through calculating the velocity of money in 3 time periods. We got our trading week, our tactical month, and our strategic quarter. Why all 3? A lot of the times I get questions of why we're trading, not just trading on the newest flows for the trading week. And honestly, after staring at these flows a lot more than I'd like to admit, they tend to be a little more whipsaw on a week-to-week basis. If you've been in the sector rotation space or tracking it, you know that over the last 10 years or so, it has really sped up. The trends that used to last quarters are now lasting weeks, and in some cases less than a week, as we see money flow in and out of the sectors. How do we trade this model? We did extensive back testing. We're always in the top 3 sectors. This is like a golf score, so the lower the ranking, the better the score, and we always invest in the top 3. How do we tell our traders to use this? Again, top-down investment approach, understanding that we have money flowing in aggressively in the top 3, knowing that, again, you have some kind of wind at your back, so to speak, and to put on your individual trades. The other thing to use is not part of the model, but what we tell our traders is understand where the money is flowing out of, and places to avoid. This could help you close out a position that maybe you have a little bit of a lead on, or tax loss harvest a loser that you've been sitting on for a little bit because the flows are coming out of this particular asset class or out of this particular sector, and we don't really see any reason to stick in things that aren't working. This is what we call a rainbow chart. So this is how we track each individual sector. Up top here, we have the daily CEIF score ranking. And then on the bottom here, we have a relative performance versus SPY chart.
So it goes back 1 year.
These charts go back 1 year. And as you can see, when we have what we call our favored, when the particular sector is sitting in an upper favored or up in this green band here, we tend to get relative outperformance. When it sits in this avoid band, we tend to get relative underperformance. Now, this isn't a one-to-one relationship. Like I said, we back tested this and we go into the top 3. Just because something is in favor doesn't inherently mean that it's going to have a positive relative outperformance score, but we often see that. On September 9th, we let the Metastock group know that we saw a opportunity in technology, and since then technology has outperformed the S&P 500 by a little bit over 5%. This data is through Thursday of last week. We run this model once a week on the weekends, so there's actually, if I were to track this today, I think technology would be up a little bit middle in the favored area. But yeah, so again, we've noticed that as we see velocity of money go in and those trends tend to stick, we do see that relative outperformance. And again, we have individual traders that use this to operate their individual stock picks for technology. And how it's done. Overall, it's done pretty well over the last, going back to 6/26/2018. It's not a cute number. That's just when some of the data for some of the new sector ETFs came alive. So that's, we just gave you everything that we have in terms of how we've been tracking this. Outperformance of roughly 7%. This is not a model that's going to win necessarily quarter over quarter, but it is going to do a good job of when there is relative outperformance in a particular sector to get you into that sector. Another thing other people have asked us is when CPM goes risk off, does the CEIF model also go risk off? And in that case is no. We often see counter-cyclical or cyclical sectors come in, defensive sectors come in, even during downtrends. I believe it was 2022, the market was, as you can see, the S&P was down and CEIF was actually up. We caught an energy trade that was counter to what the market was. So the market was down quite a bit that year, and I think our CEIF model actually finished up on the year.
Yeah, the S&P was down 19.6 that year, and CEIF was up 8.4. So we outperformed by almost 30%.
The theory behind that is there's a lot of money managers out there that have to stick into the market via mandate. So as we track those asset flows going around the 11 sector spiders, you figure they got to put their money somewhere, and the CEIF model does a really great job of telling us where that money's going. How does it do defensively. That's kind of a theme of ours. A little bit less drawdown historically than the S&P 500 with those exceptional returns. Standard deviation is a little bit less than the market, a bit less, but less all the same. And like we mentioned earlier, Sharpe ratio of 1, historic going back to 2018. It's done a great job risk adjusted. So not only are you performing long term, but you're doing so with a better risk adjusted numbers.
Okay, I mentioned in the beginning that relative performance is a big deal for us. The longer that I do this, the more sometimes you look at a stock or an ETF or even the S&P 500, it could throw you off balance, right? You're up 80 today and you're down 40 tomorrow. I think there's a certain amount of manipulation that goes on in all markets. You've got some very powerful hands that can push stuff around on a very short-term basis. But what you can't push around is a relationship between two different assets. I think you get a much truer and often a little bit earlier indication of what the market's going to do next by looking at relative performance. So this was kind of we showed you some of the models we did. Sort of a teaching moment maybe here is what I intended these next 2 slides to be. So what we've got here is XSD, which is semiconductors. Semis tend to be the tip of the spear in the technology space. Not always, there isn't any always as in the stock market, but typically this is a risk-on place to be. So you can see on May the 7th, XSD started outperforming SPY right here. It didn't catch the bottom, it was about a month late, but on May the 9th, on a quarterly basis, right? So this is strategic for us. As of the 9th of May, it started outperforming SPY. Here's my mouse. And we had a couple of tests of it here, August, September-ish, and now we're right on top of it. So that doesn't tell me what's going to happen next week. Nobody knows that. Everybody wants to guess and forecast. Where's the S&P going to close on Christmas Eve or whatever? I think it's ridiculous. I mean, it's a parlor game. What's important is to understand what the market is doing, what the market's thinking. This is a way to do this. If this trend holds right here and you see the SOX or the XSD or anything that represents the semi space start outperforming between now and the end of this week, early part of next week, outperforming the S&P, this suddenly turns into an opportunity to buy semis, right? Because you're re-engaging an outperformance trend that's been in effect since May the 9th. If this fails, we've got problems now because we've lost our leadership. The next thing I would do is go look at the technology. I would look at the NASDAQs. Are the NASDAQs underperforming too? Because if that's the case, that means you've lost the MAG 7. And unless you can tell me what's going to replace the MAG 7, which is a giant shoes to fill, the market's probably in trouble. This is the flip side of that. This is DIO, which is the ETF that tracks the 30-year T-bond. It's usually a defensive place to be for managers. So when the market's going up, like here, as of April the 23rd, that's when our CPM signal and that's when our Asbury 6 signal first turned bullish after the low that we made on April the 7th. Note that on April the 23rd, the S&P 500, the Dow 30 ETF started underperforming SPY, and again, on a quarterly strategic basis. I want to see the quarterly trend. This is a trend that I'm trying to catch. That's why we're using a 63-day. Look what's going on here. It is starting to make noises like DIO wants to start outperforming. I'm looking up here, and the Dow's up 1.2. The S&P's up 0.2. That's more of this. You're getting more outperformance here. If this turns down, semis start underperforming the market. The S&P is the market to us, and the Dow starts outperforming the market, even though nobody sent you a telegram or or threw off a firecracker in your backyard. Internally, the market's starting to twist into a defensive configuration. So this is really, really important to watch. It's a lot more truthful on a day-to-day basis. As far as I'm concerned, a guy that's been doing this a while, than trying to chase the tail of the S&P 500 every day. Here's another one to watch. This is stocks versus bonds. So we used the 21-day here because I wanted to show you what this looks like from a tactical aspect. But SPX on top, actually, yeah, SPX on top. Down here, we have the relative performance of SPY versus AGG, which is the iShares Core US Aggregate Bond ETF. It's an aggregate bond index. It's been outperforming. I started this just a few months ago to give you a little more context. You can see the chart better. This actually started in April. So it's testing. So far, it's holding that 21-day moving average. When SPX starts underperforming ag, SPY starts underperforming ag, stock start to underperform bonds, that's a problem. That means the market is the appetite for risk starting to abate. Then I mentioned SPDW in the beginning. SPDW is the Spider Portfolio Developed World. All of these have to be a sentence now. It can't be a short name. It's a Spider Portfolio Developed World ex-US ETF. This is the aggregate global developed country stock market minus the US, minus the S&P 500. Note earlier in the year, this actually started in February. From February to basically the middle of June, SPDW was outperforming SPY. That's what I mentioned earlier. Actually, it was Jeff that mentioned that he followed some of our ideas and bought some overseas stocks and did really well. Why? Because the overall developed world stock market was outperforming the S&P 500. That was a great time to go in and look for countries to buy. It hasn't been that since June the 17th, but look what's happening. It got up through this in the middle of October, stayed there for about a second, fell back down underneath, and now we're challenging again. If this starts outperforming, SPDW starts to outperform SPY, the next thing I'm doing is I'm going to the US versus the world model that we built and looking to see where that strength is coming from. Right now, there's some strength coming out of South America. But if that turns, that spread turns, then I'm going to be aggressively looking for overseas stocks to buy. And it's an indirect indication that our stock market is starting to get tired. Here's our ETF trading ideas. The way we do this is everything is systematic. So we look, Jack has built a screen that looks at 6,400-ish ETFs every day at 5:30 in the morning or 6 o'clock in the morning. I have a file on my desk that shows all of those ETFs that have a positive price trend. They are outperforming whatever their peer is. Most of the time, it's the S&P 500 for us. And then finally, the assets under management, are they expanding? If they are, I take a look at those and I look using my experience where the risk reward is. I want to buy something when it's either sitting on a support level or breaking a resistance level. So I've got some risk reward going on there. So you can see we've got a few here going on. Soybeans, believe it or not, there's a soybean ETF. We've got healthcare services. Healthcare is kicking butt today. We have a commodity index. Commodities are doing well. And biotech. And these are some of the recent ones that we had. So we caught gold miners in the beginning of August. We got out three quarters of the way through October, made 31% and outperformed the S&P by 31%. We did a similar thing with XME, which is metals and mining. On October, actually, this one went in at the very end of August. We got out again in the middle of October, 27% and 26% outright and relative. This is IVB. So this is an open trade right now. This is the biotech, iShares NASDAQ Biotech Fund. We bought it on October the 16th. You can see it's outperformed by 7% so far, and it's actually close to breaking its all-time high. It's 2021 high of 177.37. If we break that, that opens up things to make even more money with this. You can see the assets are expanding here in the middle panel, and down here on a relative basis, it's outperforming the S&P 500. As long as these three legs of the stool stay intact, this is going to keep working. Here's how we've done with this particular methodology for 2.5 years or 111 trades. 54% of them were winning trades. Our average winning trade was 5.4%, and the length of that trade on average was 18 days or 3 days shy of a business month. Our average losing trade was only 2.4%, and those last 8 days, which is about a week and a half. So our ratio of winning trades to losing trades is 2.3 to 1, and our winners, and we have 54% of these are trades that are profitable. This, if you're building a system, whether it's a day trading system or whatever it might be, you need to have more winners than losers, and your winners need to be bigger than your losers. Then it's just a matter of how much, in terms of how much money you make. Our Sharpe ratio on this is a ridiculously high 1.7%, and our maximum drawdown here has been tiny.
Negative 2.8.
Minus 2.8 is the biggest drawdown that we've had. So you can trade these ETFs with extremely little risk, which means you can maybe make your size of your trades a little bit bigger. But this is the thought process that we use, that you should be able to take and transfer over to whatever you're doing. If you don't have these pieces in place over time, you're not going to make any money.
And then, kind of wrapping this up, what we did is, like I said, or we said earlier, we're managing money for both institutions and individuals. We were doing so through some model portfolios. And what this is really us trying to say is, how we sleeve up our different portfolios to make us. I think we've been using the analogy of making chili lately. So Asbury Aggressive is going to be using a little bit of leverage in that portfolio, and it's going to lean toward those who are willing to take a little bit of additional risk. Now that is, additional risk also is relative. So, all these portfolios are still less risky than the S&P 500 when it comes to some of the drawdowns and standard deviation metrics. And then on the other spectrum of things, we have our ultra conservative model. That's a model for someone that's taking a sleeve of their money that they want to really protect the capital. Over the last 7-8 years, it has only had a maximum drawdown of 10%. Now this one trails the S&P 500 by a couple of percent. But for those of you maybe saying that a bond is not enough juice for yourself, this is something that you can kind of align your portfolios with to still keep up with the S&P 500, but keep your drawdowns exceptionally low.
Year to date, 3 of 4 of these are outperforming the S&P with less risk. Asbury Aggressive, Balanced, and Conservative are all outperforming the S&P with less risk. Some have a lot less risk, some have a little less risk, and the ultra conservative, like Jack said, trailing the S&P by a couple of percent. But the maximum drawdown that it had this year was 6%, and the S&P drew down 19. So for those that are older or just risk averse and don't need to beat the market every year, it's a really good choice.
Yeah, and this is just a simple chart. It takes 2 of our models, portfolios, our Asbury Balanced in green and our Asbury Aggressive in purple, and kind of highlighting what they have been able to do by diversifying between the different strategies. Versus what AOR, which is in orange. So that's a 60-40 stocks bond allocation. So for those of you who have their money managed by an RIA or have a portion of it, a lot of times they'll be in a 60-40. And in blue, we have the S&P 500. So our models are less risky than the 60-40 portfolio, often less risky the S&P 500, but allowed through the various indicators, various models, various dynamics of how we trade, are able to outperform the markets with less risk.
So you can see what we're doing here. We're a little different than some of the day traders. We are, I would say, we're short to intermediate term tactical traders. And we're trying to catch the white whale, which is outperforming the S&P 500 with less risk. That's what all this is built upon. I'm an older guy, as you can tell, but after doing this for a long time and banging heads on the trading floor for a lot of years, to me, this is a very safe, logical, data-driven way to participate in the markets and still be able to watch your drawdowns. What kills people are the drawdowns. The market's been going up for 100 years, and it's going to go up for another 100 years after we're all gone. What kills people and knocks them out of the game are drawdowns. So that's kind of what we do. We have two different subscriptions. We've got a premium subscription that includes all of our models and some one-on-one time with us via Zoom. It's expensive. It's $1,800 a year. We have a Substack, which is kind of an entry level. It's $25 a month. You can see it down in blue on the bottom. It's asburyresearch.substack.com. And there's a free version there. So if you like what we're doing, sign up for the free Substack. It won't cost you a penny, and you can get more familiar with us. Or you go to the YouTube channel. It's Asbury Research YouTube channel. A lot of stuff there to learn more about kind of how we look at things. We also manage money for both RIAs, for money managers, professional money managers, and for individuals. For individuals, $250K for our minimum investment, 1% annual management fee up to $1 million. We use Charles Schwab, and there's Feeding the Lawyers. And if you want a copy of this, asburyresearch.com, go to the contact tab, and we will be more than happy to, I know we kind of whipped through this, more than happy to send it to you. Jeff, we got like 1 minute left. I don't know if there's any questions.
Where's my mic?
It's good. You scared me. I thought you fell asleep.
No. I don't have any questions. Great job as always. Thanks for coming in here and spending some time with us as always.
Happy to be here, Jeff.
All right, let me go ahead and do this. I'll turn my camera on. You guys look great. Okay, let me share my screen as well. All right, big thanks to John and Jack Kosar. Really appreciate them coming in. Always like to kind of get their look on the market. Very, very different, very unique. Thanks again, guys. All right, let me go ahead and do this. As we kind of transition to the next speaker, I want to say thanks to all of our speakers so far. I also want to say thanks to the tradersforum.com for being a sponsor of the event today. If you join the tradersforum.com, which you can do for free, you can chat with other traders about the markets, about the stocks that you like. You can learn about markets. You can learn about technical indicators. Ton of information about traders, or a ton of information up there about candlestick patterns and indicators. It's a growing library. It's also a growing forum of people. I think we're up to about 1,300 or 1,400 members. Membership is totally free. You're welcome to participate. I get some good ideas up there too. thetradersforum.com. So I hope to see you there. We are, of course, Metastock. And Greg, you know what this slide means.
I do know what that slide means.
Let me go ahead and get ready for it. It means it's prize time. So, Greg, while I kind of figure out what prize we're going to give away, why don't we do the spiel about why they should register so they can be eligible to win prizes? I just pulled a brand new list too, by the way.
Okay, well, if you're watching us on GoToWebinar, you've already registered. That's why you're on GoToWebinar. You don't need to register again. Registering more than once isn't necessary. It doesn't increase your odds of winning. In fact, I don't think our system even lets you register for more than once. If you are watching us on YouTube, then you can go to metastock.com. There's a big banner right at the top, a big yellow banner. Select that, register, and you will be good to go. And I think that covers it, Jeff. Did I forget anything?
No, you did great. I give you 5 stars. A solid 5.
I should point out too that I've had to. We're moving the studio here, so I've already packed the studio lights, so a little darker and somber than I'm accustomed to being.
Well,
but go ahead. In a very somber and dark tone, I will give you the winner of the prize.
I would like to. Okay, so we're going to give away Norm Hallett's course. It's a $1,300 value. It's called Their Money, Your Profit: Cashing In on the Prop Trading Revolution. So that's what we're going to give away. And with the new list, I need you to give me a number between 2 because there's a header row, and 5,929.
Okay, according to Google Random Number Generator, that number is 4,527, favoring the late enrollees. 4527.
That is Cherry M. And Cherry, if you have
Congratulations,
the
Cherry.
word bonds in your AOL email address, you probably just want a prize. Let me go ahead and put you over here. We'll make a note of that. Greg, thanks for the assist.
You are welcome, sir.
Okay. All right. Here we go. Wanted to remind you, too, we're Metastock. We've been rated the #1 software program in our price category for 32 years in a row. We've talked about scanning, testing trading ideas, forecasting price action, getting real-time alerts, commentary signals. It's a great platform. It's something that we've developed and designed since the 1980s. Special that we're doing is if you just want to try, we're doing all kinds of specials on all kinds of products that we offer here. But if you just want to try Metastock, if you buy a month, we'll give you the second and third month for free. You'll run it all the way through the holiday season. You'll probably have some downtime to kind of go through the training that's included and really kind of play with the program. If it's helpful for you, you're going to keep it. And you can get 3 months of Metastock at the low price of $75 per month. So like $25 a month to try it out for 3 months. So you can do that if you go to metastock.com/conf promo. If you want to get more if you want it's only going to go worse from here. We got like 3 more days. If you can also go to metastock.com/sales chat. If you have questions, you want to get more information, you can call us at 800-882-3040. So there you go. Next guest is going to have objectively, indisputably, undeniably the best accent of the day. So his name is John Seville. John's a good friend of Metastock, a good friend of mine. I really kind of like, I remember one of the earlier times, and I talk about this every time I introduce John, but I remember one of the earlier times I was talking to him, I'm like, why did you name your company Acorn Wealth Corp? And one of the things that he said is, I want to grow traders from acorns to oaks. And I thought that was really, really cool. It kind of stuck in my head. And now I've probably told it 50 times or so. John, let's get you started. Hello? Not this again. Okay.
So to be clear, Jeff, I also cannot hear John, although I see he's there, and now he's muted.
Now he's unmuted again. But I hope he can hear us. This happened already today. This sounds like deja vu. Okay, John. If you can hear us, there's a little bit of a mic button. You can click on it. Next to it, it'll allow you to go to the audio settings. And Greg.
Yes, sir.
Yeah, I'm not. I'm hoping this doesn't turn into the ordeal it was last time. I can see.
I'm also hoping that.
Dude, you are so dark.
Yeah. Again, I don't mean to bore the audience.
John can hear us.
John says he can hear us. That's good to know.
So we can send it. John, if you have a mic, I'm going to plug it back in. Try that. That's usually the biggest way to help it.
Yeah. Also, while he's doing that, Jeff, if he wants to go to the settings to make sure that the microphone in his new GoToWebinar settings is set to the microphone that's on his system, that would be helpful. Yeah. Or he could, John, if you're listening, if that doesn't work, you can just close out your browser and log back in.
Yeah. Yeah. Both of those are good things to do. Wow. All of those are good advice. Good kind of troubleshooting trips. Theodore wants to know, is Metastock available for purchase?
You're asking me that? Or asking, was that a hypothetical? If Metastock is available for purchase, can you hear in the forest?
Yeah. Actually, you can. I think I heard John. No, you can purchase Metastock as a one-time cost. Pricing on that starts at about $4.99. And there are other options, right? Is a one-time
If you'd
payment.
like to go ahead and give John a call on his cellular phone.
Yeah. I'm looking for his number right now. John, if you have
Yeah.
the chance, send me an email or send me a phone
While
number.
you're doing that, I can share with the fine folks at home that we are doing a current poll on YouTube, and the question is, what will happen in the markets this holiday season? A Santa rally or a Grinch fizzle? Jeff, which do you think is winning out? Oh, I'm sorry, Jeff is gone. Oh, I'm sorry. I get the whole point of this is for you to go help John, so I apologize. Go ahead.
I can bet it's a Santa Claus rally.
Currently, the folks that are watching us on YouTube say 64% say it'll be a Santa rally and 36% will be a Grinch fizzle. I have to admit, we've done this poll countless times, some iteration of this poll on YouTube, and almost without exception, I don't think the audience has ever guessed towards anything bearish when we talk about the market, generally speaking, under whatever conditions. So we apparently have a very optimistic audience, which is not bad, I suppose. Hey, while we're waiting, why don't I take a second to, let's me get over to the right screen. And one moment, please. Okay, I'm going to go ahead and share my screen. Again, we apologize. This is the second time this has happened today. Just so you know, we are dealing with a new interface at GoToWebinar, which could be part of the problem. We're not honestly sure. But while we're discussing this, I can tell you that while we're waiting for Mr. Seville to come on, we do have more presenters this afternoon. Currently, again, we're waiting for John Seville, who's going to talk about market mayhem, the one pattern that shows up before every big move. You wouldn't know it yet because you haven't heard his voice, but John is coming at us from Australia. So that's why Jeff discussed his accent. John is also the founder and CEO of Acorn Wealth Corporation. Coming up after him is I would say a market, what's the word? I can't think of the word. A pillar in the industry, Mr. Larry McMillan. Larry's been around for a very long time. And he's going to talk about what McMillan option-oriented indicators are saying about the market now. After Larry, we have Buff Dormeier. Buff is considered the industry, again, can't think of my words. He's really into volume. He's the industry expert on volume is what I'd say. And he's everything volume. And if you have a question about volume, oh my word, stay here for Buff Dormeier because he has a lot to say about it. All right, I see now that Jeff is still online, but John is not yet online. So again, we are here on day 2 of the Metastock Traders Conference, and we are waiting right now for John Seville to come online. And we do again apologize for this technical difficulty. I'd like to point out that we do have 5 days of this and 40 or so presenters. And again, a new interface that GoToWebinar has just provided for us. And GoToWebinar generally works okay for us, but right now it appears to be giving our partners a lot of pain. Tomorrow's presentations will include Mr. Dan Pastorelli. He'll be talking about winning with momentum trades. And then we have Price Headley, our very own Scott Brown, president, founder, and CEO of Metastock. Well, he's not the founder of Metastock. He currently owns Metastock. He will be talking about our forecaster, which is a great piece of software we came out with about 10 years ago, and it's still patented, and it's very interesting, and I'm sure you'll love to hear about it. Then after that, we have Rahul Arora. He's on the market trading wins team, and he'll be talking about his new velocity trading system. After that, we have Melissa Armo. She's a commentator coming out of New York. She's always interesting to listen to, and she'll be talking on trading on the side of institutional money and gaps. I know Melissa typically talks about not being afraid to short and to trade the market both ways, and I tend to agree that's probably not a bad thing to do. Then we have Jeanette Sims. Jeff, how are we doing over there? All right.
I cannot,
all right, then next.
I cannot get John on the phone, so.
Well, he's also dropped out of, excuse us, folks, we're trying to get John Seville online to do his presentation. He's also dropped out, Jeff, of the room altogether. There he is again. John, can you hear us? John, we see your mic is on, we see you're in the room, but we cannot hear you. Jeff, I'm not sure how you're going to handle this.
Testing. Can you hear me?
Yep, that's better.
Hello, hello.
I can hear him now.
Oh wow, that was like I've used GoToMeeting for 15 years and I've never had that much difficulty. I'm not sure what happened there, Jeffrey.
Well, I'm glad you made it. I've been trying to call you. Did you actually end up rebooting your computer, or do you know what you did to fix it? Because we've had this issue another time today.
Yeah, well, GoTo has upgraded their software, and I tried 7 different times to join using the app, and it wouldn't load the app without signing in. But because we deactivated our account and moved to Zoom, it wouldn't let me sign in, and the microphone wouldn't work through the web app, so I had to sign up and pay for a GoToWebinar account to join this meeting, and then it let me in.
Oh, good. Well, geez.
I whipped out the credit card and signed up for GoToWebinar to get my microphone to work. So there we go.
Oh, I would make sure you get a refund, John. But we can hear you now, so that's good.
Yeah, well, that's the important thing. All right.
You should be able to share your screen
diagnose later.
At the very bottom.
Wonderful. Okay, so let's just thanks for everyone for sticking with that process. And
at the very bottom of the screen, John, there's a button that says share in the bottom middle.
Okay. Wonderful. You should have me now.
Well, it's showing that you're the presenter, but we cannot yet see your screen.
Can't share your screen. We apologize, but we're experiencing difficulties with the video conference and are unable to share your screen. Let me try this again.
Well, that's unfortunate.
Okay.
It has one job. Oh, there we go.
Yeah. Okay. Hey, there we go. Hooray.
Oh, wow.
I've never been so relieved to see John Seville.
Yeah. Well, that was interesting. So we'll diagnose that another time, but we'll dive right into things. Thanks for the introduction, Jeff. And yes, I am from Australia, and Acorns to Oaks is of course what we started out doing. In fact, Acorn just turned 18 years old last Thursday, so we've been turning Acorns to Oaks for almost going on almost 20 years soon enough.
Right on. Okay, it's all yours. We can hear you. I'm not touching anything except for I'm going to turn the time over to you.
Thank you very much. All right, guys, let's dive right on into things, and thank you for your patience. So yes, as Jeffrey mentioned, we've been around for a while. I'll skip over the lengthy introductions. Jeffrey already did a wonderful job as Metastock and everyone there always does. We've been around again since 2007, so we're not new kids on the block. We're the old dogs. Trained over 7,000 students in the tactics and strategies I'm going to share with you today. But it all comes back, especially in markets like this, to ensuring that you've got a playbook, strategy, and now more than ever. So if you take a look at what's going on, this is a critical time for this for what we're going to be going over today. Before we jump in, real quickly, this is for educational purposes only, not a recommendation to buy or sell any securities discussed. Acorn Wealth is not a registered financial advisor in any jurisdictional province. Always be aware of the risks of trading. Before taking any action, or speak to a registered financial advisor. Any stocks discussed are not recommendations that are suitable for you or tailored to anyone's individual risk performance and profile. However, these may be stocks that are being held by myself, Acorn Wealth, or the employees and contractors of Acorn Wealth, or positions we're looking to get into. Any returns discussed not guarantee future results, and I think that covers it. Just to fast forward, so this is what's going on in the market right now, which is a lot of what I want to speak about here at the beginning is built around is a lot of turbulence. Right. I mean, right now, the stock market, and for the last several months, has been experiencing one of the most volatile periods in history. One day it's surging, the next day it's plunging, and that is enough to make even experienced traders nervous. But when you start understanding, the right patterns or key patterns to be looking at, and the signals behind them. Volatility isn't chaos; it's opportunity. So the key is being able to see where that opportunity lies, and of course get rid of the noise in between. So I was hearing the end of the previous speaker just talk about a few things they were saying, but I want to get a gauge for everyone in the room right now, whether you're joining from YouTube or whether you're here in GoToWebinar. What do you think the market's going to do next? And I mean next as in, in the immediate few weeks ahead, and even into the end of the year, if you have a viewpoint on that. Type it into the chat box, type it into the Q&A. Where do you think the market's going to go next? Boom, bust, or not sure? And as you type that in, typically when I ask this question, we normally have about 60% in one direction, 30% in the other, and usually 10 or 20% of people not sure. Over these last couple of months, that trend is, in the audience certainly, has become far more divergent. A lot more people not sure, and a pretty even split within the audience of people saying, "Oh, I think it's going to go up," and an equal amount of people saying it's going to go down. And so, as an educated group, right? I mean, you're all here. You're hopefully many of you have got some technical skills. Others probably more advanced. The fact that there is such a big discrepancy and the level of confusion in groups like what we have today says something in itself. So far, again, I'm seeing boom, bust, not sure. Yeah, so similar trend today. Earlier in the year, in fact, when we were here in the Metastock event last, and in other events that we've done previously, for those of you that follow our Acorn material, this is something that we've been covering quite a bit. And let me just take you back to the middle of the year, back when and of course we were back here in Metastock in September, and also prior to that. What we were looking at was, how do we get down to the truth of what's going on in a market full of noise? And so one of the first things that that I wanted to share with you once more here, in case you missed some of those previous events, was a way to look at the market that dives deeper beyond the headlines and into what the truth of the data may be screaming from behind the scenes, hiding in plain sight, if you will. So this is the S&P 500. And when most people talk about the S&P, or certainly when most people talk about the market, the market's up, the market's down, where will the market go next? Well, firstly, what is the market? What's the market that people refer to, that I was even just referring to earlier? Well, a lot of people would consider the market being the S&P. And so if you take the clocks back to June, July, August, what was the market doing? Well, the market had reached all-time record highs, around 6,500, and climbing higher at that time. But I'd like to challenge this view of the market, because it's distorted and it doesn't necessarily tell us what's really going on. In my opinion, it's misleading, right? My partner of 11 years, she even said to me just the other day, she said, "Johnny, I thought you said the market had been going back up this last week or so. How come my retirement account, how come my TFSA, tax-free savings account, and my RSP is going down every day? Well, what's going on?" And how many people in the room have felt like that in these last few months, watching the market go up, but watching their accounts go down? right? Put a 1 in the chat box if you've experienced that. Well, let's dive deeper of what the market really is, and this is a different way to look at that, and that's through the lens of RSP. Now, by quick show of hands, pop in the chat box the number 1 in the question and answer box. Put the number 1 in if you are really familiar with the difference between RSP and S&P and look at it already. Put a 2 in the chat box if you're not. Okay. So when we look at RSP, this is what I call the real S&P 500. Why is it the real S&P 500? Because it's the same exact 500 stocks. But in the traditional S&P 500, those top 8 companies account for well over 20% of the value. Right? So those top 8 companies are much more heavily weighted. And it always reminds me of the George Orwell Animal Farm quote. So all animals are created equal, but some are more equal than others. In the S&P traditional index, what those 8 companies are doing is far more important than the other 492. Right. So what the RSP does is it's the same stocks. However, all 500 stocks are weighted equally. So it shows us a truer representation of what all of the stocks in the S&P are actually doing, and therefore that's where it gets its a fun name for me of the real S&P. And so when the value in this, why is this important? Well, if you take a look at these 2 side by side, as we went into kind of the July-August period. And I'll show you why that's relevant to now in a moment. But watch how the story's unfolded. When you look at the S&P on the right, it was at all-time record highs. And that's what all of the news and all of the emotions and all of the news pundits are going to be talking about. Market breaks record highs, da-da-da-da-da, blah, blah, blah. But the truth of the matter was that the market hadn't broken higher at all. The real S&P hadn't broken out at all yet, right? So that's the first thing, understanding where the market's really at. And then secondly, understanding the insight it therefore tells us about where the bulk of stocks, those 500 companies, are actually likely to go next. And so because RSP was trailing behind, that meant that there was a lot of room to fill, a gap to fill. When we dived deeper into looking at the price action and the pattern, the S&P had been going down 1, 2, 3, 4, 5 days in a row, straight down. From 6,500 to 6,400. I think it was about 5, 6, maybe even 7% decline in those 5 days, which creates what? Creates panic, creates the fear-based selling, reactionary selling. But over those same 5 days, we looked at the real S&P 500, and we saw that it was actually going sideways, if not up. Same 500 companies. But one screams bearish, panic, sell, and the other, same 500 companies here on the left, say bullish, buying opportunity. And so I wanted to really focus on this as an example of how sometimes even the same data through a different lens can call for a completely different best course of action next. And this is why we really need to be looking at the data through that right lens. What does everyone think so far? Put a 5 in the chat box if this is all making sense. Yep. So this downward channel, you can see these 2 little blue lines here. A downward channel indicates a likely break to the upside is imminent, is about to occur. That's what makes a downward channel a bullish pattern. And so instead of selling into that drop, as I'm sure many people did, got caught, we bought into that pullback. And of course, the result was in the very next day, RSP, the real S&P, did break out bullishly and has held above that ever since. Right? And we're going to come back to this in terms of what key levels we're watching now. However, let's just go back to that key piece of information, looking at the right data, looking at the truth in the data, which I think is really what we're looking for as traders. The difference for me, and again, I'm not suggesting what you should have done then. I'm just going to talk about what I did there. In my portfolio, in the Interactive Brokers portfolio, we bought into that weakness. And even as the S&P was still going down on that Thursday, that August Thursday, those stocks were going up $1,823. On the Friday, when the real S&P broke out, it's up $4,300. So it's about a $6,000 plus difference, right? Versus selling into the drop and erasing gains and selling at the worst possible time. That one key piece of information. Let's peel back the onion layer further. What types of stocks would we trade? This is where you're going to start seeing my favorite strategy for these kind of markets evolve here. Well, two of the first examples we'll share is XFOR and TLS. These were the two specifically bought in that time frame. XFOR being the best of the two, 1,100 on the Thursday and 3,000 on the Friday. Why those? Right? Well, let's dive into the charts. And this is where you're going to, it's my first introduction, if you will, of my absolute number one favorite go-to strategy for markets like these. In any market, really, but specifically when you've got markets of uncertainty and heightened levels of risk. And this is called the Smart Surge System, or SSS. You can see it here in the Metastock chart, and this does work on other platforms as well, but we've got a Metastock chart here, as you can see. So SSSH, which means high conviction. SSS, bull signal. That's what that green arrow means. So this had been alerted there in the scan in early August, just hiding behind the logo there. Early August, 1, 2, 3, 4, 5 days in a row. And a smart surge is something very special. We're going to get deeper into exactly how it works in a moment. But it's looking for, in a nutshell, it's looking for stocks that have the potential to outperform the market. Stocks that are marching to the beat of their own drum. Right? So we're not looking to trade the market. We're looking to find those diamonds in the rough. And we felt that XFOR, well, the strategy, more importantly, was identifying that it had the qualities of exactly that. Based on the rules of the system, that called for an entry just above 350 with a preset target of best case outcome of this system all the way at the top of that gold or magenta line, whatever the correct terminology is for that color, just above 450. So the trade setup here, based on the Smart Surge system, was buying on the breakout with a peak expectation of here. And for me, I always like to go on the conservative side of that. So tell me what the best case scenario is. I'm going to go underneath that. So given that you can see this double top from back in early June at $4.50, we set our target, our first target, just underneath that level. So this is the first introduction of how we trade this setup. And so there it went. So XFOR shot up over 1, 2, 3 days from entry to exit. And I had 3,500 shares, which then sold at $4.43. So there was the Thursday, the Friday, and then the Monday following that. Right? So 3,500 shares at around $3.50, just a little bit over 10 grand invested for a $6,500 profit over those 3 days of the trade. Now, even though I got out at $4.43, being the more conservative approach for me, you can see, however, it did continue on all the way to that maximum target, almost to a T. It hit it pretty much bang on. Okay, so that shows you kind of the first introduction to my favorite strategy to trade these markets, but it goes deeper than that. So that's what I would call a swing trade. You know, anywhere from a 3-day hold to a 3-week hold, would consider a swing trade. But if you are more longer term or looking at, you know, more investments or things that more than just a 3-day to 3-week outlook, it works extremely well for that also. In fact, you can also use it even in day trading. But let's go the other way first. What about a longer term hold? Does it have more than just this, you know, pop from 2 to 4? Well, let's zoom out to the weekly chart. So here we are on the weekly chart of XFOR, and pay attention to this because I'm actually going to show you a trade I've got programmed in right now on this setup. In fact, I programmed it in just very recently. So firstly, we've now zoomed out from the daily, where the smart surge had been detected in that time frame, and in this case, it also qualified on the weekly as well. So, so there's the smart surge, if everyone can see that. And here's the weekly time frame. Okay, so daily to weekly. So notice here, let's start here on the daily. Do you notice how after this target has been hit and the profit's been taken, now we're, well, firstly, look at what happened to the stock afterwards. The move had been exhausted. The setup was over, it hit the target on the head, and from there, pulled back from $4, whatever it was, almost $5, all the way back to $3. Now, that's not because the stock is a bad stock. It's just that it had already gone up over 100% in a matter of a couple of weeks. It was overbought. It needed to cool off for a bit, right? And so it goes back on the watch list while we wait to see if a new trade develops. And while that cools off and consolidates, the characteristics and the shape of the chart evolve. And you can see that really, really nicely then when we take a step out to the weekly chart. And as we do that, what you can see is that this wasn't just a smart surge on the daily, but we've also got the weekly signal 1, 2, 3, 4 weeks in a row after that, that first initial move. So why is that important? Because when you have, firstly, a smart surge is very rare. We find in the 8,000 stocks roughly that are scanned every day on a daily time frame, you're typically going to find about maybe 5 to 8. 5 to 8 out of 8,000 a day. So it is not common. It's very special. We want it to be that. We're looking for quality over quantity. And so to find one that is also a smart surge on the weekly chart is even rarer, even more special, of a 1-2 punch. And so what does this indicate? It means that on the weekly chart, much like we had our original setup here for a breakout above 350 up to 5, we've now got potentially that same setup occurring in that longer term view. Okay, so if you want to take a guess here, if you've been following along, what do you think the trade setup would potentially be based on just a 30,000-foot view of the rules so far? Where do you think I would want to get in potentially? Where would I buy it? And where would I want to sell it? Type it into the chat box if you want to take a guess. There's no wrong answers, right? The entry I'd be looking for, based on the rules, would be buying a break of the Smart Surge system, the blue line, which would be just above 450. And my target is going to be just under $7, right? So in fact, and this gets now down into execution, that's exactly what I've got programmed in to my account. This is just a screenshot from just prior to market close. So what I've got here is I've got a set and forget trade on XFOR. I've got my account number hidden there, of course, but you can see I've got a bid for 2,000 shares to buy that if it goes above $4.56. There's a buy stop. So if it goes above 456, buy it. Don't pay more than 459. So I've set it's a buy stop limit order. What price to start buying and what price to not pay more than. And that's set and forget. So that could happen tomorrow. It could happen next week. It could happen a month from now. The strategy is now watching it to do the execution piece. You can see I've also got my target pre-programmed at $6.93. And also you can see I've got my stop loss pre-programmed at $3.93. Right? So I've got essentially about just a little over 50 cents of risk for $2.30 of potential gains. Let's just call it 50 cents to $2. Right? So I've got a risk-reward ratio there of risking 50 cents roughly to make $2. That's a risk-reward ratio of 4 to 1, or risking 50 cents to potentially make 2. 4 to 1. Right? So you can see, I just wanted to dive straight into the deep end and go from looking at the market to then the strategy that we would then look to trade, and then how we would actually execute it all in one. So now, as Jeffrey said, I'm in Australia, so I'm sleeping when the market's open. Right? I get up just as the market's closing, and I'm going to sleep long before it opens in Australia time. So all my trades, even when I'm in Canada in the States, which is most of the time, are programmed in this way. Make sense? Stephen, I do see your comment, by the way, coming into the question. So wherever you typed that, that's the place to type it, into the questions box. So let's go to some of the other ones. So TLS was another one. That was the other one there on the trades of that day that I'd shared with you. Same thing. Smart surge, 1, 2, 3, 4, 5, 6 days in a row. consolidate, boom, breakout, right? So an entry around 3, that surged up to 6, and then in fact higher. I got out of it somewhere around here. In fact, I'll be able to show that for you in a moment. But why was this one special? Well, it was not just a smart surge on the daily, it was also a smart surge on the weekly as well. On TELOS, TELOS. If you want to see how that would look in a different platform, there it is in TradingView. Right, smart surge on the daily, 1, 2, 3, 4, 5 days in a row. Smart surge as it broke out. Smart surge on the monthly. Smart surge on the weekly. All 3 time frames, in fact. So once again, let's go back to management. So once a trade, in this case, these were both winning trades. Not every trade is going to win. Not every trade has to, right? The key is risk management, right? So on top of having a predetermined entry, a predetermined target, and a predetermined stop, managing risk as things go along is also important. So this is a screenshot I took at the time of this portfolio while I was holding TLS. And just, in fact, you can see this with every other position. Every single position here has a predetermined stop loss and a target. And so we're focusing on TLS here, which you can see I bought at $6.03 on that entry. You can see I've got a predetermined target of $7.43 for the 2,000 shares I was holding. And you can see my stop loss at $5.73. Right, so as it continues and goes up towards that target, what we'll do is a little bit of partial profit taking. So as you can see here, the stock had jumped to 681, up 12% roughly from the entry price. So as you can see, I've gone from 2,000 shares to 1,200 shares, selling 800 shares to take some profit, right? Instead of being greedy and thinking, oh, I could go to 50, well, maybe it does. But what will allow me the comfort and confidence to hold for potentially bigger gains is by making sure I've protected my nest egg first, making sure you pay yourself first, right? So by selling 40% of the position at a 12% profit, I've now got already a profitable trade. But more importantly, or as importantly, I've also raised my stop loss to 619, which is above the entry price. So I've taken a profit and I've moved my stop loss above what I paid for it, protecting the rest of my position and the rest of my profit and original capital all at the same time. So while I love talking about the potential of this strategy, because it really is very, very special, and while I love talking about the market, what makes a strategy different from just an indicator or a bright shiny object is making sure you've got all of those pieces in place, from being able to know what to buy through to when to buy it, when to sell it, and how to manage the risk on the way through. All right, that's something that I think is certainly been a big part of Acorn since we started almost 20 years ago. And this is what we teach. In fact, I've got a very special offer for you that I will share with you here at the end. But just to come back to what we were saying earlier, why is this so important in the current market conditions? Well, because currently the market isn't very good, right? If you're talking about the broader market, it's very choppy, it's uncertain, and so what we're looking for are these very unique kind of opportunities that have that capability to thrive on their own, either bullish or bearishly. So just to go back to that context of the market, if you look at the RSP, ever since we broke out bullishly back in August, it really has struggled to go anywhere since. It's holding above that bullish support line that's been in place ever since July. It's holding above that, except that little dip here. But otherwise, it's in a sideways range. And you can see the top line and bottom line here that it's just been dancing back and forth between over these last 3 months. So in a market, in a directionless market like that, being able to find setups that are marching to the beat of their own drum and have the ability to move aggressively in a short period of time, like the ones I've shown you, is a real asset. Put in the context of the broader market, we're also, this is going back to the S&P, we've also got this overhanging risk of this kind of bearish upward channel on the S&P index. Going even broader to that, if you go back to 2020, over the last 5 years, and look at the Russell 2000, there's more risk and concern that you should see there. Right? When you look at the Russell 2000, you can see that we are right up against 5-year resistance. If you look at the chart that's been in place since 2023, which is also an upward channel, you're against that resistance point at the same juncture. So there's a lot of headwind and a lot of risk in the market at the moment. And so am I interested in buying the stock market at the moment? Absolutely not. Not at all. I've got zero interest in trading the stock market, but I do have an interest in trading smart surges. And that's what we've said for 20 years, right? We don't trade the market, we trade strategies. And so stocks like this are another great example, right? Stocks that have the capability of doing something special. This is an oncology company. It's one of the reasons why I like pharmaceuticals and biotechs, because if they do something right, something really right can happen, right? Regardless of what the sector's doing, regardless of what the market's doing, these stocks have their own story to tell. And when you combine that with things like the smart surge, which kicked off here just a buck with a target of 2, first target of 2. These are exactly the kind of things that I'm looking for and actively buying still. And this was shown in wealth charts, if you want to see how that looks again on another platform, on both the daily and weekly time frame. So, and there's the alert on it from back on September 10th. Potential entry at 128. First target 193, second target 493, stop signal 94 cents, risk reward 191, second risk reward 10 to 1. And again, this isn't financial advice, it's up to you to make your own decisions. But it's there to help show you what the rules of the strategy would dictate and see if you find a trade that you like. That was one that I took, and as you can see, rallied up, hitting its target, first target on whatever day that was back in October. Late September. So just to fast forward, because we had some technical difficulties, we can come back to some of these, but let me just fast forward a little bit. And to the core of how this pattern works, because this is the engine behind all of this. This is what really makes this work. And so let's talk about what the Smart Surge system is. And as I said earlier, it's my #1 go-to setup for volatile markets. So what is it? What exactly is it? The Smart Surge system is, in simple terms, a pattern when a stock makes a very powerful move or a surge in price, coupled with unusually high volume and clear, strong momentum. It's like the stock is yelling, pay attention, because something big is happening behind the scenes. And so usually you'll see an initial sharp price move, which could be up or down, because it works to both directions. Then a brief pause or consolidation, kind of like the stock catching its breath, and then another strong move in the same direction. So it's that second wave, backed with heavy volume, that's the tell. That's the moment we say, we have a trade on our hands. The odds are now in our favor for a potential sustained run. So think of it as a 1-2 punch. The first surge gets it on your radar. The second surge, with all the smart money volume behind it, confirms that breakout, and that's the trade. That's when you got that on that second surge. That's our entry, and the potential high probability trade on your hands. So again, going back to with that in mind now, let's go back to some of the other ones. Now this is going into the more speculative side of the market. Some of those other stocks were high volume stocks. Teed up when we found it here in the scan late last year was just a small stock that I'd never even heard of before. Now, typically I would have no interest in anything under $2 or even under $10, but with a smart surge, it's a bit different. We are looking for those sometimes diamonds in the rough, those hidden gems. So teed up I'd never heard of before when it was alerted on the system, but it was alerted, and it was alerted 1, 2, 3, 4, 5 days in a row. Okay. Combined with breaking out of a downward channel, which is bullish in itself, was a reason to sit up and take notice. And when we shared with our members, that broke out through a buck, and even in its just the first surge, going from a buck to 180, even that on its own was very impressive. I'm sure we'd all agree that if you could do that, once a month, we'd all be thrilled, right? Even once every few months would be great. Even that on its own was impressive. But when we went out and looked at the bigger time frame, we saw that something was actually going on the bigger picture as well. Okay. And so after the first surge, we spotted it on the weekly. And much like that stock earlier I showed you, a few of them in fact, this suggested that something bigger in more than just a few weeks may be evolving. And what we hope to see in XFOR, because that's something I've got programmed at the moment, what we're looking for is something like this. The evolution on the weekly chart, then break out, and this one breaking out from 150, traveling all the way to its 270 target. And a little bit higher, but hitting that 270 area with no problems, almost 100% move. But when you start to look at what can evolve beyond that, beyond just those initial pops, this is what teed up carried on to do all the way through just recently when it topped out. Right, all the way up to 12 bucks. Now that was a 600% move. What was impressive is that insiders were loading up ahead of it. So not only was it a smart surge, but that smart money I talked about, that smart money volume behind it, 58%, 73% by Noam Poransky, they loaded up with several $100,000, around 80 cents before it went up. That 600-700%, or a lot more from 80 cents to $12. Taking 350 grand and turning it into over 4 million on paper for those insiders. Now, there's nothing wrong with that. It's publicly reported to the market. Good for them, right? And just like the RSP, these insights are sometimes hiding in plain sight for us to ignore or to take advantage of if we're looking at the right time in the right place. And what's even more impressive is not the 600% move that it did plus, but the fact that 400% of that move, as you can see here in the bubble, happened while the market went down 20%. So in a market of uncertainty, what kind of stocks do you want to be holding? I want to be holding stocks that have got that potential, that resilience to at least go sideways or maybe even still go up, even when the broader markets go through volatility or declines. Now I'm going to just fast forward because obviously we had some glitches, and I want to make sure that everyone gets a chance to take part in today's offer, and then we'll see if we have a few minutes at the end. because we have put together, as we did last time for Metastock, again, as Jeffrey said, we've worked alongside Metastock, and this is programmed into Metastock for the scan and the indicator, everything you've seen here on the charts, since Acorn began 18 years ago. So the Smart Surge program that we've got here for you combines everything that you need. And as I said, it's more than just an indicator. It's more than just a scan. It's a system. So the package combined, first and foremost, starts with the scanner. Because with only, on average, 5 to 8 out of 8,000 occurring per day, that's impossible to find manually. But so many breakouts turn into fakeouts, so much noise, especially now in the market. So it's more important now than ever to find the quality over the quantity. So scanning for it, I wouldn't trade this without the scan. At the click of a button, you'll be able to run that scan. It's going to find it for you in seconds. Whether you're on Wealth Charts, TradingView, Metastock, Thinkorswim, Incredible Charts, TradeStation, Trading Indicators, we have it set up in all of those, and you'll not just get the scan, but you'll get it for life. Lifetime access to the scanner. And on top of that, lifetime access to the indicator that you can see there, right there on the chart. So every time that the stock qualifies on the hourly or the 15-minute or the daily or the weekly, you're going to see that print on the chart, and then once that time frame is over, that does not repaint. It's there on the chart, it's there on the chart forever. And like the indicator, you're also going to be getting access to it forever, for life, in Wealth Charts, TradingView, Metastock, Thinkorswim, TradeStation, Trading Indicators. On top of that, if you are someone that is a little bit newer to patterns, what we've included for you is one of our flagship products, which is Finding Flags. This is very complementary to the SSS, because some smart surges have flag-like qualities, but they're not to be confused with just your normal breakout, your normal kind of flag setup. So what this advanced course goes through is why most breakouts should just be thrown back, and how to find the critical differences between breakouts and fakeouts. And it builds just so very nicely into the Smart Surge technology. This is only 4 modules long. You could do it easily in a day, on a weekend, whenever you want. You don't have to go through this first to start using the Smart Surge at all, because this is also there for you for life. So you can go through it in your own time whenever you have that time, but a beautiful complement and showing you how the strategy evolves. So that's included with your package today. What I would do straight away is just watch the quick start guide on the Smart Surge system, which is really easy. You can do that in half an hour, and that's going to take you through from start to finish, from setting up the scan to running the scan, picking out live setups there in the video, and the entries and exits and all that kind of thing. And at the time I recorded that quick start guide, what was really cool was Kaba was the stock I picked out in that live video, which ended up going from $1 to 12, much like that one we talked about before. But the benefit and the value there is you get to see all of the analysis take place of why I picked this over the other 7, how I brought up the insiders, how the smart money was incorporated. So you just get to look over my shoulder and see everything from setting up the scan through to picking my favorite trade in that day happened there right on the screen. And so all of this is included. You're going to get your own one-on-one coach for 3 months. That's an extra bonus that we've included for you today. Unlimited support throughout those 3 months. The Advanced Flags Masterclass, and it's valued at over $5,000 for all of that. The new members special we did just a few months ago. We haven't run it for a couple of months, but some of you may have seen this. We did a special on this for $14.97 for this package. But as I said, we like to do something very special for these summits, and especially working with Jeffrey and everyone, phenomenal people at Metastock. We brought back the mid-year offer for you, which gives you access to all of these things for life for only $397. $397 in total, which is lifetime access to the scanner, lifetime access to the indicator, and you have 3 months of your own personal concierge support for setting things up, practicing, absolutely everything. And on top of that, for those of you who take action here within the next 15 minutes, there's a live event bonus specifically for Metastock here. If you're getting signed up right now or during the live event, using that link on the screen, important to use that link on the screen, acornwealthcorp.com/meta. We're also going to include for you 3 months of our live trading room sessions, and we host them every Tuesday and Thursday from 4 p.m. to 5 p.m. Pacific, 7 to 8 p.m. Eastern. And that is where we break down the market and if you talk about the kind of things I was earlier in much greater detail, everything from stocks to commodities, forex, option trades we're looking at to leverage these moves. It's spectacular. Every Tuesday, Thursday for 1 hour, 4 to 5 Pacific, or 7 p.m. to 8 p.m. Eastern. Those are also recorded and sent out right away afterwards. The recordings are broken into chapters. You've got a written summary of those recordings as well, so you never miss a beat. And 3 months access as well to our top trade alerts. These are our insider setups, our smart surge setups. We send out a minimum of 1 core video per week with our 5 favorite trade ideas for the week ahead. Longs, shorts, stocks, options, broken down into everything that's going on, from the potential entry signal to the targets, just like I spoke about to you earlier, stop losses. Again, it's not financial advice. You still have to decide if it's right for you. Do your own due diligence. But every single piece of the rule system and what's covered in the course, what you'll see me talk about live in trading rooms, all broken down for you in that short video and also in written format as well. That's valued at over $600 for that additional 3-month bonus, and it's yours completely complimentary if you take action as part of the live event bonus. So to do that, simply go to acornwealthcorp.com/meta, and let's just have a look. I think Jeffrey's, thank you, mate. Jeffrey's already put that into the chat box for you.
You're welcome.
And there we go. And there it is from me as well, I think. There we go. Everyone. Boom. All right, now I know we had some time. We're going to be shorter on time here because I've had the technical glitches at the start. And again, I'm glad we got that sorted out. So I don't want to take up any of the next speaker's time, but if there's any critical questions, feel free to just shoot it into the chat box and I can type back to you. But
All right.
feel free to cut me off whenever you need to there, Jeff.
All right. One question real quick that we have is does this work well for Australian markets? What international markets, what rep markets do you recommend?
Yeah, actually, in fact, I don't really. Just 1 second here. I don't actually really mind where the stock is. In fact, some of my best trades this year were actually on the Canadian market and Australian market. There was a company called Race Oncology, RAC, that was found by the Smart Surge scan in the Australian market, and that one did extremely well. Just seeing if I could bring it up. The other one was lithium. We're closely following and alerting a lot of lithium companies and rare earth companies. We have been ever since earlier this year in March. Uranium, and some of these companies are in either in Australia or they might be in Canada. In fact, one of the largest positions I have right now is based out of Chile. That is a lithium play that we recently alerted. So the beautiful thing about this is that, as I said, we're not trading the market, we're trading a strategy. And with the broad scope of things like interactive brokers, I mean, I've got my account set up in Canada, but I can trade any exchange in the world. And so you, and if you've got Metastock, or if you've got a scanning program that supports multiple exchanges, you've got no problems tapping into those worldwide opportunities like Australia, Canada, and otherwise. So that's a huge win. If you've got a quality program like Metastock that allows you to do that, the world is your oyster and Smart Surge is your compass.
All right. John, I'm really sorry about kind of the technical issues we had getting you going. The link is in the chat. If you have any questions, let us know. And I really appreciate you, John. Thanks for coming in.
Thank you so much, mate. Appreciate it.
All right. Very cool. Let me go ahead and kind of just share my screen real quick. And what we're going to do is I think move straight into the next presenter just so we can kind of make up a little bit of time. If you have any questions for us, feel free to give us a call, 800-882-3040, metastock.com/saleschat, metastock.com/conf promo. Our next guest almost needs no introduction, but I'm not going to do that. Larry McMillan has actually written Options as a Strategic Investment, what's considered by many, I've heard this from more than one place, the Bible of options trading. Very, very good book. He does several newsletters from the McMillan Analysis Corporation. I love his take on the market. He likes to look at a lot of his different market indices to kind of determine what he sees going on in the market. It's always a good time, and he always does such a great job. So, Larry, let's go ahead and get you started.
Okay, Jeff, you hear me all right?
Yeah, I can hear you great, and you don't know how happy that makes me inside. We had some issues with audio with a couple people today. So
I second that emotion.
I'm doing share, right?
Right, that should be the right thing to do.
Yeah, I'm not. Okay, let's see. I guess I'll share my screen, but that's not the video. Hold on.
I can see your video. I mean, I can see your screen.
Okay, I see. Okay, there we go, I guess.
All right.
All right. So we're going to spend a little time talking about the market. Most of our indicators have an option-oriented take to them, but we'll work our way through those. So am I seeing your screen or my screen? I can't seem to control it here. What's going on?
I can see your screen. You shouldn't be able to see my screen anymore. But
okay. Now, did it change pages there?
It did. Yes.
Okay. All right. Good. We're good.
Cool.
So I guess I was looking at the picture of my screen instead of my screen. All right. So just a little background. We started the company quite a while ago, back around the late 1990s. As a derivatives research firm, we moved into money management around the time of the financial crisis because we had some pretty good recommendations. And we also have an option education division where we make talks like this, or we have mentoring classes as well. I'll come back to this later, but I did want to point out that we will be sending you the PDFs of the presentation, and by that's plural because one is in color and one is in grayscale in case you want to print it out. You don't use up all the color ink in your printer. All right, so the things I like to look at are basically these, although we're going to take a look at a few more than just these. But first and foremost, the chart of the S&P 500. And this has really been very important this year, especially this fall, where the market keeps going up, but many other indicators are either overbought or giving sell signals, and then those sell signals fade away and the market continues higher. So the chart of the S&P is the most important indicator. We'll also look at equity-only put-call ratios, and we'll look at some put-call ratios, individual stocks and futures. Market breadth, that's important. We have a way to look at that in terms of optional stocks. And then we'll take a good in-depth look at VIX and all the VIX futures and the other things that VIX implies, the whole volatility space, if you will. So I have a corollary. One is oversold does not mean buy. So the market can get oversold and stay oversold while it's collapsing. I think last week we probably were oversold. We bounced right off of that, so it doesn't, but we wait for confirmed buy signals. The other companion to that is overbought does not mean sell. And in this particular, as I mentioned, this fall and this summer, we had a lot of overbought conditions, but they just stayed that way while the market kept going higher. So again, just because the market gets overbought doesn't mean you should be running into sell. So here's the long-term chart. This is a place to start. The 2-year, well, actually, this bull market started in October of 2022. This is a year before this chart starts. But we had, a couple of modest little corrections. We had this 10% correction here, and then a little one there, 9% here. And then we had this nasty tariff tantrum, if you want to call it that, last April. Market dropped a huge amount in a very short period of time. That's usually pretty rough on everybody's psyche. But we've rebounded from there in a really strong V formation. And right now, we keep setting these support levels. Here you can see we had a couple of tests right around 6,200, moved higher. Then a couple more tests around 6,350. And then most recently here we tested 5 times in this 6,550 area. And we also had some support there at 6,500. So that's the strong support for this current leg of the market. Last Friday when we sold off and then rebounded, that was 63.60. I'm sorry, 66.30. So that's also a support level, at least a short-term one as well. If we zoom into a 1-year chart, these circles are gaps on the chart. So not every gap is filled. I'm not. I don't ever really trade to base my trades on the gap being filled. But you can see there were a couple of gaps here recently when we broke out to new highs. Those got filled, but now we have a new one after yesterday's strong rally on hopes that the government shutdown will end. But if you look back here in April, coming out of the bottom in a very volatile market, there were several gaps that are still there. These pink circles, and those may never be filled. I don't really know. Certainly not planning on taking a position to see that they're filled. But right now, the important thing to gather from this chart is that we still have several support levels. We really only pulled back below the 20-day moving average. That's the line in there. That's the 20-day moving average. This one right here. The 200-day is over here. The 20-day moving average, we only really pulled back to there and closed below 1 day. So that's hardly a bear market. It's just more or less perhaps a correction in a healthy market. I mean, I think there's some possibility now we might be caught in a trading range a little bit, but we'll know that for sure. And as long as we're above 6,500, this chart is still a positive chart. So this kind of more or less says the same things. The chart is still bullish. I'd like to see to really confirm that the market make new highs again above 6,900. But even if it doesn't, it's still not a reason to go short until you drop below either last week's support, if you want to use that level, or 6,500. So another thing we do with the S&P chart is we draw modified Bollinger Bands on it. And by that, we use the Black-Scholes definition of volatility. So when John Bollinger invented Bollinger Bands as the realized volatility, used the standard deviation of closing prices, which is fine, but that's not what the Black-Scholes model uses or many of the other math kind of oriented models. So they use the standard deviation of daily percentage price changes. It's not a huge difference, but it is a difference. And since we're in the option business, we need our realized volatilities to line up with the applied volatilities that are coming out of the Black-Scholes model or whatever model we're using. And therefore, that we use this definition then as the definition of realized volatility. So we draw Bollinger Bands with that volatility, And when the market moves outside of the +4 minus standard deviation band and then moves back inside, we have a signal. So we call this MVB, McMillan volatility bands. But here's the current chart of that same 1-year chart. That's the 4 standard deviation band right there. And then right inside that's the +3 standard deviation band. So you can see we had, for example, this signal right here, we were outside and then back inside. The object is to then go and touch the opposite band. So on this buy signal that we had down here at the April lows, we got the buy signal and then it went up and it touched the upper band and that completed that signal. So on this chart, that's really the only completed signal. The others all fell back earlier. And we have one that's open right now. Well, there was a sell signal issued back here on October 10th, and the sell signal came in about right there. We reached that same level again last week, or a little bit higher now. So this has a long-term, very positive track record. If you take me up on my offer to subscribe to the Option Strategist newsletter, you'll see the track record of this indicator. That, in particular, though, the last year has not been successful for it. It's just keeps hitting. We keep getting slightly overbought, give the sell signal, and then move on again. So in any case, there is an open sell signal on that indicator right now. We also can apply the same logic to stocks, futures, indices, or whatever, and we have a service that does that if you're interested in that approach. So let's move on to a more strictly optional oriented thing, and that's put call ratios. So put call ratios were invented by Marty Zweig as an indicator back in the 1950s when he was getting the data from the ads that were run in Barron's every Sunday by the put and call dealers, brokers at that time. And at first he thought, he'd gather this data and he'd see if everybody was buying calls, he'd expect the market would be going up. But in fact, just the opposite was happening. And so I realized this was a contrary indicator, in which case too much put buying, and we have to, of course, define what that is. Too much put buying, though, means that too many people are bearish, and therefore that's bullish for the market in the contrary sense. And conversely, if too many people are buying calls, the market's about to head lower. So we can do this on individual stocks, but to predict the broad market, we use the equity only put call ratio. That's all stock options that trade. We use it across all U.S. Option exchanges. So there's millions of contracts here that trade, but I'll show you how we interpret it. So in a very simple manner, the put call ratio is determined this way. Let's say it's IBM. At the end of the day, we sum up the volume of the puts traded in IBM separately, sum up the volume of the calls, divide the two, and that's the put call ratio. So Marty Zweig puts in the numerator of this fraction. So if there's heavy put buying, the ratio goes higher. But when are you likely to have heavy put buying? Well, that's when the market's going lower. So the ratio and the stock move in opposite directions. Similarly, if you increase the denominator of a fraction, in this case, more call buying, the ratio will drop, a fraction will drop, loses value. And when's that likely to happen? When's there likely to be heavy call buying? Well, that's when the stock is going up. So again, just to confirm that, the ratio and the stock price move opposite to each other. We keep 21-day moving average on these. You need to use some moving average. I use that just in case Fibonacci means something. And this is the theory. Now, we post on our website in an area we call the strategy zone. We post over 1,600 put call ratio charts every day. And every chart has both the stock price and the option price. And the put call ratio, so that you can get a handle on whether or not they have this inverse relationship, which is what you're looking for. So let's say here the stock is dropping in price. As the stock is dropping in price, people are buying puts, and the public is making money during the move. But eventually, the put call ratio makes a local maximum, and when that happens, that's a buy signal for the stock. So now the put call ratio starts to go lower, because people are buying calls, and the stock starts to go higher, move over here to the left. So the ratio is going lower and lower as the stock moves higher and higher. Eventually, the put call ratio makes a local minimum, and that's a sell signal for the stock. So that's the inverse pattern we look for most of the time. And if you don't see this, perhaps there's arbitrage or some other thing going on that's distorting the put call ratio. So this is not the current chart, but on the top is the S&P 500 index, and on the bottom is the equity only put call ratio that I spoke of. That's all stock options that trade, and you can see the inverse symmetry here. So that's why we use the equity only put call ratio to predict the broad market. So here's the current chart, and this is again is just the standard put call ratio. I call it the standard, meaning we're just considering the volume of puts and the volume of calls. You can see that last April we had a nice local maximum on the chart that led to a strong buy signal. We've had a few other local maximums. Right now, though, most recently we had this local minimum in October, and at first, the market did drop. It had this sharp drop, then really it hasn't. Then last week it had another drop, but it really hasn't, gone down in a trendy manner or anything. So this ratio right now is moving higher, but if it were to roll over and start to do that again, it would revert back to a buy signal. You can see that the buy signal in April was at a very high level on the chart. Over to the left, it came at about the 70 level, meaning 70 puts were traded for every 100 calls. That's a lot for stock options. It's usually, closer to 50 or some other number. And so we're watching this, of course, but at this point in time, the put call ratio is still rising. It's on a sell signal. Now, as computers developed and things got a little more sophisticated, we were able to compute another ratio, which we call the weighted ratio or the dollar weighted ratio. And this is the way we calculate it. At the end of the day, again, let's say it's IBM, we take each option and we multiply it by its closing price by the volume that traded that day to get the dollar volume or an estimate of the dollar volume on that option. Now, you could do it tick by tick all day long. That's an expensive and time-consuming procedure, and we weren't getting any better results when we tried that than doing it this way, so we just do it this way. And so at the end of the day, we sum up those dollar volume of all the puts, we sum up the dollar volume of all the calls, and that's the dollar weighted put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And so it's a weighted, we call it the weighted ratio. And so this is the current chart now, the weighted ratio going back a year or so. The local minimums and local maximum occur at about the same spots. You can see again a local maximum buy signal in April, most recently a local minimum sell signal in October. Now this one, last couple of days, has started to go back down again. As I said before, if it rolls back over and starts to head back down, that'll revert to a buy signal. We have computer analysis programs that view this as sort of a chess tree. You can look a few moves ahead. And it's that those computer programs are still saying it's on a sell signal. In other words, they expect the ratio to continue to go higher. We'll see. But right now, they are on a sell signal. And typically we'll hold a position in line with any of our confirmed signals. So these have been really strong signals historically, especially when they occur at the extremes on the chart. So we're pretty low on these charts right now. That means the market's overbought, and getting sell signals at those overbought levels would normally be pretty good. But if they roll back over, of course, that would negate the sell signals. It's just they'd be rolling over at very low levels or, like late in the day, kind of overbought conditions. If we take a longer look back on those charts at the bottom, it said there's the lowest ratio since 2021. So this is the same chart that we just looked at, except only this is an 8-year chart. We were just looking back 1 year or so, like approximately this area right here. And you can see that this is at local minimum we just had there in October, that was the lowest level that we'd seen since all the way back here in 2021. Now, in 2021, we stayed down at that really low level for almost a year before taking off out of there. So, just because we get to a really low level doesn't mean the market is ready to reverse and head upwards. But eventually it did lead to a bear market in 2022. And you can see that during the bear market, then the put call ratios tend to move higher as people are buying more puts and less calls. If we look at the weighted ratio, this goes all the way back to 1998, which is when we really started having enough option volume to calculate the weighted ratio and have some confidence in it. You can see the weighted ratio kind of gets down to about 50, and then that's about it. So on the left-hand side there on the y-axis, the 50, that means $50 worth of puts are traded for every $100 worth of calls. In other words, a lot of calls. So a lot of optimism. So when you're down here at this bottom of the chart, that there's optimism going on. On the other hand, when you get up to the top of the chart like that, that's the end of the bear market. 2022. This is a financial crisis. This was a little bit odd back here in 2001, but we did have a very nasty bear market in 2000. So because there were fewer stocks having options back then, the ratio was more easily distorted. But in any case, the little red square on the right-hand side, that's what I just showed you on the previous 1 year chart. So what do we trade when we get these signals? We have, we have let's say a McMillan volatility band signal or a put call ratio signal. We trade SPY options, and I tend to trade SPY options slightly in the money because the delta of a call option, let's say we're going to be bullish, or I want to have an option that's going to respond well if the underlying moves higher. So I don't want to buy an option that's so far out of the money that I'm not going to really make anything. And that easy way to tell that is to look at the delta. So the delta of a call ranges between 0 and 1. 1 means it moves exactly 1 point for every point the stock moves. That's not really, you don't need to get that high of a delta. But I do like to get like a 70 delta or so. So we'll buy SPY options maybe with 2 or 3 weeks remaining and maybe 1 or 2 points in the money. And that'll give us an option with a delta of like 70 or so. If I'm going out a little longer term, a put call ratio maybe a couple months out, then I'll buy an at the money. But even an at the money call has a delta of slightly above a half. So if the stock moves up, if I'm right on my buy signals, and the stock moves up, then I would make, the opposite is going to be making money right along with me, and not some deeply out of the money quasi lottery ticket or something. Now, on TV, they often spread these options, and I see a lot of people saying they like to do the spreads. I don't know why, because it's a killer. What spread? I mean, so let's say you're bullish on this stock, so you buy a call at this strike, but then you also, in order to, I guess, reduce your overall cost, sell a call at this strike. But what that does is cut your profit potential off if the stock is to rises up to the high strike. So you're making money up until here, and then boom, that's it. You're done. So there are times to do that. The time to do that is when options are expensive. We have a lot of implied volatility information for free on our website, a lot of realized volatility information too. It's all every Saturday. We update the implied and realized volatilities for everything that trades options. A lot of things trade options. So if the options are expensive, and let's say they're in a high percentile of implied volatility, then a bull spread might make sense. I'm not going to go into the whole explanation for that now. But otherwise, no, because what you're doing is if you just own the call, you have this possibility. If the stock really takes off, you can make a lot of money to the upside. Where if you did the bull spread, you can only make X dollars, and then that's it. So even if it is, let's say, volatility is high, like last week, VIX is very high. VIX is still sort of high. If you're really, adhering to bull spreads during periods of high volatility, you can mitigate the negative aspects of having a spread. There's two things you can do. First, you widen the difference in the strike. So you don't do a 5-point bull spread on S&P, on SPY. Instead, you spread it out. So right now, if we're looking at anything expiring November 28th or later, I'm going to do this SPY call bull spread 15 to 20 points wide. Put spreads you can even do wider, 30, 40 points wide, because out of the money puts are more expensive than out of the money calls on a implied volatility basis. The other thing that you can do is then, besides widening the strikes, is roll if the short strike is hit. Well, what do I mean by that? So we'll take a look at an example. So today, as SPY is trading around 680, let's say you're bullish, you decide to put on the December spread 25 points wide. So you're buying the 680 call and you're selling the 705 call, 25 points wide between the two strikes. So that's nice and wide, and that gives you the ability for that spread to widen out in your favor. If SPY trades up to the high strike, though, 705, you've just about reached your maximum profit potential, depending on how much time is still left between when that happens and December expiration. So our recommendation in those cases, and this is the way we do it in our newsletters, is to, and in real life in my own trading account as well, sell that spread that you bought and instead replace it with this one. Just move both strikes up by 25 points. So now you're buying the 705 call and selling the 730 call. So I put together a graph because people have wondered about this. So the first spread is this black spread right here. So we're buying the 680 call, buying a call at this strike, and we're selling the 705 call. So that's where we would cap off. But now when we get to 705, you can see the black line here. That's our profit potential. And it's just about done. It's just going to flatten out here. It's got not really much to do. But if we sell that spread and now buy the 705, 730 spread, so we're buying the 705 call and selling the 730 call, now we have that red profit graph. And now our profit graph for our position moves up along this red line. And we can, and then again, if you get up to 730, that starts to flatten out and you do it again. So this is how you can stay in a spread and still keep pace with the upside to a certain extent. It won't be as good as just owning a call, but since options are expensive, sometimes just owning a call is really not the optimal, theoretical trade to be in. On the put side, similar way, let's say you were bearish today, you want to set up a put spread on December, you buy the December. Oh, I'm sorry. I'm getting to that in a minute. This is one more example on the call side. The call spread that I just described, buying the 680, 705 call, that's 14 points on the buy side, 350 on the sell side, that's 1050. So you're paying 1050 debit to max out at 25 points. That's the difference in the strikes. That's okay for an option trade. It's not great, but it's okay. Here's where I was jumping myself ahead here. The puts. So today you were instead bearish on the market. So you buy a 680 put and you sell a 640 put, 40 points wide. Here's what those options cost. And now that's a debit you're paying of 860. They're 1230 minus 370. And now you're paying 860 for a spread that could max out to 40 points. So that's much better. So the way the market is actually priced right now with interest rates, dividends, etc., and perhaps a little dose of bullishness built in there and not so much skew in the puts are actually, a more attractive thing. But I wouldn't just buy puts because of that. If you have a lot of buy signals from your indicators, you have to be long the market. And again, in this particular case, you would treat it the same way. If you put this bear spread on and S&P or SPY traded down to 640, you would sell the spread you own and you buy a new spread with each strike being 40 points lower. So we do that approach all the time, and that's pretty much standard for us, whether we're doing put-call ratio trades or any other kind of trades. Here's some other put-call ratio charts in individual stocks. Now, when we're dealing with individual stocks, I usually only use the extreme local maximum, local minimum. So here, for example, there's a little local maximum there. There's another one there. another over here. Those I wouldn't trade because they're kind of in the middle of the chart. But we did have a buy signal here at a very high level, and now we had like 2 buy signals here. This is in AIG. The stock hasn't really responded yet, but we did go long AIG really just yesterday based on this put call ratio signal, buy signal. There's another one we're waiting on. This is Eversource Energy. You can see that way on the far side of the chart here, it had a local minimum back here, which was a sell signal, which is pretty good. The stock went down after that. Then it was followed by a buy signal, which was okay in the beginning. It moved on later. I don't know if you'd still be around for that part or not. But again, this is too low. We're not trading that one. This is too high. We're not trading that one. But now we've come down here to a new extreme just recently and formed a new local minimum sell signal. So the stock has bounced off the 71.5 level back here and even last week. So we're waiting to see if it can break 71.5. If it can't, then we won't buy the puts. But if it can, we'll act on this signal. So sometimes we combine technical analysis in terms of support levels with the put and call ratio signal. This is H&R Block to show you how this technical analysis can save you some money. We had the local maximum back here. That was a pretty good buy signal, although short-lived. Then we had the double buy signal here, but you can see the stock was in a trading range. The top of this trading range was 53. So we said, all right, if it closes above 53, we'll go long. Well, it never did, and now instead it's broken down. So we did not buy the calls, even though there was a buy signal from the put-call ratio chart. This is gold, the gold ETF, GLD. It's had a number of good signals. We had in our newsletters a real strong signal here. Now, this one we did play with a bull spread rather than just an outright long call because the options were very expensive. But it got all the way down and gave a sell signal right around the 1st of October. It didn't really break right away, but it eventually did break in the last couple of weeks. And in doing so, look how much put buying has gone on. This last break of the last couple of weeks as people are just buying puts massively. In other words, everybody's trying to predict the top in gold. Remember, this is a contrary indicator, so they're probably going to be wrong. So I put a question mark here because we don't have the local maximum yet, but it's probably going to come pretty soon. And so when it does, we'll re-enter a long position in the GLD, probably a call bull spread. Now this is Masco. We had a sell signal back in September, and it's worked well. The only reason, again, I put this one on this list today is you can see now people are really cranking away buying the puts. We're starting to get up here to the same levels that we had pretty good buy signals at before. So I would suspect within a couple of weeks, we'll probably see the local maximum roll over and get a new buy signal in this stock. Now we can do this with futures options too. So this put call ratio on the bottom here is drawn using the T-bond options that trade on the Chicago Board of Trade. So that the put call ratio and all this is from the pricing and volume of the futures options that trade on the Board of Trade. However, just because futures options are used to create the signal doesn't mean you have to trade futures. So you can trade TLT, which is a ETF that simulates the 30-year bond or long-term bond. And so this has just now given a sell signal. And if you were going to trade this, we did not make a recommendation in this one, but if you were, you could buy puts on TLT. On the other hand, sometimes in futures, you can't do that. So this is cocoa. The left side of the cocoa chart here is almost unreadable. It's just been all squashed down into oblivion because the right side is so high. It's gotten up here over 500, meaning that $500 in puts are trading for every $100 in calls. Yes, cocoa has been in a slide here for most of a year. There was a huge rally before that, but now it's been in a slide, and I think people are just pretty disgusted with it. Here we thought we had a buy signal, local max, or we did have a buy signal. At the time, that was the highest level it had been. And then it came down, and the ratio reversed. So I said we don't trade these in the middle, that we wouldn't use that as a sell signal. We do use it as a sell stop for that trade. So now we moved even higher. Now we're getting another put call ratio buy signal. Cocoa, though, does not have an ETF anymore. It used to, but it does not have an ETF anymore on the stock side of the fence. So if you want to trade this, you're going to have a futures account and trade the futures call options at the ICE. And call options are $10 a point on, that's their value. You might think that's not that big a deal, but cocoa moves a lot. So you can make lose a bunch of money pretty fast in cocoa, even at $10 a point. All right, let's move on to market breadth. Market breadth is simply we keep track of advances minus declines. You keep a cumulative total of that, or we can keep an oscillator. We do both, but our oscillator is so today's oscillator value is equal to 90% of yesterday's oscillator value plus 10% of today's advances minus declines. Now there's a further complication here. If we just use New York Stock Exchange data for advances and declines, we get some things that are not stocks. And I was noticing over the years that distorted things. So we were looking for a stocks only data set. And I realized the New York Stock Exchange publishes what they call operating company only data. But we realized we had a much better data set. And that's all stock options or all stocks that have listed options. There are about 6,000 of them now. So we have a nice, healthy set of stocks to use for advances and declines. So this is the current oscillator value. This is the stocks only one. So and this goes back about it's about 4 years, or 7 years. Sorry. So you can see that when it probes down, we get oversold territory. This was that right before December of 2018, and that was a very nasty market right before Christmas. But we've actually survived that and kept going. Then we had the pandemic, so that set the market again way down, and it we had another massive oversold condition, and now then you can see we got into the bear market, and we started to get much more in the way of oversold conditions. All these oversold conditions here produced a bunch of green arrows, and then they kind of dissipated as we got back into the bull market. This was the pandemic last April, and now just recently we've had just modestly oversold conditions, but they were still oversold. Now remember, I said in the beginning, we don't buy the market when it's over, so we wait for it to stop being oversold. So that just happened yesterday. It's a little bit hard to see, but we probed down here and then back up again. And so we just have a brand new buy signal from the breadth oscillator here. Conversely, on the upside, when it gets too overbought and it goes way up in this area, again, we don't sell when it's overbought. We sell when it stops being overbought. The last time we had one of those was in October 28th. So this is our short-term indicator. It's subject to whipsaws, but it does get the market right. Normally, it just gets it wrong sometimes too. So, well, that's the advantage of option trading. You know what your risk is. You can make a lot of money on, buying a call, but you can only lose what you put up. So here we're noticing, though, that this latest buy signal from the stocks only oscillator, that's what I was showing you there, was not confirmed by New York Stock Exchange data, which is a bit bothersome. So I really haven't taken a new trade based on this yet. One thing that we did see, and this was not just this recently, but over the last couple of months, breadth was not expanding while S&P was making new all-time highs. Usually, if the market's making new all-time highs, these breadth oscillators get very overbought and very strongly supporting the market. That has not been the case. What has been the case, though, is another indicator which we call cumulative volume breadth, and that's volume on advancing issues minus volume on declining issues accumulated daily. And this has been very strong. This has been a new all-time high, right along with SPX all summer and fall. Last two times it made it were October 24th and 27th. And we're very close again now coming into today. I won't actually have the data till tonight. But today, even though SPX is only up 14 points, advances were strongly ahead of decline. So this might have made a new all-time high as well. So of course, what's happening here is that the volume on NVIDIA and Apple and Microsoft is dwarfing the volume on some declining stocks, and so this indicator continues to go higher. Whereas if we just count, NVIDIA up is one, and Nike down is one, then you have the previous indicator, this straight advanced decline, has struggled. This indicator is also useful as a negative divergence, but that's not in play at this time. Not every bear market starts with a negative divergence, but the one in October of 2022 did. So if a negative divergence were to develop here, that would certainly be significant. That's not been happening. So the yellow line here is the cumulative volume breadth, and the white line is SPX. This was last April, when everything got hit pretty hard. But you can see that cumulative volume breadth recovered to a new all-time high much quicker than SPX did. And so that's actually a buy signal for SPX, because this is at a new all-time high, and this was not yet there. So it did make the all-time high, and then, as I said, they've continued on higher. This one on this chart is based on stocks only data, but also was all this information I've been saying has also been confirmed by the New York Stock Exchange version of cumulative volume breadth. Another thing we look at is new highs versus new lows. This is a indicator that when it gives a signal, usually lasts for a while. So you can see the last signal we had here was a buy signal in June, which lasted for 4 months. For me, that's a long-term indicator. And it did very well. Of course, the market went up a lot in that period of time, but it was eventually stopped out when advances, this is on the New York Stock Exchange now, this first set of columns here is New York Stock Exchange data. Advances fell behind declines for just 2 days in a row. Then last week, declines really started to pump up, went more than 102 days in a row on Thursday and Friday, and that looked like a sell signal, but I wanted to wait because obviously we knew the market was rallying by Sunday, you knew the market was going to rally on Monday. And so we came back strongly with new highs yesterday and again today. And so that really canceled out this potential sell signal. So right now, this is technically back on a buy signal again as of today. All right, let's spend the rest of the time here talking about VIX. I don't know how we get to 550 already, but we are. So there's a couple of things we can use the VIX chart for. One is to discern the trend of VIX, and the other is to look for spike peaks. So this is the 1-year chart of VIX. All those Bs are a system that we use to try to trade the spike peak buy signals. And the red letters are successful trades. The blue letters are not. The green letter is one that's open right now. We had a buy signal in mid-October, and these buy signals last for about a month. So this was coming to fruition. Now, interestingly enough, this thing that just happened Friday is not a spike peak by our system because we use closing prices. So even though VIX spiked up near 23, it closed back down here at 19 on Friday. And so that did not give us a spike peak buy signal there. But this one from October is still in effect. Meanwhile, the trend of VIX, we define the trend as saying if both VIX and the 20-day moving average are on the same side of the 200-day, then you have a buy signal. So right here, that was the latest buy signal right there. And that was mid-October. It hasn't been stopped out yet because here's the 20-day. So it's still below the 200-day. And VIX has only popped above the 200-day intraday. It hasn't closed above it for 2 days in a row. So it's both those buy signals are still clinging to their, I guess, bullishness at this point in time. So they were not stopped out. Just as an aside, people get worried when VIX goes low. A low VIX in itself is not a problem. It's just an overbought condition. But as I said, the market can go up a lot when the VIX is low. It's just when VIX starts to rise that the problem set in. So we've got our eye on the 200-day moving average, which right now is at about 1940. And if VIX starts to close above that more than 1 day at a time, then we've got a problem, a potential problem. And then you can't trade VIX, but you can trade VIX futures and VIX options. The options are based on the futures. In a normal bullish, standard environment, if we look at the VIX futures term structure slope upward like this, that's bullish. Occasionally, though, this happens. The term structures invert, and that's bearish. So the last time that happened to a large extent was this past April, but then the March of the pandemic, it really happened for like a whole month. Financial crisis had happened for more than a month. And so these are really opportunities when they do occur. This past decline, we did have a little bit of it. I'll show you that in a minute. But here's where we stand right now as of last night's close, not today's, but last night's. VIX was 1760. The November futures are the front month. So if we subtract 1760 from 1850, we have the VIX futures are trading at a premium of 90 cents. Now you can see here each futures contract as we go out in time is trading higher than its predecessor. So the term structure is sloping upwards, and all the futures here have a nice fat premium to VIX. All that's bullish. That's bullish for stocks when you see that pattern. If you don't trade the VIX futures, which they are available on the CBOE website, but you can also quote these CBOE indices, volatility indices. So there's a 1 day that's usually mostly useful for people trading those 0 day to expiration options. Then you have a 9-day. VIX itself is a 30-day volatility, a 3-month, a 6-month, and a 1 year. And again, last night, this is where these all close. You can see each one's higher than its predecessor. Again, that means the term structure is sloping upwards. And again, that's bullish. So the term structure right now are quite bullish. But this is how it looked on October 16th. That was the first day that the China tariffs caused another little tariff tantrum in the market. And you can see here, now they sloped downward in the front end and then just kind of flat after that. And all the futures were trading below VIX at a negative premium. That's very bearish, and that's a sell signal for stocks. So really, when that happens, the VIX itself was at 25 at the time. When that happens, that's a big warning sign. You really need to play some defense. If it doesn't persist, fine. Then you lose on your defense. You're okay on the rest of the things. But that has been a predecessor to some really nasty markets, and ever since VIX started trading futures back in 2004. Now, as I said, it quickly reverted back to a bullish status. So everybody's kind of saying, "Wow, great! That didn't get that major sell signal that we've gotten before." Everybody feels pretty good about it, but I think it's still worrisome to some. I know even myself. You see how the market's recovered, but the fact that it can have that inversion like that is not really a good thing. But the number one thing we keep an eye on is the front month future, in this case November versus December. If November starts trading at a higher price than December, then all these other things can follow. So that's the leader of the pack. That's the thing you want to keep an eye on. On that day of the October 16th, and actually the next morning, the market was down substantially pre-market trading. The front month was ahead of the second month by $2. That's a large number. But again, it reversed that day, and then eventually, the market went lower last week, but then reversed again. Realized volatility is something we also pay some attention to, and the historical 20-day volatility of SPX traded down to 6%, which is overbought, but then began to rise. And it got all the way up to 17, which is pretty bearish, but now it's back to 12. So again, not really too worrisome at this point in time. So right now, things are good with VIX. The term structure is sloping upwards. The futures have a premium. those negative things that popped up there in the middle of October seemed like they were going to be a problem, but surprisingly, at least so far, they haven't been. We have written some articles recently about the difference between realized and implied volatility. The takeaway here is that we recently had this point G, where implied volatility got well ahead of realized volatility. And what that tends to mean is that not necessarily the market goes up or down, but the market is volatile. And that happened to, back there at the end of October. So, market's been pretty volatile since then. This is a thing that you might have read about. There was a 5-day in a row period where SPX was up every day and VIX was up every day, and that had never happened before. But it turns out it had never been up 4 days in a row either. So we checked out the ones that have been up 3 days in a row, and they really were kind of meaningless. They didn't mean anything. So it's just a big to-do about nothing. Anyway, so where do our indicators stand? Well, these things on the left here are various shades of bullish. The S&P chart is bullish. I moved it away from the left edge because we're not at a new all-time high, but it's still bullish. New highs versus new lows. I said that's a new buy signal as of today. The VIX spike peak is still bullish. The trend of VIX, that's bullish. The breadth oscillators, I said we just had a new buy signal yesterday. And the construct, that's the term structure we just looked at, that's bullish. On the counter side of the ledger, we have that McMillan volatility band sell signal from the Bollinger Band, modified Bollinger Bands. Realized volatility I just mentioned, that's still kind of high, but it's decreasing. So I'm moving this towards neutral. And the equity-only put-call ratios, we saw they're still in their sell signals. But frankly, all three of these, their initial signal was a while ago, so they're getting kind of stale. So this is pretty much a bullish picture. And as long as S&P is above 6,500, I wouldn't worry too much about the market. If it breaks 6,500, then I think you're going to have a big problem on your hands. But I'm not saying it's going to break 6,500, just if it does. So now back to the offer. If you go to this website, optionstrategist.com/metastock, we're offering our top 3 newsletters, which is the Option Strategist, the Daily Strategist, and Daily Volume Alerts. 1 month of each, combined total value, total cost $99. You can take them consecutively, so you're not overwhelmed with new information all the time. The Daily Strategist is our most expensive and our most popular. Comes out twice a day. Has a kind of a speculative, newsletter in the morning and more of a volatility-based, theoretically based one in the afternoon. So I said those 3 newsletters for $99, and our track records of these are available on our website if you want to wander around there and find them. Obviously, past performance is no guarantee of future results, but we've done pretty well over the years with our recommendations. We also have a YouTube channel. I put a market comment up there every Monday and a couple of other newsletters. You can find those by just wandering around our website. But again, here's optionstrategist.com/metastock. If you're interested in money management, you can email me at this address. I will note that our minimum account size is $100,000. So, Jeff, I'll shoot it back to you. I think we more or less got there on time.
Yeah, no, good job. We started you a minute or quite a few minutes late, so I appreciate your doing that as well.
So, let's see, do I have to return a screen to you or anything? Or
No, I can do that myself, actually. So, I did put all of the links in the chat. We did have a comment from Long that said, great presentation. I'm just going to eject you, and that's all we need to do.
Okay.
All right. Thank you so much, Larry. I appreciate it.
All right, Jeff. Glad to do it. Hope to see you soon.
All right. Sounds good. All right. Yes. Okay. Let's do this. Let's go ahead and actually turn my camera on, share my screen. Oops. Okay. Let's go ahead and share this real quick. All right. As we kind of get to the last session, I do want to say thank you again to AAII for sponsoring the event. They did a great job of sponsoring and providing information. So very much appreciate them and the work that they've done over the years. Also, Stocks and Commodities Magazine, also the TradersForum.com. Greg, I want to ask you a question.
Yes, how can I help you today?
Oh, it's the prize of the day.
It is the prize of the day.
Yeah. And you just all I see in your camera is like black.
Yeah, it's a long story, but there comes.
Oh, there you go.
A little late, not unlike me.
Glad you turned on the light. Anyway, I
just adjusted the. Doesn't matter.
Buff says he can't hear me, so I'm a little bit worried. But
I can hear you just fine.
No, he said he couldn't hear anything, so we might have another little bit of a situation.
Oh, but are you freaking kidding me?
No. But we're gonna see if we can hear him, which is the more important part of that. So, but before we do that, let's give away the massive prize of the day.
Yeah,
I like to give it away to the person that the most active chatter. We are going to give away 3 months of Metastock. Now, normally I'll put you on the spot and have you talk a little bit about Metastock and give a little bit of a blurb about Metastock, but I think I'll do that this time.
Okay, you go ahead.
Metastock, we're going to give away a free 3-month subscription to. You're going to get the dog. All right, we have a 3-way 3 months subscription to Metastock Real-Time, our real-time version of Metastock. It's been rated the best software in its price category. Metastock has for 32 years in a row. We've talked about how you can use it to scan markets, find the best trades at the best times, and the best opportunities. We've talked about testing. Kelly did a little bit of a demo on testing. Talked about the importance of understanding whether or not your system works. We've shown off the commentary and kind of how it can give you signals and alerts, and it can kind of give you commentary and all that kind of good stuff. We're going to give you 3 months of that. We're also, but that's not all we're going to give away, Greg.
Wait, is that all?
Metastock RT just wouldn't be complete without Metastock Zenith. Metastock Zenith is a news program. It's supported by over 2,000 different journalists in 200 different news countries through 200 different news bureaus. Oh boy!
You sure you don't want me to do this? Or
I had the market breadth available and the fundamental data available in Zenith was built to rival Bloomberg, which is $22,000 a year. So we're going to include 3 months of that. It's awesome. Very, very good news service. We're going to also include 3 months of Learn Metastock, which is a service that's $99 a month. So all of that is going to be available. And really, like with this one, you don't. We're going to give it away to somebody that asked a question. Audience participation is huge. We like to reward it. If you have questions, we want you to ask.
Yes, we do.
We've been very good, Greg. I think we've answered almost every question. I don't think we've missed any. If we did, I'm sorry.
We rarely do.
Yeah. So what I'm going to do is actually going to come over here to the questions. Going to go out to the thread. I'm going to go ahead and make sure that I'm showing all of them, which there's got to be hundreds of them from today. What I'm going to slowly do is I'm going to just have you tell me when to stop, and whoever we land on is going to be whoever wins the prize. Hopefully they're still here so they can say, "Yay, I won a prize." But in any case, I'm starting.
Charlie will chime in when it's time to stop.
All right. What, are you going to squeeze him till he barks?
It's a her. Thank you very much.
All right.
Go ahead. I'm sorry. It's been a long day.
Yeah. When am I going to stop, though?
Bark. That means stop. And dog, that's stop. I happen to know.
All right. Ed D. Earlier here today, he said, "Boom." So he just won the prize for that. So congrats.
Wow, that's a lot for boom.
Ed.
That's the best boom he'll ever get.
All right. Thank you very much, Greg. Let's see if we can get Buff.
You're welcome. I'm going to stick around for just a second to make sure that Mr. Dormeier is.
Yeah, let me see the messages.
While you're doing that, I would like to point out to the audience that I will be gone tomorrow and the next day. So Jeff will be flying solo on Wednesday and Thursday. So please give him the utmost lenience and love in my absence, because this is hard enough to do as a duo, as we've demonstrated, but it is much harder to do when you're flying solo, which is what he'll be doing for the next 2 days. So if there's some issues, please be patient. Jeff, have you heard from Mr. Dormeier at all? Dormeier. I keep on calling him Dormeier.
I can see that his mic's on.
I can see he's turned his volume, or he turned his mic on. Buff, can you hear us? Maybe message us?
Okay, I'm gonna have him rejoin, which is the biggest way to fix it. So is what we did a little bit of Google research earlier in case this happens again.
I'll entertain people with my best friend and studio mascot, Charlie.
Yesterday went so well too. So,
I'd like to point out, while you're doing that, I'd like to point out to folks that, again, we're doing a new we're utterly blaming and throwing GoToWebinar under the bus.
I think it's completely their fault.
Which we've been slow to adopt because we don't like to adopt new interfaces of things too soon before they've gotten the bugs out. And so we finally adopted it after being out for like a year or so. And this is the third problem we've had today with people coming through with audio. We have looked up and researched this, and it turns out that rebooting helps. Not rebooting the whole system, but at least rebooting the browser. It looks that is what Buff is doing. I should say right now, while we're waiting, I can tell a little bit about Dormeier. He is the industry's poster boy for volume. If you want to know anything about volume, he is your man. Seriously, is there anybody more of an expert on volume than Buff Dormeier? Let me go ahead. Let's put our studio mascot down for a second. We do apologize that once again we are having to postpone things while we get a speaker on. Today is again the last speaker of the second day of the Traders Conference, and while Jeff is trying to get Buff aboard, let me share with you a couple things real quick. Okay, tell a little bit about Buff before it comes on. This is Buff Dormeier. Again, he is a champion of volume, and I don't think I've heard anybody else talk about volume the way he does. His presentation is Intro to Volume Studies, Decoding Money Flow for Market Insight. If you'd like to know a little more about Duff, he is the CMT to Chief Technical Analyst of King's Peer Partners. He provides 3 important roles to KingView's clientele that are an advisor, analyst, and portfolio manager. I'm not reading any of this, I just happen to know it. Armed with proprietary indicators and investment programs, Buff dynamically advises financial advisors, RIAs, as well as affluent and institutional clientele on strategies to help keep your specific investments objectives in what are often uncertain investment climates. All right, regarding his there he is. I can at least see Buff now. Buff, can you talk?
I can talk. Can you hear me?
Oh, that is music to my ears. You don't know the day we've had, Mr. Dormeier.
I'm not hearing you through the computer, though.
Can you not hear us? Can you hear us now? Testing, testing. Calling it to Buff Dormeier. Volume Evangelist.
Okay, you want me to just go? I can't hear you.
Yeah, go ahead.
Yeah. If you got him on the phone, Jeff, let him just go ahead and take off.
Yeah, we can hear you. I'm going to hold on to it with you. Go ahead and hit your share button on the share screen. I'll make sure your screen shared.
Okay. All right.
Do you see the share button?
Yes, I do.
Perfect. I see the volume factor option. So I'm just going to hang up and let you go.
All right.
We can hear you. I can even hear me through your mic.
All right. Thank you.
Good to go.
All right. Hey, well, thanks everybody. Appreciate your patience there. Hey, today we're going to talk about offense. We're going to talk about using volume or the volume factor in building a prolific offense. So just a a little bit about me for introductions. I'm the Chief Technical Analyst of Kingsview Asset Management, and I'm also the Index Specialist for the Monarch Funds Volume Factor ETFs. Okay, so I'm not sure if you're going to be able to hear this or not, but this is a classic. And here we have from the movie City Slickers, Curly explaining the secret to life. And what does Curly say? Curly says the secret to life is just one thing. So the question I want you to ask of yourself is, what's your one thing? Give you a little story. I was at a higher education event earlier this spring. It was actually during the tariff tantrum, and all kinds of hell was breaking loose. And so in that, I was in there with lots of professors of finance and some CFAs, and there's one in particular high-profile CFA. And given it was such a critical time, we would have conversations, and he would point out a piece of data, and then he'd give his rationale why the market's going to go up based on this piece of data. And then 5 minutes later, he'd pull out another piece of data, and then he'd say, well, the market needs to go down because of this. And then and I would be polite and engage and give arguments and counter arguments, and this went on for a couple of days. But after a while, I just couldn't take it anymore. And I just told him all that, that might be important, and it might be important to you, but to me, none of that means squat. I only care about one thing. And on April 9th, more money flowed into the stock market than any other day in history. I'm going to follow the money. More recently this summer, I was in a conference in Chicago speaking on a panel. There's a CIO, there was CFAs on this panel, and they all had their views on the various markets and why they should be bullish or bearish on their portfolios. And finally it came to me, and I just had to tell the audience, I don't care about all that. I only care about one thing. Where's the money going? And the money was fleeing the greenback, and it was going back home. And that's why our portfolios shifted to international gold and mining stocks, because I'm following the money. You see, I wake up every morning and I should thank the good Lord. He's given me my one thing. And today I have the privilege of sharing with you my one thing. And that's, how do you follow the money? So we're going to follow the money by building a prolific offense, utilizing volume momentum. So you got to know when to hold them, and that's price momentum. But volume analysis takes us a step further. You got to not only know which ones to hold, but you got to know which ones to throw away and which ones you keep. And in volume analysis, we want to own the ones garnering the strongest capital flows. So let's take a step back and just look at bigger picture. What is volume? Volume is the number of shares traded over a given period of time. What does volume do? It measures participation. It measures interest. It measures the enthusiasm. Now, I like to think of volume as being synonymous with force. And if you were to look up the definition of force in the physics in the dictionary, you might find this in Webster's. Force is a power made operative against support and resistance. And so that takes us back to technical analysis, the roots. And what is support? Support is an area where buyers reside. Price comes down, there's people that missed out perhaps at that price. They think it's a good value there, and they unwillingly support the price, can keep it from going lower. What is resistance? Resistance is an area where the sellers reside. Stock goes up, people think that it's overbought there, or they think it's overpriced there. They sell out, and then that forces the market down. Okay. So volume is a power made up against support and resistance. Okay, but it also tells us something about trends. What's a trend? What's an uptrend? An uptrend is just a rising support line. And in technical analysis, a downtrend is just a falling resistance line. Okay, now let's jump ahead here. What is the force that sustains those trends? The force that sustains those trends is the capital, the money, or the volume. So let's move on here, and we'll look up the definition of force in the physics dictionary. And this is what the physics dictionary says. Force is a vector quantity that tends to produce an acceleration. So this confirms another major tenet of technical analysis. Since the very beginnings, the days of Charles Dow, over a century ago, that volume leads price, meaning that significant changes in volume patterns often precede significant price movements. Since volume leads price, and the volume is the producer of acceleration, shouldn't we then consider volume in our momentum analysis? Okay, so think about it this way. You know, what did any Star Wars fans out there? What did Yoda say before engaging an important mission? You'd ask, or he'd say, "May the force be with you." Volume, my friends, is the force of the exchange market. If you take one thing out of my presentation today, remember volume is the force. And you, as the investor, you want to make sure the force is with you, or better said, you are with the force. You want to be where the money's going. Okay, so we're going to expand upon physics here. We're going to talk about volume's role in momentum analysis through the laws of Newtonian physics. So, what is the first law of motion? An object at rest and an object in motion remains in motion at a constant speed and in a straight line unless acted upon by what? An unbalanced force. So, with that thought in mind, most momentum, if not all momentum analysis, neglects that force or volume. So what we could redo is we could rewrite this Newtonian first law and Newton's first law, and we could rephrase it in market analysis like this. A price trend in motion or momentum tends to remain in motion at a constant speed and in a straight line unless acted upon by unbalanced volume. Anybody remember Joe Granville? In the late 80s, Joe Granville had the saying, volume is the cause, price is just its effects. So almost all volume analysis focuses strictly on the effects, but shouldn't we also consider its cause? So we're going to start by looking at some momentum indicators, okay? But we're going to look at those, specifically those that neglect volume in the calculation, okay? So as Newton's law's first law suggests, momentum and trends continue until the volume changes. Okay, so there are two primary types of momentum. Okay, one is what we call internal momentum. That's momentum relative to itself. That means how, say, a stock is doing relatively compared to how it was doing previously. Okay, then there's external momentum. that's momentum relative to something else. Like, how is the stock performing relative? How is its momentum relative to, say, something like the S&P 500? Okay, so this graph right here is from Richard Totello's book, Quantitative Strategies to Produce Alpha. So Tortillo, he's a research analyst with the S&P. And so given that, he had a front row seat of testing all these strategies that would come out with things like, exchange traded funds and things like that. So he wrote a book about all the different testing that he did. And in his book, he tested over 1,200 indicators from 1992 to 2007. And he tested these to see if these actually produced alpha. Okay, and the vast majority were being fundamental data or fundamental indicators. But he did test a couple technical indicators. And of all the indicators he tested, all that 1,200, guess which one had the highest alpha? You betcha it was RSI, the Relative Strength Index. Okay, so here you can see that the results from his test from 92 to 2007. And you can see here that the RSI, I'm not sure if you can see my mouse, but it produced over 6% of alpha in the top stocks with the top quintile, top 20% of high RSI scores. And the stocks with the lowest RSI scores, the fifth quintile, produced the lowest returns. Now, we did our own study on RSI, and we did it from a different time frame, but some of it covered there's about 5 years in common. We studied it more recently from 2002 to 2023, and we tested the Russell 3000 members. Okay, and so here are the results by decile. Okay, and you can see here that the stocks with the highest top 10%, or even here the top 20%, those stocks underperformed the index. Whereas the stocks with the lowest RSI, the stocks with weakest momentum, actually outperformed. So these RSI results are the polar opposite of Tortillo's research. And so what does that tell you? Momentum analysis is fickle. Sometimes it works really well, and sometimes it works differently. Sometimes you want to buy stocks that are oversold, and other times you want to buy stocks that with strong momentum. Okay, so we need is a tell to tell us which one of those environments are we in and what we should be doing. Anybody want to guess what that tell may be? Okay, now let's move on here to relative strength. This is not RSI, but RS. And relative strength compares a security's momentum to that of another security, like the S&P. And when you look up like the momentum factor, this is typically what they're using to figure out that that factor of momentum, what a stock is doing relative to, say, the S&P 500 or another benchmark. Okay, so as a technician, it doesn't surprise me that of all those 1,200 indicators that Tortillo tested, that RS also scored very high, easily in the top 1% of all the indicators. It was actually in the top 10, easily in the top 10 of all the 1,200. So in his study from 92 to 2007, the highest quintile RS stocks outperformed by over 3%. And the stocks with the lowest relative strength underperformed by 3%. So the strong stocks outperformed by 3. The weakest relative RS stocks underperformed by 3. So again, we tested it again. And here's what I found out, is that here we find something that works in both time cycles. Okay, again, it was 2002 to 2023. We tested the stocks by RS, and the top decile stocks, top 10%, outperformed by 4%. Okay, but also the weak stocks also outperformed. They outperformed by 5%. So again, maybe we can find a catalyst to help identify how do we use this strong or weak momentum in what way. Anybody think about what that catalyst might be? Okay, so let's move on. And let's move to Newton's second law of motion, which is force, or in technical analysis terms, volume. So according to Isaac Newton, momentum is the acceleration of an object, depends on the mass of the object and the amount of force supplied. Okay? So we can rewrite this and think about it this way. The more volume or force being applied to price, the stronger the expectation of the momentum. So here's the analogy. Price acceleration or momentum is powered through volume. Think about it this way. Volume analysis is how much force is required to move a security a given distance at a particular speed. Again, how much force or volume is required to move a stock a given distance, which is price change, at a particular speed, which is momentum. Okay, that's what we're going to look at here next. Okay, so up on top, we've already went through this RSI. Okay, now below this, we're going to put below another indicator called MFI. That's the money flow indicator, MFI. This is one of the indicators in our Metastock toolbox. Okay, the volume analysis toolbox. Okay, so this is one of the indicators we use, and what it actually does is this is an indicator that goes back all the way to the late 70s. Okay, and all MFI does is volume weight RSI. So RSI is the same thing as MFI, but RSI does not contain volume data, and MFI does. Okay, and so what happens? Why would we want to add volume to RSI? Well, because we want to utilize volume information, or the volume factor. Okay, so what happens when we do that? We take a strategy that underperformed by 2%, and now it outperforms by 2%. Okay, and that's evidenced by these top decile results between the two strategies. So most people, they don't use volume, and that's particularly true even in momentum analysis. You don't see too many people using MFI. They use RSI, but what should they be using? They should be using MFI. Okay, but that's just a small piece of it. Okay, most people, that even those that use MFI over RSI, they stop there. Okay, but even there, they're neglecting the most significant law, and the one that frankly everyone misses. Okay, and it's not the first law, it's not the second law, it's the third law that really makes a significant difference. Okay, and what is the third law of motion? Every action has an equal and opposite reaction. Okay, so the way to think about this is it's not about price momentum. It's not about volume. Okay, it's the difference, the delta between price momentum and volume, which exposes the asymmetry between what's happening in the price and what's happening in volume. So again, this is the delta between price trend and its momentum. Okay, think about it this way. When we look at that difference, that delta, we're looking at that we're producing a delta force. Demand is pushing, supply is pushing back. What does that reaction look like? Okay, and so here's the first indicator that we're going to study is the volume price confirmation indicator. Okay, what it does is exposes the asymmetry between a price trend and a volume weighted price trend. So it's exposing the asymmetry in trends between prices and its volume. Okay, so again, we're not looking at price, we're not looking at volume, we're looking at the difference between the two. Okay, so the goal of this indicator, the VPCI, volume price confirmation indicator, which again is in the Metastock toolbox, is to verify trends. So in this study, what we did is we took the stocks out of the S&P 500, the top 10% or the top 50, and we owned every quarter the top 50 stocks in the S&P with the highest VPCI ratings. And by doing that, we outperformed the market over the last 2 decades by about 3% annualized. Okay, so next, Jeff was saying before the break, he was talking about Stocks and Commodities magazine. So this was a cover feature. I believe it was last year around this time. And this, we talked about the volume momentum indicator. Okay, and so the VMI, or the volume momentum indicator, is again one of the tools in our toolbox, the volume factor toolbox that you can get through Metastock. And there isn't a whole lot of places that you can actually find this. But what it does, it looks at the difference between MFI and RSI. So it's that delta between momentum and volume momentum. Okay, and the stocks with the highest VMI or delta force, or the strongest volume confirmation of the momentum, produced nearly 7% of alpha over top decile, over 7% of alpha over the benchmark. Okay, the VMI is showing if momentum is being confirmed or contradicted by the volume. So many people are looking at the momentum, okay, and then they get frustrated because, oh, I bought a stock with high momentum, and it goes down, and then I buy another one, it goes up. Okay, what we're looking at is we want to buy this indicator. We're looking at it is not only is the stock up, but is the volume, the capital, more stronger than the price momentum. So we want the volume momentum to be stronger than even the price momentum. And when that happens, we get high scores in the VMI. Okay, this is what it looks like. This is on a chart here. This is the VPCI, and this is the VMI. So let's just review. Newton's first law of motion. We can summarize that. Volume is the unbalanced force causing price change. 2, next is Newton's second law of motion. Price acceleration or momentum is powered by volume. Newton's third law is the difference, the delta between momentum and volume momentum exposes an asymmetry between price momentum and its volume. Okay? Remember this. Price is the effect, Volume is the cause. So what we're going to do next is we're going to combine the winning strategies that we just went over, covering Newton's law of motion. So the first law of motion, we had a winning strategy of relative strength. We're going to take the stocks with the highest relative strength, and then we're also going to add in the stocks with the weakest relative strength. And how do we do that? We're not going to use relative strength. We're going to use absolute relative strength, which looks at positive and the negative numbers, the ones that are the strongest. So absolute relative strength. We're going to take this one and this one. We're going to take the stocks, top decile VPCI, stocks with the strongest volume confirmation through trends. And then we're going to add finally in the VMI, which is the strongest volume confirmation of momentum. And we're going to combine these all into one strategy. And we do that, we move from this return of the Russell 3000 of 12.6% to a return of 24.5% annualized return when we combine all three of our volume factor indicators into one. This is what it looks like. If you started an account with $10,000 in 2002, it would have grown in 2023 to 123,000. But using this top decile, it would have grown over to 1 million. The 10,000 would have grown over to 1 million using those three factors. These are the results per year. And these are the other deciles. You see the top decile way outperforms everything. Okay, so one of the things that you have in the toolkit through Metastock is a screener. And so what I did is I picked out maybe a dozen stocks from the screener that screened at the close of last week. Okay, and these are the stocks that passed the screen for the volume trend momentum test. So again, through the toolkit, you can screen stocks via and screen the stock market and get a list of stocks that meet the criteria that we're looking for a volume analysis setup. Okay, so just kind of go over the chart here. First of all, the color. So black doesn't mean anything, but when it's green, and you see this green arrow, that's a buy. It was on a buy signal. Okay. The next thing is you have these green dots. This is if you were to sell short, like here, you got a short sale, and if the stock closes above that green line, you get stopped out. Okay. The same thing here is with the green arrow. You buy the stock here, and then if it falls below the red line and closes below it, you get stopped out. And so you can see here the last, here in February, we got a nice buy signal here on CIB. And then just this past week, we got another buy signal. So if you get a second one, it won't produce the arrow, but this did trigger. That's why it was on the screen. So we got another buy signal again on this stock last week. And then you'll find several like that we go through. So again, here's another chart. This is SPHR. Stock breaks out right here, but look, we even got the signal, the initial signal way back here. Okay. Here we have the VPCI. Here we have the VMI that we talked about. And this is another indicator I didn't mention. This is the trend thrust indicator. The trend thrust indicator is one of the tools that we actually use to generate these buy signals. It was also written up in Stocks and Commodities magazine. And think about it like this. If you like the MACD, this is the MACD on steroids. But to say that is really an understatement. This is so much more powerful than the MACD. You not only get quicker signals, but the reliability is almost double with this indicator. Okay, this is ENS. And again, we got a signal here, breakout signal. Okay, this is PH, Parker Hanifa. We got a signal here and then another signal last week. Notice the VPCI is crossing over here. Okay, this is this is a good one. Seagate, this is getting a little frothy here, but this is a great signal for us. Buy signal right here. You can see at that time that the TTI crossed over a little bit beforehand. It got verified by the VPCI. VMI is doing well, is strong as well, and very nice, powerful move. That's probably a little frothy to buy right now. This stock is just got a signal last week. Okay, this is DOCN. Okay, this is IRMD. Notice the original signal. You see that buy signal here often produces the green arrow here. Again, this dotted line here is the stop loss. And notice how we trail the stock up as it moves higher. Cardinal Health. Boy, this one we originally got a signal right here, had a couple stop outs, but we got back in here. And then just recently we got other confirming sells, or confirming buys rather. Okay, this is JCI, Johnson Controls. We got a signal last week. And then LGND. This one we got earlier in the late second quarter. Again, but it re-signaled last week again. Fox News. This has been mostly on over the last couple of years, and we got another buy signal here about 3 weeks ago, and then it was confirmed last week. Does not always have to be in stocks that are going up. You can see that this one here is breaking out. They're being in a downtrend. Green arrow just last week. See signal here, crossover here. AER, recent signals. And what do we got here? AHR. Okay, another signal, not quite as strong. Like the VPCI is, the TTI, the VPCI is not that high. So this isn't a super strong signal, but nonetheless, it did trigger. And then NTRA. Okay, this one just recently signaled again. Okay, you look at it, broke out of that base. It's a good chart pattern there. And then HCC, we got a signal last week. All right, and so to kind of finish up here, I'll give you this one last nugget. So I'm calling this a volume factor, and the reason is because volume is not just a piece of data. See, I'm going to make a claim here. It's not just an important piece of data or a data set, nor is it just a leading indicator. But when volume is used correctly, it's actually what we call a market factor, like I mentioned momentum before. Okay, and it's not only a market factor, but it's the monarch of all the factors. Okay, So that's a big claim. It's not only a factor, it's the monarch of all factors. Okay, so the proof is here. Okay, this is according to the factors, the people that really started factor analysis, that they used what they call the FAMA French model. Okay, the FAMA won the I think a Nobel Prize in economics. Okay, and the FAMA French model is the gold standard for factor investing. Okay, and so according to the FAMA French, to be a factor, you have to have a minimum p-value of 0.05. What that simply means in normal terms, a p-value of 5 means that there's only a 5% chance that the results came from chance. Okay, so most factors really struggle to meet this minimum criteria of 5, but yet there's so few factors that they kind of let some of them slide. Like I'd say value is one of them, size is another. They just barely meet and often don't meet that 5% probability or p-value of 0.05. So the strongest ones are typically momentum and quality, and they produce p-values typically of 0.01, meaning there's only a 1% probability of the factors by chance. And so what's the p-value of the volume factor? So Dr. Matthew Ludi ran the FAMA French model using my not all of them, but some of the pieces from my volume factor. Okay, like the VPCI, for instance. And then these were published in the Journal of Accounting and Business Economics. That's J. Okay, and what did the volume factor p-value produce? Not 0.05, not 0.01, not even 0.01 or 0.00. It's 0.001, meaning it's 100 times stronger than the next strongest factor. So yes, volume is not only a factor, it's the monarch of all factors. So what's your one thing? Well, my one thing, if you haven't figured it out, is following the money. Okay, and so I follow the money, and that's my one thing. So you too can follow the money through the indicators that are available to you on Metastock through the toolbox. And Jeff's going to talk to you a little bit about how you can order those. Okay. So the big thing is you want to be in the stocks that are garnering the most capital. Okay. And in addition to that, if you want more information, I do have if you want to follow my weekly report, you can do that through info@buffdormeier.com, and you can subscribe for free to my weekly commentary. Oh, what happened to it? I'm sorry. Okay, I also have a couple books. My newest book is The Volume Factor. And then I also have an older book. This was that in 2012 won the 2012 Book of the Year, and that's Investing with Volume Analysis. So I appreciate your time today, and I encourage you to find your one thing, and wishing you the very best with your investing. Thank you.
Thank you, Buff. If you can hear me. I don't think you can. Anyway, I'm going to, hello. Thanks, Buff. All right. Great job. We could hear you fine. Appreciate it. Anyway, thank you, everybody, for coming today. I'm going to go ahead and kind of just share my screen and talk about the Buff Dormeier add-on. And then you'll be happy to know I've made a decision. We do have an option. We are using the new interface. We've run into some issues with the new interface with 3 out of 8 speakers today, which I've made a decision that we're going to use the old interface for the rest of the week, because that's just pretty ridiculous.
Make sure people understand you're talking about our go-to webinar interface and not Buff's analysis toolkit interface. You kind of segued in there.
Nobody that's watching is actually going to have any issues though with this. So just come the same way you normally come. Everything on your end will look the same. What we're having is issues with the interface that we're given as presenters. So we're going to kind of
it will look the same. They won't notice any difference. The interface for the end users is exactly the same. And having said that, I will get out of the way because now we tested my audio as we wanted to.
Right. I would. Buff Dormeier did release his system for Metastock. His system won the Dow Awards, which is what I would have really talked about quite a bit had we not run into some audio issues. So this is a really, really cool system. It won the Chartered Market Technicians Dow Award, and it's great. It has 2 expert systems, 2 explorations, system tests, templates, indicators, everything that you need to run it. We are, of course, and that would include the Buff Dormeier Trend Momentum, and then the Buff Dormeier Volume Trend Thrust. Of course, we're going to offer a little bit of a discount. This is a subscription-based add-on. It's normally $149. It's the normal price. We're going to give you a permanent discount on the price of it at $99 per month. If you buy a month, we'll give you the second and the third month for free, so you can try it out for 3 months. To do that, you can go to metastock.com/conf-promo. If you have any questions at all, give us a call, 800-882-3040, or metastock.com/salespchat to chat online with us. And I would really recommend that you try it. It's a Chartered Market Technicians Dow Award-winning add-on. Permanent discount if you decide to keep it, $50 off forever, $99 per month. So give it a go. As we kind of close up today, I want to say thank you for you. Thanks for being here. I hope you learned something. I hope it was enjoyable for you. We got some behind the scenes look while we tried to figure out audio issues, all that kind of stuff. Also want to thank our sponsors, AAII, AAII.com for them. Stocks and Commodities Magazine. You can find them at traders.com. If you haven't yet, join the Traders Forum. We do live sessions all the time there. We do lessons. We do classes. We do guest experts where we'll bring in somebody and just do like a podcast style thing. It's very, very fun. It's very, very free. We talk about cool stuff all the time. You can join for free at thetradersforum.com. And then you should come and chat with us and talk to us about how you trade and what stocks you're interested in, and we'll share ideas with you. I get a lot of really good picks from the Traders Forum. We're up to about 1,300 or 1,400 members. It's not huge, but it's growing, and there's some really, really good ideas and knowledge. I've actually learned quite a bit running the forum myself. So thetradersforum.com. As just a reminder, Metastock is a charting software. It's a scanning tool. It's a testing engine. It's an alert engine. If over the decades, I've spent a lot of time talking to people about kind of the issues that they're running into trading, and it usually comes down to they don't know what they're doing, or they don't have the right system, or they're not very good at picking the right stock. And that's something that Metastock's very, very helpful at addressing all of those issues. So if there's something that you're looking to do that improve your trading, we've been working with traders for decades. And I think that's why for 32 years in a row, Metastock's been rated the top software in its price category. We have a special running right now. If you sign up, you can get you pay for the first month, you get the second and third month for free. It gives you a lot of time, gives you unlimited access to like our support desk, gives you a one-on-one session, gives you some training materials. Metastock's a great tool bag, so you're going to learn. It's going to grow with you as you learn more and as you want to implement new things in the market. again, give it a go. I would not trade without it. I would not be able to be as effective as I am in the market without it. So any of the specials that we've got today, you can get at metastock.com/conf promo, metastock.com/sales chat, or, we'd love to talk to you. If you have any questions, 800-882-3040. I hope you guys had a good session. Thank you for hanging out the whole time. We'll see you tomorrow. We have some great more speakers tomorrow. Thanks for being here. Stay healthy, stay well. See you in the morning, 8 a.m. my time. Bye, everybody. Bye, Greg.